focusing on specialty products. And of course, there'll be some speed bumps as they go along. But end of the day, it's a very sound strategy in a situation where a lot of the markets, the formulation business is getting highly commoditized. And on the whole, I think that once they have more product launches and they do geographical expansion of those products as well, this could be a sustainable growth momentum for the company. And eventually, I think investors will start paying even higher valuation for such a business. So I'm very positive on Sun Pharma. Disclosure, we and our clients are invested in it. Valuation wise, also it's reasonable. And I think that they're getting a nice upside at present because of a certain situation in the US generic market where price erosion seems to have got a little reduced as compared to maybe 2-3 years ago.
Okay. Dipan, hi, good morning. I wanted your thoughts on Jubilant Foodworks because finally after 4 quarters, Domino's growth has, improved. So I think that's something that the street perhaps will like. But your thoughts on the numbers?
Yeah, good morning, Sonia. But same store sales growth is flat. And a lot of the growth has come from new store openings, and there's only so much of expansion that they can do. We really like to see same store sales growth to improve. Of course, they keep saying that because they're adding stores closer to the existing ones, therefore the SSG is not as strong as it expected. But nonetheless, I think it's a good story. But look, a lot of the positives have got captured in the stock price. It trades at a very rich price to earnings multiple, which perhaps doesn't justify this kind of a high PE multiple. So I would just say wait and watch as far as Jubilant Foodworks is concerned. And end of the day, I think, it's basically a single product company. And that also is a bit of a risk factor.
What about Nykaa? Because, the performance was good. I mean, revenue growth of almost 30%, EBITDA up 32%. But I think this is something that the street knew, right? They gave us the updates a couple of months ago. Your thoughts on this stock?
Sorry, I missed the name, Sonia.
Nykaa.
Nykaa, yeah. No, I think it's following through on its business plan and it's executing pretty well, I think. The entire category is growing pretty well and we are seeing a lot of traction over there. But, I don't want to buy a company where profits are as minuscule as they are. They're just about breaking even. We want to get into consumption-related businesses where there are solid profitability. It's getting over there, but it's not yet there. So I would also place Nykaa on hold for the time being.
Okay. Dipan, hi, morning. Just coming to you, but here there's two sort of deals which are taking place. One is the QIP, there is a block. Abhishek is here with details on Keystone Realtors and Star Health. Abhishek, morning, take it away.
Morning, Prashant. So sources do tell us that Keystone Realtors have launched QIP. The base deal size is about 800 crores, which can be upsized to about 1,000 crore. Now, the the indicative floor price that they have set is about 660 per share, which is at a discount of 9.6% to yesterday's closing price and about 5% discount to SEBI's floor price. Equity dilution would be around 10.6% due to this QIP. Star Health, CNBC-TV18 news break has been confirmed. Block deal has been launched. $266.3 million deal has been launched. We had reported that deal will be in the vicinity of $250 million to $270 million. Block deal is priced at about 530 to 538 per share. We had mentioned that the price would be around 530 to 545 per share. Now APIS, Madison, that is Mio, as well as ROC Capital are the sellers. Mio Star will have a lock-in of 120 days post the stake sale for their residual stake in the company. Mio held about 4.6% stake, APIS held about 2.6% stake, ROC Capital held about 1% stake in the company as of March 2024. ICICI Securities is the sole broker or the banker to the deal. Back to you.
All right, Abhishek, thanks very much for that. So keep an eye out on these two names as well. Dipan, just a quick word on Medanta, if you have a view. Stocks down some 15% in 2 days after results. Do you like it? You track it?
No, Prashant, it's a new listing and I'm just waiting for the stock price and the performance to settle down. But generally very positive on hospital companies and these are secular growth stories because healthcare consumption, healthcare costs and healthcare spending is going to keep on moving up in a structural way as and when there is more awareness. So generally positive, but not had a look at Vedanta that closely.
Okay, well, let's focus on the infrastructure space now. And Dipan, I want your thoughts as well, but we have someone who tracks the space. Ankita Shah, who's the Vice President Research at Elara Capital, is with us. Ankita, thanks a lot for joining in. First, if we can just start by telling us what your overall call is on the infrastructure space. What is the stocks that you're most bullish on now? And then, of course, we'll get to individual names as well. But what's the overarching view now?
Yeah, so we are very positive on the infrastructure space. If you see last year, FY24, the awarding activity has been muted, but post-elections, we're expecting the order awarding to pick up significantly on the government orders. But in the meantime, state governments have been very active. Recently, MSRTC has announced a lot of new packages that are opened up, and multiple infrastructure companies have emerged as L1. Like PNC Infratech, HG Infra, NCC, GR Infra, which are could be key beneficiaries of these project awarding. So, in the absence of central government orders, state governments and some private sector orders are also continuing. And post the elections, a lot of ministries have been working on a 100-day plan post-election, which we believe could lead to further boost in new project awarding going forward.
So you mentioned a couple of stocks, right? And we had them in focus yesterday as well. Let's talk about them. PNC Infra, I think total orders worth 5,000 crores is what the company is looking at. From this price, what kind of stock price upside and earnings upside are you factoring in?
Yeah. So overall for the infrastructure space and, the key companies that are in discussion, we are expecting at least a 20% earnings growth on the current numbers. However, given the buoyancy in order awarding pickup, we expect, a lot of these companies to raise the guidance in terms of new project awarding going forward. If that happens, then the visibility on new projects improves and the earnings upside could be higher than that. But currently, we are working with approximately 20% earnings growth over the next 2 years, FY24 to FY26.
All right. Hi, Ankita. Good morning. Nigel on this side, and good to see you. And I want to ask you about the big boy, L&T. They came out with their set of numbers. The street didn't like their guidance, I think, and even the margin miss. Your view on the stock at current prices?
Yeah, so L&T remains one of our top pick in the space. Despite global headwinds last year, I think they reported very good performance for FY24, on inflows, on performance on the core ENC side, net working capital improvement and ROE. So on these fronts, they have delivered well. On this high base, the growth pace, the rate of growth is expected to slow down, and which to me, I don't think is a surprise. So we believe with the strong order book that they have, almost around 5 lakh crores of order book is what they are sitting at. It's almost a 3 times book-to-bill visibility. We believe the momentum is likely to continue. Also, the order prospect pipeline is much better versus previous year for the domestic markets. So when last year the international markets contributed to the inflows, I think this year domestic will pick up significantly for them, and that should help the momentum to continue going forward. So we remain positive on L&T.
Got it. Ankita, just one thing. Across your coverage universe, if you can just name the top 3 recommendations from your side.
So among the large cap space, we like L&T. Within mid caps, we like HG Infra, PNC, and NCC are the stocks that we like. Reason being, not just they are sitting on good order book and leverage position, but also being diversified in nature. They are not dependent on any one particular segment to do well. They can get orders from multiple sectors. That's all.
All right. We'll leave it there, Ankita. Thanks very much for joining us, and we'll have you back soon again as we get past that election verdict. And I think infrastructure is going to be really top of the list where market expectations are concerned. But let's get back to the market and how we're set up. Anuj is standing by with exactly that. Anuj, morning.
Morning, Prashant. And you know what, I think this is GIFT Nifty is one of those days where perhaps not giving you the best indications. My sense is you could actually have a good 100-point gap up today. The market's got almost a double bonanza today. The RBI dividend, blockbuster dividend of 2.1 lakh crore, while the expectation was 1.05 lakh crore. I think you would have analyzed it threadbare, but this alone cuts the fiscal deficit by about 20 basis points. And I think the second big positive is crude prices. Look at where we are now at $81. I think that's another big positive for the market because, just a few days back, we were almost threatening to cross 90. So that's a big positive. Now, what does that mean in terms of the market levels to watch out for? Considering today is the weekly options expiry on the Nifty, the first resistance is 22,675 based on the options, and the bigger resistance is 22,795, the all-time high. The support comes in at 22,465 to 22,483, which is yesterday's low and also the options base, and the bigger support is 22,385, the 20-day exponential moving average. On the Bank Nifty, where we had that last hour move, the first support is 47,400 to 500, and then 47,200 to 47,300. On the upside, 48,100 to 48,200 is where you see the first resistance, and then 48,400 to 48,500. I leave you with the quote of the day, and today is Buddha Purnima, so currency markets are closed for that. But Gautam Buddha, of course, has a big influence on my life. I go a lot by Buddha's teachings, and one of the big teachings is each morning we are born again. What we do is what matters most.
Okay, live in the moment, right? Thanks a lot for that, Anuj. Very helpful there, both on the markets and some life lessons as well. Let's do one thing. Let's take a quick commercial break. On the other side of the break, we will talk to our technical experts, Kush Bora and Sudarshan Sukhani, for some technical trades. Stay tuned.
We're looking at a good traction in the year. The tire industry is expected to grow about 6 to 8% across the board. And so is the vehicle industry going to, particularly the passenger car, 6 to 8%. So that should give us a good traction. The truck industry, of course, is a little flattish and will be a little flat during the year. It may have quarter to quarter up and down, but in the end of the year, it will land up more or less flat. The OEM I'm talking. I'm not, replacement market is different story. Replacement market is moving all right. And so that is the growth forecast for the industry. We are looking at maintaining the growth momentum and trying to work on about 8 to 10% increase in our sales in the year for 25.
Okay, welcome back. There's 12 minutes to go for the pre-open session. The GIFT Nifty still indicating about a 30-odd point higher start. Kush Bora is with us, and so Sudarshan Sukhani, as we sort of run through technicals and levels and what you should do. Gentlemen, good morning. Good to have both of you here. Thanks very much. Kush, how are things set up? The positives are there and kind of sort of slowly piling in. Nothing very large, but incrementally, it's not bad. And once in a while, you get something positive. But the market here, of course, has been a little hesitant in taking all of that on board straight away, and that's understandable. What's the setup on indices before we get to stocks?
Hi, Prashant. First up, a very good morning. Well, I think this is exactly the kind of discussion we had a couple of days ago, perhaps even yesterday as well, that, the texture of the market is very clearly buy on dip. Any dip that you get towards those support levels of 22,500, 22,400 should be bought. Since the IPL is towards the business end, let's just take a few parallels from there. Nifty, like RR, continues to find ways and means to find form and just, bounce back, while Bank Nifty, despite a valiant effort, hasn't really been able to cross the line. I think that texture will continue. There is a short covering rally that we see due on the Bank Nifty. It's just a little difficult to time as to from where will it come, but we believe that 47,400 should act as a support zone, and perhaps we could see a short covering rally on the Bank Nifty, but I won't pay for that. I will continue to buy the dip on the Nifty.
Okay, all right, Kush, morning. And since you're talking about IPL, who do you expect to lift the cup?
Hi, Nigel. Let me try and answer that also in the stock market parlance. Like Sunil Narayan, I believe CDSL will continue to outperform, and 2200, 2250 will be the target, 2135 will be the stop loss. And perhaps like Venki Iyer, PGEL, PG Electroplast will also blast, and 2425, 2475 will be the targets, and 2330 will be the stop loss on this one. So there's your answer, okay. I suppose.
All right, so both these two we'll be tracking. PG Electroplast will have the management with us in the next 1 hour or so. But Kush, who will win the World Cup? Who will win the IPL? Not the World Cup, the IPL. Do you expect KKR to come out trumps, or do you think, yeah?
Both the players I mentioned are from KKR, so there was a slight hint for you there.
KKR, got it. All right. Well, let's get in Sudarshan. Sudarshan, how are you approaching trade today?
Good morning. The trade is the same. The markets are in an uptrend. So far as the Nifty proves it otherwise, we'll assume the uptrend continues. If that is so, then stay long and buy on dips. Now, intraday volatility will continue and persist. That's at least till the election results. So accept that every dip in the market due to volatility is a buying opportunity, not an exit opportunity. Now, the Bank Nifty has been underperforming, but that means nothing. It could easily catch up any time. So the trade is simply pay more attention to the Nifty, but also consider keeping the Bank Nifty in your long portfolio. Buy every dip.
Okay, buy every dip. What about individual stocks, Sudarshan? What are we looking at this morning?
Well, GMR Infra is a buying opportunity with a stop under 79. Granules is a buy with a stop under 397. That big boy Reliance is now coming out of a decent correction. That's a buy with a stop under 2800. And Sun Pharma, which has been underperforming some of the other pharma stocks, may catch up, buy with a stop under 1477. All buying.
Okay, all right. Thanks a lot for that, gentlemen. Well, for the time being, I think we can get in Chandan Taparia as well, derivative and technical analyst at Motilal Oswal, who joins us on the show. Hi, Chandan. Morning. What strategies that you have for us?
Good morning, Nigel. Thanks for having me. So we have seen sustained buying interest in the broader market, especially the Nifty headed towards 22,600 zone. Supports are gradually shifting higher, and we believe that till it holds above 22,400, this momentum could extend towards the new lifetime high and rally towards 23,000. Overall, we believe that 22,222 could act as a positional support, and this rally can even head towards 23,500 once the results are over. But as of now, we need to go with buy on decline with support of 22,400 for an upside move towards 22,795 and higher levels. Looking at the Bank Nifty index, that is slightly underperforming, but holding well to its rising trend line. It has to hold 47,500, then only we can see an up move towards 48,250. So more bullish on the Nifty, but only concern is the India VIX that is now hovering above 20 marks. So if volatility cools down below 1680, then only the smoother ride will be there. But as of now, as per the price pattern, we believe that momentum of the market could continue to hit towards the new lifetime high. Now, looking at the stock specific, first that is buy on Coal India. We have seen that the stock has been making higher top, higher bottom. Recently, it has given a consolidation breakout on the daily and the weekly chart. We have seen the put writing and the PCR of the stock has jumped higher. So expecting further rally towards 525, one can buy with support of 490 level. Second trading idea, that is buy on Oberoi Realty. We have positive on the selective realty counter, and Oberoi Realty has seen the open interest addition of around 35-36% in last couple of days. Major trend is positive. Technically, it has given a breakout from its pole and flag pattern. So expecting a rally towards 1850, one can buy with support of 1735. Last trading idea, that is buy on Auto Ancillaries, buy on Motherson Samvardhan. Here we have seen support of 50 DEMA. It has given a consolidation breakout. Major trend is positive. Built up of long position is clearly seen by 8 to 10%. So expecting a run up towards 141, one can buy with support of 129 in Motherson Samvardhan.
Okay, let's take a quick break on that note. Thanks a lot, Chandan. Have a good day. That's Motilal Oswal Financial Services with their views on the market. We'll come back after the break with the pre-opening rates. Also, we'll have Sonal Verma of Nomura and Samiran Chakraborty of Citi to discuss the RBI Bonanza dividend payout. Stay tuned.
We had first done a place with the IFCI, 240 crores and another 500 crores with the QIP this year. And the two together, our debt has come down substantially by nearly 18% during this year. Our net debt has come down by 18%, and our debt equity now stands as 0.85 to 1. So in fact, we are quite happy about our debt. And that is absolute number of debt is nearly 3,100 crores. So that's where we are, and we hope to maintain a better debt profile continually.
We are diverging to Bangkok, one.
Welcome back. We have about a few minutes before the pre-opening rates kick in and then about 15 minutes before the market opens for the day. Dipan Mehta is still with us. Dipan, you know, the big talking point, of course, globally is NVIDIA, right? And the kind of surge that it's seen post its numbers. But sitting here in India, how does one participate in this rally? I mean, there are many mutual funds that give you an exposure there. But what would your best advice be?
See, Sonia, the best way to play US tech and tech and overall US economy is the Indian software companies. Of course, I think this quarter numbers have been a bit disappointing. In a way, the quarter is a washout because more or less, I think results were flat to declining. But there is a ray of hope in the form of higher order book position, which means that once things start to improve over there, execution will immediately pick up on the Indian software company side. And that could lead to very good numbers, maybe December quarter, March quarter or so. And this entire AI and cloud, I think that's another going to be another structural spending increase for all Fortune 500 companies globally, and that's going to benefit Indian tech companies. And these are companies which have got great shareholder-friendly policies in terms of distribution of profits and great operating leverage businesses as well. And valuations are still reasonable for these companies. So if you get a few of the even large cap or mid cap software companies, I think that's the best way to play this technology surge and increase in tech spends globally.
Okay, all right. Dipan, I wanted your view on the insurance space. You know, HDFC Life, there's a Motilal Oswal note that's come in early this morning, and they're talking about HDFC Life. They've upgraded the stock to buy from neutral. They're saying that the stock is down 20% in the last 5 months, and the de-rating of stock has been steeper than expected. And the valuations they highlight at around 2.2 times, well, it's the lowest in January 2023. Any view on this one, HDFC Life?
See, Nigel, I think insurance has done very well in this quarter overall. But, you know, you look at LIC, and when I look at LIC, I don't feel like looking at any other insurance company. It's available at below its enterprise value. The way the stock prices have moved up, LIC's portfolio would have done exceptionally well. And a lot of the gains and increases in the enterprise value do come from portfolio gains. I think in terms of actual performance also, it is coming through pretty well. It's able to hold on to its market share. And valuations, I think, are very, very attractive. So, and PSU is the flavor of the season, has been so for the last 2-3 years. So from that point of view, I think LIC is the best bet in the insurance sector. A disclosure we and our clients are invested in, so our views could be biased.
All right. Dipan, you know, you may want to listen into the next discussion as well, and we'll come back to you in a bit. This is, of course, we're talking about the bonanza for the government of India from the Reserve Bank of India, which has announced a record 2.11 lakh crore surplus dividend for FY24. In a conversation with CNBC-TV18, the Finance Secretary, TV Somanathan, comments that RBI's dividend will prove to be beneficial for the government and will the government will, of course, pragmatically take future steps with regard to fiscal policy. Listen in.
Cash is a short-term thing. The revenue is important. Cash will fluctuate based on expectation. Cash is not something which can be managed, or I can't tell you how cash will be managed. But I can tell you that this dividend is good for the revenue of the government. It's good for the fiscal position of the government. It's always good. All revenue is welcome. We will only buy those bonds back which come at yields which we like. So it's not this is not like when we are trying to raise money. There is no failure of the buyback. We have put out a target amount. If it happens, it happens. If it doesn't happen, no, it's okay, no problem. If conditions are tight enough, people will take the buyback. If they're not taking the buyback, then conditions are probably not very tight. So, I mean, that's a matter for the other side to decide on how much they want to buy. It would be definitely 0.2, 0.3% higher than what we expected as receipts. 0.3% of GDP.
The number. Okay. Of the GDP.
Yeah. Is the delta.
So 0.3%, that's the Finance Secretary himself saying 0.3% of GDP is the extra sort of delta, he said, fiscal space which the government of India gets because of this bumper dividend. Sonal Verma is with us, Managing Director and Chief Economist, India and Asia, ex-Japan at Nomura Financial Advisory. We also have Samiran Chakrabarti, Chief Economist for India at Citi, who's with us. Sonal, Samiran, great to have both of you here. Thank you very much for your time. Samiran, if we can start by asking you, I mean, how do you read this? How will this, in your opinion, I mean, this is, of course, extra fiscal space which opens up. The question, though, is how will this be put to use? So your first thoughts, Samiran.
Good morning, Prashant. I guess this was
to us, somewhat expected. We were putting out in our notes saying that there is a possibility that the RBI dividend will be significantly higher than what the government has budgeted for. And so that way, it's not that big a surprise for us. Yes, it means that the government has three options in some sense. One is that it can reduce the fiscal deficit, 0.3% of GDP, as you mentioned. It can utilize this money for more fiscal expenditure, whether it is capex or any sort of populism. And the third one is that there are always unforeseen circumstances because of which some of the budget arithmetic can go wrong. This just provides an elbow room to the government to stay with that 5.1% number, adjusting for those unforeseen circumstances. Now, obviously, the question that we are getting is that is going to be more of expenditure versus more deficit cut. Look, in my view, this is a one-time thing that the government is getting. If it is spent on certain kinds of expenditure, which has more of a recurring nature, which next year you cannot withdraw, then it's difficult to do it on the expenditure side. Whereas if you do it on the deficit reduction side, this is also going to be a year where we'll be flooded with more demand from FPIs after the bond index inclusion. So both the supply will be lower and the demand will be higher, means that yields can collapse under those circumstances, making RBI's job more difficult. So it's a complex problem that the government will have to deal with, but it's also a problem of plenty. So I think every government will welcome this as well.
Okay, it's a problem of plenty, and every government will welcome this. So that's the moot point, right? It's positive for the government, for the bond market, etc. Sonal Verma is also joining into the conversation. Sonal, hi, good to speak to you after a while. So it's this tough decision between increasing spending on one hand or reducing the fiscal deficit, right? Which way do you think the government would head, and what are the overall implications of this announcement?
Yeah, it's a good problem to actually have. I think we are still too early in the year actually for the government to also take a call on what to do, because in terms of potential, more expenditure as the year progresses, for instance, the subsidy amounts could be much higher than what they've budgeted, because if you look at the revenue expenditure increase, the percentage increase in FY25 in the interim budget is not substantial, so that could be higher. And similarly, the disinvestment side, last many years, we've seen a disappointment. So that could be a bit of a negative on the fiscal finances. So we're still early in the year. Government has time. Our own sense is they might therefore do a mix of all. The budgeted amount on the RBI dividend specifically, we don't know, but our own estimate is the B amount is closer to 850 billion INR. So the 2.11 trillion in RBI dividend actually is around 1.3 trillion above the budget estimate. So that's closer to 0.4% of GDP. So it's a substantial fiscal bonanza that has come in. We think the government could therefore choose to reduce the deficit marginally when it presents the final budget in early July, which is what we're expecting, but also leave some cushion for any unexpected shifts that might happen on the revenue and the expenditure side. Outside of this, there will be implications on liquidity as government starts spending. This is more of a medium-term issue. And given the significant amount of RBI dividend, the extent of reserve money that the RBI needs to create through expansion of its domestic or foreign assets will be that much lesser. On the bond side, this is actually going to add to the cash surplus that the government is sitting on. This could very well go, above 5 trillion INR, and therefore some sort of a reduction in the borrowing, could happen. Again, the details of this are likely to get announced in the budget. And as Somiran was saying, it's really positive from a demand-supply environment. So our own forecast is that the 7-year as well as the 10-year bond yields could drop to 6.75%.
Wow. I mean, so more downside here. I mean, of course, today markets are shut. Otherwise, we would have perhaps seen some more reaction after yesterday's sharp fall. Samiran, the market did respond, right? Yields fell sharply. So, well, you said that, well, you were expecting it. The market liked what it saw. So, if you want to sort of comment quickly on that. So, and as Sonal is saying, that it does, make it easier for the government to meet its fiscal consolidation roadmap in that sense, but it also gives the opportunity for them to alter the budgeted receipts, expenditure, etc. On the on that front, on the second part, do you think we should start from and this is of course more in line with what markets are looking at, the infrastructure sort of thrust, roads and capex, etc. What about taxes? You know, the lower end of the economy has been hurting. Maybe something on personal taxation, lowering it a bit to boost that. I don't know if that's going too far, but Samiran, any thoughts?
So Prashant, on a lighter note, till the actual budget is announced, everyone will want to see what he or she wants to see. So on the bond market, people will want to see a lower fiscal deficit. So bond markets will react positively, thinking that the government will actually reduce the borrowing numbers. On equity market, if you are a holder of a capex play, then you would be wanting the government to do more of capex out of this and may react on it. If you think that actually by reducing taxes, you can stimulate consumption, which has been a bit weak in recent times, then you might think that that's the way the government is going to do. But to be honest, no one knows at this point of time exactly how the government is going to approach this, the new government. So I'm not going to venture a particular guess on exactly which way things will move. But one thing is very clear, that suddenly the budget will become more interesting than what we were thinking before. What the initial thought process was that the government will do only somewhat marginal tweak to the interim budget numbers, because the interim budget itself was quite detailed. Now, with this more than 1 lakh crore extra kitty, the budget maths will have to be reworked, and it will become very interesting, and the market will keep on speculating till it's actually announced.
Okay, well, something for the market to speculate, right? Thanks a lot to both of you, Samiran and Sonal, for joining us this morning and talking about the macro setup. But let's do one thing. We have the market, which is opening, the pre-opening that has kicked in. And a couple of stocks like Nykaa, Jubilant Foodworks, Metro Brands, all in focus after their numbers. So very quickly, let's get the stocks up on board. Nykaa is up 2.5%, Jubilant Food up 3.5%, and Metro Brands as well. Good earnings coming through. But let's go across to Sudarshan to find out what's the 9-10 call of the day. Sudarshan, over to you.
Consider buying Granules with a stop under 397.
Okay, and Ramco Cements is what you're looking at, Nigel?
Well, that's right. Ramco Cements, the big underperformer of the last 1 year or so. From the highs of around 1,100 rupees, the stock has corrected considerably, holding at around 780 rupees. And that's closer to around the 52-week low. Now, the reason that I said earlier this morning as well that I expect the stock to react positively is because those numbers are more or less in line. The top line was a little bit better because of higher volumes. And because of higher volumes, you had a top line beat. That beat on the top line came down to the EBITDA number. So though the margins are a little bit of a miss, the absolute EBITDA number is in line with what we are working with. So I take that positively. Remember, they're working on various cost efficiencies. Though the realizations were down by close to around 8% on a sequential basis, they focus on green power. That's helping them. It's up to the mid-30s. They're expecting it to go to around 40%. And that's why, in fact, things are looking up for them. Now, on the net debt front, they've reduced it by close to around 150 crores, which is a positive. That's something that the street will like. And in addition to that, the capex plan, earlier they were saying for the coming year, the capex plan is at around 1,700 crores. They've scaled it down to around 1,200 crores odd. Remember, they're on their way to becoming a 26 million ton unit. So with the capex plan being scaled down, I think in the near term, the street will like this. And given that the stock has bombed out, expect the stock to do well from here on, at least for today's trading session. Well, Mangalam joins us to tell us about the other big winner from the F&O stocks, Jubilant Foodworks. Mangalam, tell us more.
Well, the stock is higher in pre-open. That's because, the numbers were aided by the consolidation of the international business. The Indian business internals look good as well, despite, margins being near record lows as well. The revenue is coming in at 1331 crores, largely in line with the street expectations. EBITDA margins at 19.1%. Even if they're low, they're better than what the street was anticipating. The like-for-like growth has turned positive after 4 quarters, and in fact, one of the best that we've seen in the QSR space itself so far. Internals were pretty strong. Delivery channel actually grew 12% for the company in the fourth quarter, and the like-for-like in delivery was actually up by about 7.8%, telling you that, you know, dine-in is the problem and not delivery. Delivery is now at close to 68% of sales versus 63%. Who eats at a Domino's store inside anyway? They added 89 stores in India across all brands, and the new brands contributed about 1.4% to their sales. International business, for 2 months of the consolidation, the revenue addition was 217 crores. The EBITDA margins were close to around 26.5%. So that business, as it scales up, will only be margin accretive for the company. And they've guided for 180 new Domino's stores being added in India in FY25, 50 Popeye stores and 25 Hong's Kitchen stores as well. So all these are factors which are working for Jubilant Foodworks.
Actually, you're right. You know, Mangalam, I mean, the dine-in experience has been a bit compromised, right? Because the other day, actually, I passed by a Domino's outlet and there were only delivery boys sitting inside there waiting for the order to deliver. So I guess it's one again pitted against the other, but dine-in experience definitely compromised there. But thanks a lot for that. Vivek is joining in. Gland Pharma and Sun Pharma also on our radar. Vivek, over to you.
Well, good morning. Just stepping in for Ekta. Now, talking about Sun Pharma, last evening they had the call and, Ekta's collated the top highlights. Number one, FY25, the company is expecting high single-digit consolidated top-line growth. Now, the only concerning part is the company is not given any EBITDA margin guidance as far as FY25 is concerned. Now, along with that, they're expecting R&D spends to be almost 8 to 10% of the total sales. And in FY25, the company is also planning to launch the specialty drug for alopecia. Now, along with that, the company is saying they're also working towards GLP-1 drugs. Now, brokerages, expect FY25 to be slightly subdued as far as Sun Pharma is concerned. In fact, CLSA has downgraded the stock to an underperform rating. They're saying that downgrade is due to lack of limited upside and also lack of near-term triggers. Nomura as well as Jefferies too are expecting a subdued FY25. Now, coming to Gland Pharma, Goldman Sachs says that the management maintained their medium-term top-line guidance of mid-teen base biz growth. However, when you're talking about Cenexi, the CDMO arm, the revenues were down almost 18% sequentially, and the company has said that the China market progress is lower than expected. So expect some softness as far as Sun Pharma is concerned. Gland Pharma will be interesting to see given what the management committee has come in.
All right, Vivek, thanks very much for that. So Sun and Gland are the other two which are going to be in focus. Guys, we were talking about the NVIDIA numbers, right? So obviously tech benefits and all of that stuff. But I was just reading that maybe another area, and this is actually true, because AI takes so much power. So for example, ABB recently said that if you ask ChatGPT something, the power required for ChatGPT to throw up an answer is 10 times the power a Google search, a simple Google search takes. So if NVIDIA results show that the AI sort of boom is well and alive.
Power.
So power is a theme, which is, and that's where the big demand for, actually it's all related, right? Yeah. Copper, transformers.
Silver.
Silver. So, it's of course a second level kind of impact, but it nevertheless, I think, is a big reason why, the demand for some of these industrial metals is being talked about in such great sort of shape and form. The first rates will start to come up, and we'll kind of talk to Hiren Ved, who will be with us in just a bit from now. So the first rates and reactions to earnings like Sun, etc. Jubilant Foodworks, I think I saw an upgrade from Spark, which is of course I think Aventus now, on Jubilant Foodworks. No big increase in price target or anything, but I did see an upgrade. And a few others as well to begin the day. So the first rates are coming up with the Nifty and the Sensex absolutely flat, nothing. The Nifty's got about 15, I think we saw some red as well, but 10 points higher on the Nifty. The Sensex is up about 20, is down about 20 points. So it's kind of like a traffic light, blinking red and green, nothing at all. And you've got the mid-cap index, which is up about 0.5%, 230 points higher, 52,383. The small cap index will also come up. So I think the broader market, at least to begin the day, has got it much better. And I think we'll have to pick up from there. So, the broader market doing much better. The Nifty Bank is up 1/3%. Financials, banks, because of the big drop in yields. Sonal Verma of Nomura was saying that she's seeing the 10-year here dropping to about 6.75. So maybe further downside there. So banks are the other thing to watch. But on the Nifty, there's nothing. 10-point change. But it's all about stocks. Sonia's got those. Sonia.
Thanks a lot for that. So since the market is very quiet, right, I thought let's focus on individual stocks and the big moves that we're seeing. Nykaa is the one that, I want to kick off with. Almost a 3% rally on Nykaa now. Very good performance. Is revenue growth of 30%, EBITDA growth of 32%. So the street definitely likes that. Jubilant FoodWorks, we were talking about how Domino's has picked up pace. Its growth has turned positive for the first time in 4 quarters. Jubilant FoodWorks is now up almost 4.5%, has hit that 500 rupee mark. Metro Brands is the other one. Good set of earnings. The EBITDA is up almost about 10.5%. Margins have picked up substantially on Metro Brands, and the stock is factoring that in, 4.5% higher now on Metro Brands. Now, Sun Pharma is the other one from the frontliners that I'm looking at. Let's just get Sun Pharma on board. The reason the stock is under pressure is because the company has said that FY25, they expect high single-digit consolidated top-line growth. So there's only a single-digit growth that they're looking at on the top line in FY25, and hence the stock is coming in for some profit-taking. Gland Pharma is the other one. The Q4 results were below what the street was estimating. The India business, in fact, was revenues were down almost 19%, but the stock is tearing away right now, 7.5% higher on Gland Pharma. So there's definitely something that the street likes. Now, very interesting, a stock that has been a huge underperformer is HDFC Life. But this morning, Motilal Oswal has upgraded the stock to a buy. They have raised their target price to 700 rupees a share, which is a big upside to the current market price. Let's see how this one does, because it's been an underperformer for years now. So does it... it start to pick up? Time will tell. Zomato is the other one. Axis Capital has initiated a buy on the stock. They have a target price of 254, so I'm watching out for Zomato very closely. Gujarat Pipavav is the other one. Good operational performance this time. In fact, there's a big margin pickup for Gujarat Pipavav. EBITDA is up about 21% as well. Let's head to PG Electroplast. The revenues have gone up almost 27%. Margins have picked up year on year, so the street definitely likes what they're seeing on PG Electroplast. And Ramco Cements, Nigel was telling us about how the net debt has gone down by 100 crores for Ramco Cement. The Q4 numbers are largely, above street estimates, so the street likes that, 2% higher there. So that's the exhaustive list of stocks in focus. But let's get our focus back on the Nifty. Not too much happening, which is a good thing actually. The market has had a fair amount of rally, 650 points since the lows in May. So the Nifty is hanging tight above that 22,600 mark. Back to you.
Thanks a lot for that, Sonia. Garden Reach Shipbuilders, that's the stock of the morning, up close to around 13% as we speak. Massive uptick is what we're seeing on that name. So big move on Garden Reach. Another one that's moving well is Macrotech Developers, up close to around 5% as we speak. Solid up move is what we're seeing out there. I'm not sure what's the news flow, but that one as well, one of the top volume movers in today's trading session. Besides that, a few more stocks. HEG, their numbers were weak, multi-quarter low in terms of their margins. They've announced a demerger, though we'll have to understand in greater detail what's the reason for that. So that stock, in fact, is down close to 5.5%. In the next 20 minutes or so, we'll have the management on the channel as well. A few more losers. We have Azad Engineering. Well, that one was down close to around 4%. You have Esther Industries, that's down close to around 5%. Gandhar Oil, I think that's a new listing. That one as well down close to around 5%. So a few of these names should come up for you on the screen. And, overnight, you had some kind of nervousness whether or not the Fed will be able to go ahead and, cut rates in the coming year. And because of that, you have metals that are under pressure. Vedanta, Hindustan Copper, both of them are pulling back. Remember, they have seen a big up move, but both of them have pulled back considerably. And gold was under pressure overnight. So you have Manappuram as well. That's down close to around 1.5%. Remember, the metal stocks, not a pocket for the faint-hearted. You've seen on Hindustan Copper itself an 8% move from yesterday's high itself. So just keep that in mind. Structurally, things could look good. You could have a bit of a tailwind that's playing out. But, you want to trail, if you're trading them with some stop losses, is very important. Prashant.
All right. This is the definition of a flat start, right? 1 point, less than 1 point change, 22,600 or so is where you have the Nifty now opening at. Just a couple of more names. Look at Max Estates. It's starting 10% higher. I think there were numbers which came. Volumes are very low, so keep that in mind. What else? I mean, the shipbuilders are all, I think we mentioned a few, Cochin, Garden Reach, Mazgaon. It's never one. It always usually moves as a pack. And I think that is true today as well. Loda, which is Macrotech, is up 3. Jubilant Food, we mentioned 4. PG Electroplast, 5% that is. Tata Elxsi is up 4% this morning. So 74.99, 7,500. Star Health is up about 3%, 554. You got a couple of these banks. Hitachi, which sold off, that's Power India, is up about 2.5%. And I think you've got Ashoka Buildcon, which is starting with some gains as well. I'm spotting one or two of these PSU banks as well, Indian Overseas Bank, UCO Bank, which are also coming up with decent sized volumes for this point in the day right now. So, I mean, that's it. A lot of metals stocks, as Nigel mentioned, which are taking a bit of a knock. So underlying prices have been a little soft after the big run-up that we've seen fairly quickly. Let's get in Hiren Ved, who's joining us now. Hiren, of course, is Director and CIO at Alchemy Capital Management. Hiren, good morning. Great to have you with us here and good to see you here in our
Good morning,
studios.
Prashant.
What's top of mind, Hiren? Is it elections? Is it waiting for the verdict? Looking past
just
it?
let's get done with it, right?
How does one position for it, Hiren, if one can?
One doesn't position for, I mean, like, I know it's cheesy to say that, but I mean, if you're a long-term investor, you don't change
anything
positioning, based on events like that, because, I mean, frankly, while the overwhelming consensus is that there will be, stability and the same dispensation will come back. It's so usually long-term trends don't change so quickly based on an event, right? So we've seen that in so many elections in the past. People have kind of thought about, okay, will the leadership in the market change if there is a change in the political dispensation? Very difficult to say that. It didn't change in 2000, for example, in the bull market of 2003 to 2007. There was a abrupt change in 2004.
But the
leadership did not, the leadership amongst the sectors didn't really change. So I guess just stay with what you have.
Let me ask you this then: if you get, it's a big event in any case. I mean, you get what the market consensus is expecting, and we're pretty much at near record highs, 200 points away on the Nifty.
Yeah.
You get that big number, and all is well on the 4th. You think the market does? It kind of keeps going like it has, at the pace it has over the last 6-8 months, or you think a lot is in the price? So you think it starts something new?
Well, I think, I mean, obviously, if the results are what the market likes, then yes, you could have a big relief rally, so to speak. I think after a few days it will be back to kind of normal, right? And then there will be the anticipation for the budget. In terms of what happens. Well, there will be anticipation because they've talked about bold reforms. So people are, everybody is going to think. From my perspective, we will think about capital markets, what can come. Somebody else will think, what can come as a bold reform in the budget. But it'll be interesting to see. I think on the whole, in the run-up, if the results are as per the market's liking, then I think in the run-up to the budget, we should have a pretty decent market, I would say.
In so many years of tracking the markets and elections, I haven't seen a government who's so confident of coming back into power that, Prime Minister Modi did mention that post 4th of June, you're going to see the markets rally, right? So, of course, there is this level of confidence that's there for sure.
Yeah.
But if there is policy continuity, which I think the market wants and is focusing on, then what are the themes that you see over the next 1 year that people should bet on now?
So, Sonia, it's not 1 year as in fact, I did write and author an article on money control where I showed that how leadership is looking very similar to the 2003 to 2008 bull market, right?
Wow.
Where all your cyclical sectors, autos, auto components, hotels, real estate, capital goods, power, telecommunication. These were all sectors which were the lagging sectors of the previous bull market. And they are now all the leading sectors, right? So it's quite instructive if you look at financial year 23-24, or even if you take the last 24 months, and if you do a sector leadership, right? There are several NSE sector indices. The top performing sector is real estate. Then it is, I think, Nifty Defense. Then it is the PSU banks, then it is Nifty infrastructure. None of these, the top 5 or 6 best performing sectors, were the leaders of the pre-COVID bull market cycle. And then if you look at the bottom of the pyramid, it's Nifty FMCG, Nifty private banks, Nifty financial services, and they were all the leaders of the previous cycle. They are all the laggards of this cycle, right?
So is it fair
I
to
think that
assume
leadership has changed.
No, is it fair to assume that the laggards who have now become the leaders, as you said, right?
Yeah.
That is a space that will continue to grow?
I would think so. I would think so. See, even within that, there are always ebbs and flows, right? It's like in a boxing match, you know, even an opponent can sometimes win a round. That doesn't mean, right? So you may have a quarter or two where the FMCG guys, you know, will come back and stuff like that happens. But when you take a slightly longer term view, I think the leadership clearly is with the more infrastructure, capex, power, capital goods. I mean, that entire cohort of sectors, I think the leadership continues to be there.
All right. Hi, Ren. Good to see you in the studio. You know, as they have been saying, Hrithik hasn't danced as yet, you know, because all those Hrithik, you know, HDFC Bank and the likes, they haven't moved that much in comparison to what the gains that we've seen, say, in the real estate space. And as you were coming in, you know, we had a flash that was up for our viewers on the screen, where Godrej Properties have sold 600 flats in Noida for 2,000 crores. Hotcakes, you know, that sort of demand is what we're seeing. But Hiren, I want to talk about NVIDIA. You know, overnight, you've seen this big rally out there. And you woke up this morning to those brilliant results.
Yeah, I just saw the numbers while I was walking in.
Yeah, I mean, we wake up a little earlier. You know,
so what, is the stock up? Is the stock up?
2.5 trillion in terms of market capitalization.
By the way, you know, Nigel, I should tell you this, that Hiren and me are neighbors. So he wakes up at the same time as us. It's just that he works out while we are walking our way to the studio. So he's, you know, running or jogging on the road.
So what's the play here in the Indian markets? And I'm looking at some of these mid-cap IT names. Tata Elxsi, case in point, is up 4.5% as we speak. You know, the AI focus is definitely picking up steam. How would you play this theme?
So, Nigel, very difficult to, unlike in the US where there are direct AI plays, right? So I think if you really look at what's happening is that right now it's the companies which are building the GPUs and the servers, or what we call as the AI infrastructure layer is doing well, right? Okay. I think once that build out happens with a lag, you will find the AI applications starting to do well. I mean, every Indian software company is saying that I am AI ready with my workforce, right? TCS being right at the top, Persistent has been talking about it, a lot of them. But I think for that to be seen in the numbers and to move the needle, it's going to take a little bit of while, right? So I think at this point in time, it's all AI infrastructure. So the data centers, I mean, one way to play that in India would be to play the beneficiaries of the data center build out, right? Because that's the critical infrastructure that you require. And then the application software layer will come in.
Indeed.
And then, you know, how much is, it's like if you remember, when digital was a big thing, everybody used to say, okay, my digital is 14% of revenue. Then it went to 20% of revenue. Then it went to 30%. Now you don't know what is digital and what is not, right? So I guess AI will still, right now, very small percentage. Whether it moves the needle, very difficult to say.
You know, we had somebody saying something like a NetWeb. They make servers and that kind of stuff. So you got to look at very disaggregated kind of play.
Yeah, we own that with full disclaimer. But yeah, something like that, you know, there are always a few things here and there.
Yeah.
There is another very interesting company, but again, with full disclosure that we and our clients own. It is a company called Latent View.
Right.
Yeah. I mean, they do a lot of data analytics, AI work. So there are a few disparate players here, you know, smaller plays, but there's no direct AI play like you have in the US market.
Yeah. Another way perhaps is looking at it's maybe second level, third level, but power, because power consumption required is in the order of magnitudes for AI. I mean, and everything is, if most things are going to go that way, power consumption it goes through the roof, which means, I mean, you know, this entire T&D kind of space.
Yeah, that's already happening, right? I mean,
that also ties in with what you said, industrials and
exactly, because I think power was a utility sector. Now it's a growth sector, right? People used to buy power stocks for dividend yield.
Absolutely. You know, the other space, one name that I remember you liked is Jubilant FoodWorks.
Yes.
This is a few months ago, maybe when we had spoken. Results came, I saw an upgrade as well, I was mentioning earlier, from one of the brokers. You still like it? You still own it, Aaron?
We don't own it, Prashant. Our thinking was that, they had a tough period during COVID, right? And then we thought that there will be a pickup in consumption. But we haven't seen anything great happen for the last couple of years. Consumers have been downtrading. They haven't been going that often. And today, with platforms like Swiggy and Zomato, you have access to a far larger variety of, options that a customer has.
Yeah.
Earlier it was only Jubilant, and so on and so forth. And then inflation also took away, some of the pricing power from these guys. So maybe things are bottoming out there, right? And, things could incrementally improve from here. But I think the trends that we are seeing in the more premiumization or the premium consumption is far stronger than what we are seeing here, right? So I think this might take a little bit much longer to revive. Maybe we are seeing early green shoots, but nothing very dramatic.
Nothing significant. Okay. Another space, just before we let you go, I wanted to mention, a lot of these defense stocks are sitting at fresh highs this morning. So that's really the space to be. BEL, there is Garden Reach, there's Mazgaon Dock, there is Hindustan Aeronautics, Cochin Shipyard, that whole lot, right? BEML as well. And it's not just defense, but it's also India manufacturing for itself and for the world, right? That whole theme is picking up quite a bit. We saw it with Dixon Tech as well. In that space, any stocks that still stand out?
So we own, we do have an exposure to Dixon. We've been having it for a couple of years now. And
it's played out, you think?
I think they can grow multifold from here, right? I don't know if, I think it's very clear, the policy level is very clear that we want to reduce our dependence on imports very dramatically, right? And I think just a few weeks ago, I think I heard the EM Jaishankar talk about how we may not have geostrategic leverage if we continue to import $100 billion worth of stuff from China, right? And if you look at the top import items, it starts with electronics.
Yeah.
And I think this government has been very clear that you get to have the electronic manufacturing ecosystem in India. It's already happening. Apple is here. I think Google is also going to get stuff manufactured here. We're going to have all these laptops and tablets going to be manufactured here. So I think the runway for growth is still significant. And to your question on defense, I think, that continues to be a multi-year theme. Recently I met a small defense manufacturer based out of Indore. And we was just generally chatting. And he said that he's never experienced something like this. He said the Undersecretary of Defense called him and said, you guys are the 10th larger exporter of, defense products. And they make some shells for the ammunition and stuff like that. And they said, look, you've done X crores this year. Your target is X plus Y crores next year. Let us know what you need from us, what help you need from us. That razor sharp is the focus to get domestic manufacturing in defense and also to get exports get kicked off. So yes, all of this has done quite well. It's sometimes scary when you look at how the stock prices have moved.
Yes.
But that's exactly what happens, right? There is a doubling and a doubling and a doubling. Obviously, you need to have a long-term view. And, this is not a recommendation, but I think we are still not done with it.
Okay, still not done with it. That's going to stay with me, that despite the rally we've seen in names like Dixon Tech, there could be still lots more to go. Thanks a lot, Hiren, for joining in.
Thank you. Thanks so much for having me.
Okay, well, for the market, right, it's not bad. To be honest, the mid-cap index is really flying off the shelf now, 260 points higher. The Bank Nifty is supporting the market today. So after a big rally we've seen in the last few days, the up move continues. We have some news flow which could be negative for Lupin and Cipla though, as there is a competitor for albuterol sulfate. Vivek has the details for us. Vivek, over to you.
Well, good morning. Lupin is under pressure today. Now, what's actually happened overnight is that one US-based pharma company has received approval, and this is for an important drug that both Lupin and Cipla have as far as the US market is concerned. So, US-based Amphastar Pharmaceuticals has received the US FDA nod for albuterol sulfate inhalation aerosol. Now, remember, this is quite a big drug. In fact, according to IQVIA, the US sales for this particular drug, both the generic as well as the branded, combined was approximately $1.7 billion. Now, what actually happens is that this is a negative read-through for both Lupin as well as Cipla. Both of them get a significant portion of the US-based revenue from this particular product itself. Now, what actually analysts are saying is that the new player entering, number one, could mean that there could be loss of market share. Number two, they also expect price erosion. They're expecting price erosion anywhere in the range of 10 to 25%. On the back of that, they are expecting some pressure both on Lupin as well as Cipla. Lupin more, given the fact that it has a lot more similarity to this particular approval.
Got it. Thanks a lot for that. So that's the reason why Lupin and Cipla are under pressure. But let's focus on Petronet LNG now. The company saw its highest ever volume throughput for Q4, but their top line and profits took a hit while the margins also contracted sequentially. To discuss in detail how the year may shape up, FY25, that is, Akshay Kumar Singh, the MD and CEO of Petronet LNG, joins us now. Mr. Singh, thanks a lot for joining in. Good morning. For the full year, the overall volumes in FY24 saw a growth of 22%. Can you tell us whether you expect this kind of volume up move in FY25 as well? And what would be the volume triggers for the fiscal?
Good morning. I would like to first express my sincere and heartfelt gratitude to the CNBC team for inviting me to share my perspective on the LNG and gas market and also the company perspective. Definitely, if you see that last year, the overall volume growth of the natural gas in the country was around 17%. And in financial year 22-23, the volume was around 160 MMSCMD across the country, domestic and the LNG. But in 23-24, it has risen to 188 MMSCMD. And even the LNG volume has increased about 17 to 18% import. But Petronet volume has increased by almost 22%. And the main reason is that our Dahej LNG terminal, which is situated and connected with the national gas grid, and it has a very large evacuation capacity, unlike the other terminal. We have an evacuation capacity of almost 35 MMTPA, whereas the installed capacity is 17.5 MMTPA. So we have been able to utilize the Dahej terminal to almost its fullest capacity during the last financial year, and it is continuing in this financial year also. The basic reason for this increase is the economic growth in our country and also the urbanizations.
Mr. Singh? Yes, we know the reasons. I just wanted some forward-looking numbers in FY25. What kind of growth can you see? And now that you have this, you're setting up this LNG terminal at the Gopalpur ports as well. Can you tell me what is the planned capacity there? When will it come on stream?
Yeah, in fact, if you see that the Dahej terminal is also being expanded from 17.5 million ton to 22.5 million ton. And the target is to complete this expansion by this financial year end. So it will give a huge capacity utilization boost to the Dahej terminal. Apart from that, the Kochi terminal, which is of 5 million ton capacity, is only being utilized for 1 million ton at around 20 to 22% capacity. And we expect that once the Bangalore connectivity is completed, which is expected to be by the year end, maybe by November and December this year itself, then our Kochi terminal will be connected to national gas grid, and we can substantially improve the capacity utilization of our Kochi terminal, which is only operating at 20 to 22%. The Gopalpur terminal is a greenfield project, and it will take almost 3 years' time to complete. So it will be the strategic East Coast terminal being set up by Petronet LNG. And after commissioning of Gopalpur terminal, we will be able to cover the entire country from the multi-directional south, east, and west, and will be able to serve the consumer across the country. So that will give a strategic advantage to the Petronet consumers, where we can also offer a lot of flexibility to the consumers at the different part of the country.
Got it. Right. Mr. Singh, good morning. Prashant here. I'll come back to, and that's very helpful, the details across the three terminals that you've provided. And I have a few questions there. But just to get a few things for the fourth quarter out of the way, could you tell us what was the amount of inventory losses that you booked on account of the fall in gas prices, sir?
107. It was around 107 crores for the Q4.
107?
107 crore.
Sorry, you were saying? You wanted to add something there, sir?
107 crore.
Okay, no, got that. I got that number. The other thing is, what you're providing for, right, against receivables of about nearly 1,300 crores, you had said that you had provided about 450 odd crores. This is, with regards to historical take or pay revenue. And you've provided once again in the quarter. How will this sort of go forward? I mean, will you continue to provide at this steady rate over the next many quarters as well? What is the, are you confident of sort of recovering all of this by when? Anything you can tell us there?
Yes. What has happened that during the COVID and Ukraine-Russia war in financial year 21-22, 22-23, and in fact 23-24, there had been some default from our off-takers, and we have already worked out the settlement mechanism to recover this money. And as per that settlement mechanism, whatever the default were there for the year 21-22 has to be recouped by these consumers by the December 2024. And they have provided already the bank guarantee against this use or pay charges. And if they don't utilize the shortfall volume by the December 2024, we have a bank guarantee to recover that money. Similar way for the 22-23 volumes, whatever default to the tune of 848 crores, we have allowed them to bring the default volume by December 2025. And against that, they have already given the full bank guarantee of 848 crores. And if they are unable to bring these additional volume over and above their booked capacity, we will be encashing the bank guarantee and recovering our dues. So this is a positive things which has happened in recent past, where we have secured our full this use or pay charges from all our off-takers. And this was done as a one-off measure because there was a huge problem in the country during the COVID period, and also due to Ukraine and Russia, where the LNG prices skyrocketed and consumer affordability was not there in India to consume those volumes. So now the situation is improving, and a lot of volumes are flowing in the country, and we are quite hopeful that this situation will be addressed satisfactorily in the coming months and coming year.
Okay, so you should be able to recover most of this over the next 1 year. That's what you're saying.
Yeah. By December 2025, all the use or paid dues will be settled, which was defaulted in 21 and 22.
Okay, got it. Mr. Singh, just two other points. Going back to the terminals that you were talking about, by when is this Kochi-Bangalore connectivity going to happen? That is one, because you said once that happens, the full capacity utilization will come on stream. It's operating at about a quarter of its capacity right now. And second, with Kochi, is there a tariff revision which is expected, and by when?
As you know, that from Kochi to Mangalore connectivity has already been completed, and we have been able to serve the Mangalore consumers by completion of that. But only a small sections between Coimbatore and Krishnagiri, that is around 250 kilometers, is left over. GAIL is laying this pipeline, and they have already mobilized two contractors and divided the entire 250 kilometers in two sections. And this project is also being monitored at the highest level of government. That is, it is in the Pragati it has come, where the Honorable Prime Minister reviewed these projects. And there the commitment is given that by November 2024, this pipeline section will be completed. We are very closely following up, watching the progress of this completions, and we are quite hopeful that 1 month, 2 months here and there delay, this section will be completed. And once it is completed, we will be connecting to the national gas grid. And we expect that this 20% volume utilizations, capacity utilizations of Kochi will substantially improve. Maybe gradually 60, 70, 80, 90, and it can go to 100% also because there is a demand of gas across the country.
Sir,
what about the tariff revision, sir?
I think as on today, there is no tariff revision, and it was already done 2 to 3 years back. We worked out reworked out the tariff, and there is no proposal for any tariff revision of Kochi right now. But if the capacity is substantially improved, we can look into the future.
Okay, so no tariff revision at the moment at Kochi, got it. What is the outlook as far as the EBITDA per MMBTU is concerned for FY25? It's somewhere around 57 at the moment, but going forward in FY25, what is the view?
I think our tariff at the Dahej is around 62.91 for MMBTU, which is the lowest tariff across the country between all the LNG terminals. And going forward, there is a already long-term contract where there is an increase of 5% every year, and the Kochi tariff is around 89 rupees per MMBTU right now.
Okay. All right. We will let you go on that note. Thank you so much for joining in. Let's slip into a quick break. The market is doing fine, more than fine actually. Building on to its gains now, 85 points higher. We are very close to an all-time high on the Nifty, by the way. We're like 1% away, I think, from, or about 120 points away from that all-time high. So just keep an eye out on that. Remember, 22,794 was the all-time high level, and we're just about 100 points away from it. Looking pretty good for the market, building on to our gains. When we come back, we'll connect with HEG's Executive Director, Manish Gulati, and Chief Strategy Officer, Puneet Anand, to discuss their Q4 numbers. Stay tuned.
Welcome back. Well, this is Corporate Trader and you're watching CNBC-TV18. Well, let's focus on HEG now. The margins that did come in came in at its lowest levels we've seen all the way since March 2021 quarter. They also announced the demerger of the graphite business into a separate entity. To help us out with what went on in the past quarter and the rationale for this demerger, we have Mr. Puneet Anand, the Chief Strategy Officer, who's joining in now to tell us about the strategy with regard to this demerger. And then later on, we'll be joined by Mr. Manish Gulati, who will help us out with the operational performance. Hi, Puneet. Good morning, and thanks a lot for joining in. Well, the markets are wondering about this demerger. You know, 95% of your revenues come in from the graphite electrodes business. So why this demerger? So give us a few details. How do you see this HEG green tech business ramping up? What is the current revenues? And say in the next 3 years, where do you see these revenues going? And as of now, is it EBITDA positive, this entity that you're looking to carve out, HEG Green Tech?
Hi, good morning, Nigel. So the objective of this entire restructuring is to actually unlock the shareholder value. Since today, graphite business is EBITDA positive, and the remaining demerged business which we are doing is also EBITDA positive. It comprises of TACC Limited, which is our anode company coming on the commercial production next year. Plus, we hold 49% in Bhilwara Energy Limited, in which we are doing the merger. The objective is to, because both of these companies today have different growth trajectories, different kind of investors. We want to actually unlock the value for the minority shareholders and make it more as a value as a whole in the two pies.
Okay, okay, Puneet, we got that. We have gone through the presentation. We got the entire working. And clearly, the promoter entity is expecting better times for this entity. That's a green tech entity, because their holding is going up to 70%. You need to keep an eye out on that as well. But what's the outlook from here on? If you can give me some numbers, Puneet. In the next few years, obviously, you've got that that lithium ion play as well that will be there in that entity. That's the HEG Green Tech. So what could revenues look like in that entity?
So I'll explain you. In this HEG Green Tech, it comprises of TACC Limited, plus our hydro assets, plus our energy storage solutions. Our hydro asset gives 150 crores of profits every year. It's a cash profit. We are expecting in our energy solution business, the EBITDA margins and the turnover will be substantially growing in next few years. Last year, we have had a turnover of 20 crores. We are expecting approximately 500 crores of turnover in our energy storage solution system business. In TACC, the production will start from the next year, FY26, and we believe there will be an addition to the EBITDA of 150 crores from the starting. And when the capacity utilization will go till 75%, the EBITDA will be approximately 350 crores from that. So you can expect there could be 1,000 crores of EBITDA coming from this green tech company in next 2-3 years.
Got it. That's the number that we're looking for then. So you're giving us a guidance in the next 2 to 3 years. HEG Green Tech can have a potential EBITDA of around 1,000 crores. We'll hold you to that number. Let's go across to Manish then, since he's joining in. Manish, what's happening? The margin is not improving at all. So give us a couple of details. Do you believe that the graphite prices, now electrode prices, have bottomed out? And what does it mean in terms of margins? We're down to the lowest levels we've seen since March 2021.
Yeah. Hi, Nigel. As you have seen, the margins continue to be under pressure. And I have said in the last interview also that it's still inching down. And the needle coke prices are also coming down with a lag. So that is why the margin is under pressure and it's likely to remain so for next 2 more quarters, it seems. But there's going to be light at the end of the tunnel. You see, all our peer group, industry analysts, big companies, big analysts like BCGs and SMSs are all talking about a number that it's going to grow up. The graphite electrode demand is going to grow up by 200,000 tons by 2030. And we have expanded, we are ready with our 20,000 tons. So we don't see a problem. So there's going to be light at the end of the tunnel. As you have seen, the steel production has been down for the last 2 years. Even if we...
Manish, let's leave the bigger story out, because we have heard that 2 lakh tons of additional demand by 2030. And we have heard about this green push as well, the shift from BF to EAF, which will be good for you. Let's get some numbers only about HEG and give me a few numbers. One is, what should the volume growth be? Because you have 20,000 tons that's come on board. So what is the volume that you did in the past year, that's FY24? And on that base, what kind of a growth can you look at? And what is the margin guidance as well? It's still in single digit. When do you see it scale up, say to around 15-20%? Just 2 numbers.
Okay, understood. So for the last, since we declared the expansion in November 23, it's only the last quarter of Jan to March that we got this capacity. So on that capacity, our total utilization was in excess of 80, between 80 and 85. Going forward for 24-25, we expect to be around 75% of the new capacity of 100,000 tons. So that's the guidance on that. And we'll try hard. The market continues to be bad. We expect 2 more quarters of these low margins. And we expect that, after 2 quarters, it should start improving upwards because people have made their corrections. There's no inventory in the system. So at the moment the steel production picks up, it'll be very fast. About the margins, you have already seen. It's still, I believe in the next 2 quarters, you'll see similar margin. And then I expect it to improve.
So improved to what level? And going by that 75% utilization level of 1 lakh tons, so that will be around 75,000 tons for the coming year, right?
Yeah, we aspire to do that.
What you did in the past year? Around what was the average?
That was between 80 and 85, exactly somewhere in between of the, we just
whole capacity.
Of the whole capacity.
So so last year you did roughly around 68,000 tons, and this year you're saying you'll do around 75,000 tons. Is that a fair estimate?
Fair estimate.
And these numbers improve this margin improvement in the second half of the year. Should it improve to mid-teens? Do you think that's a fair estimate?
I can go wrong by maximum 1 quarter. So if it is not the second half, maybe towards the last quarter, Jan to March.
What will it be, but in the last quarter? It goes back to 15, 20%, 20, 25%. What is it?
It'll only take a while. I mean, it can happen in the Q4 or the Q1 of next year. We're just standing at the edge of that. The prices, I don't think they've bottomed out. You will still see our prices going down next quarter also, but that is only because of a lag of that. So, but I think I don't think there's any room left for further price reduction.
Okay, just finally, got it. Final question, Manish and Puneet, then what is the total cash in the books right now? And in this demerged entity, how does the balance sheet look at both of them? Because as of now, you're a net cash company, even post that expansion. So what is the consolidated number and how does it get split up? How do both the balance sheets look?
So, Nigel, please. So, Nigel, we are sitting with 1,000 crore of cash, of which roughly 700 crores will be utilized for this TACC business, which will be deployed in next 6 to 8 months. Remaining cash in way of investments will be with HEG graphite business. It will be going into demerged entity.
Okay, so 1,000 crores total, 700 crores goes into this green tech business and 300 crores will be with HEG. Got that correct?
Yes. Yeah, approximately correct.
Okay, well, gentlemen, thanks a lot for joining in and speaking to us. By the way, for the market, just wanted to mention that it's really a good-looking screen. So, a lot of stocks are picking up pace. Interglobe Aviation, by the way, is now above the 4,400 mark. So, big moves have been coming into that stock. It's up 50% this year already. We're not even halfway through the year. And something like a BEL is up 2.5%. Mazgaon Dock, Macrotech Developers surging now 4.5% higher. But let's connect with the management of Team Services. For Q4, the company witnessed a steady top-line growth while the specialized staffing slowed down in Q4 after a double-digit growth in Q3. Ramani Dati, the CFO of Team Services, joins us now to talk about that. Ramani, thanks a lot for joining in. Appreciate your time here. You've had a steady revenue growth of 20% on the top line. Do you think this run rate is something that will be maintained in FY25? And what are the growth triggers for the company now?
Definitely. The 20% top-line growth for us is largely driven by the general staffing business. And there, the hiring momentum is very positive across segments like FMCG, FMCD, e-commerce, telecom, manufacturing now. So there, comfortably will be doing upwards of 20% growth on volume, headcount addition, as well as gross revenue. Where we are seeing headwinds is still in IT staffing. We are not seeing any recovery, indication of any sort of recovery at this stage in IT services. So that may continue to impact on profits, but on top line, since the contribution from IT staffing is minimal, that may not impact the 20% that we are confident of.
Okay, so you're saying that specialized staffing, so IT staffing is under pressure, but general staffing is still picking up. I know it may be hard for you to call a recovery in IT staffing, but can you see IT hiring pick up either in the second half of the year, in the first half? Any indications of a timeline?
That's, as of now, it's just a hope statement because, as I mentioned, at this stage, we are not seeing any indication. But again, it looks like second half of 2025, there can be a pickup in IT services. GCCs and non-tech companies are still hiring. So to that extent, we are able to maintain the run rate of our revenue in specialized staffing business. But in terms of net growth, we need the pickup of hiring in IT services, which drives the maximum volume of IT hiring.
So if IT, okay, by the way, that's the Go-Digit IPO listing that's happened. Decent listing there, 4.5% higher. So we'll talk about that in a bit. Go-Digit General Insurance IPO listing happening. That's the latest one on Dalal Street. But we'll talk about that. Ramani, since IT, there is no clarity on when things may pick up. Do you think that could put pressure on your margins? Because even in this quarter, right, there was that wage hike impact, and perhaps that may get extended into Q1 as well. Do you think, given the slowdown in specialized staffing, further margin pressure is likely?
That's right, because for us, specialized staffing is the highest margin contributor. And while with staffing growth, we are driving productivity and operating leverage. In terms of overall group level margin expansion, we really need the specialized staffing contribution to pick up. And again, on top of that, NEEM withdrawal scheme in our apprenticeship program has impacted profits to the tune of about 20 crore spread over multiple quarters. However, Q1 is the last leg with which we'll be fully done with the release of NEEM trainees. And hopefully from Q2 onwards, we can see consistent improvement in the margins overall.
Okay, so when you say consistent improvement in the margins, I mean, it's still at sub 2% margins. Any thoughts on what the band could be once the improvement begins?
We are targeting 5 to 10 basis points quarter on quarter. But if the IT hiring picks up, it can get further accelerated.
Okay. And in generalized staffing, you're saying that has picked up. But any election-related impact that you see, how is Q1 and Q2 expected to pan out?
Very marginal impact on, especially in tier 2, tier 3 places. But cities and metros, we haven't seen any impact. Even in the past also, during election season, we didn't see any material impact as such in the overall hirings. Only here and there few pockets. But that's not material enough to impact the growth rates at scale.
Okay. Finally, just before we let you go, you have, what is the outlook on different sectors? I mean, what is the expectation on staffing in the metros versus what you're seeing in rural? Have you seen any kind of pickup geography-wise? Anything that you can share with us?
Yeah. In terms of overall hiring for us, metros and tier 1 cities are always the largest contributor. And a good part is from last few quarters, we are seeing good momentum in tier 2, tier 3 places as well, especially with industries like BFSI and manufacturing. So we are seeing good new open positions getting opened up, especially at the entry level jobs, the fresher level and entry level jobs. So we are seeing in small cities and towns as well, new formal jobs getting created. So that's a very positive sign. And even otherwise, for the verticals like FMCG, FMCD, there is an increased drive for formalization. So some of the jobs that we have added during the year, especially over the last 5-6 quarters, are not new jobs, but these are more of consolidation and also the shift of jobs from informal to formal. So we believe the trend will continue into FY25 as well, and not just in FMCG, FMCD. Across other verticals, we are seeing this preference for more formalization of jobs, which is good for companies like us, organized players, as well as for the overall employees.
Okay. And finally, the headcount addition for FY24 was around 13%. What's the expectation for FY25?
Yeah. Within staffing, it's actually 20%, but that got offset with the headcount loss we had in NEEM program. Net of that, it came to about 13-14%. But since we'll be fully done with the NEEM loss in Q1 of FY25, even on headcount growth, we believe for FY25, we can maintain upwards of 20% growth.
Okay, Ramani, thanks a lot for joining in. That is Team Lease Services talking about how general staffing is picking up, but specialized staffing like IT is still under pressure. We'll take a quick break. Up next, Vikas Gupta of PG Electroplast will join in to talk about their Q4 earnings. Stay tuned.
Iranian President 63-year-old Ibrahim Raisi has died in a helicopter crash. Raisi, along with Iran's Foreign Minister Hossein Amir Abdollahian.
Welcome back. You're with us here on Bazaar. Markets, of course, are doing much better. Flattish kind of start, but it's been a gradual up move. I mean, as gradual as it can be, because we're just in the first hour of trading. Things have picked up quite a bit, which we'll address with specific stocks, etc., as we go along. Now, one big area which has done extremely well is this entire electronic manufacturing services, the EMS space, and stocks, of course, have really done very, very well. Varied kind of performance, but, on the top of the list, you've got names like Dixon. You also have names like PG Electroplast. Actually, we're going to talk about PG Electroplast because they also reported numbers and they put out some very aggressive growth guidance numbers for FY25 as well. Vikas Gupta is Managing Director, Operations at PG Electroplast. He's joining us now to take us through some of that. Vikas, good morning. Good to have you with us here. Thank you very much for your time. Prashant this side. So you're guiding for sort of revenues of at least 3,400 crores, right? This is after separating the TV revenues into a separate 50-50 joint venture. Could you start there when you say at least? I mean, is it a very conservative number? What can you really do if one were to move to the other, a more aggressive kind of number here? At best, what can you do from at least?
Yeah, good morning, Prashant. So right now, the numbers that we have put out as a guidance of around 3,400 crores, we'll stick to that. We'll not like to go beyond that. We are seeing a very robust growth in all our product businesses, like air conditioners, washing machines. And we are surprised with the kind of growth that we are seeing in our AC business in the first quarter of the current financial year is almost getting over. And we are seeing a very robust growth in our AC business. Similarly, in washing machine business as well, we have been seeing a very strong traction. We have onboarded a couple of new clients, and we are further expanding our capacities in our washing machine business also. So we are very confident that at least we should be reaching the numbers of around 3,400 crores, even after hiving off our TV business into a JV company.
And that is, if you do 3,400 crores, that's about 24% growth over FY24. Now, on margins, you've expanded margins in 24 over 23, gone up to 10%. And you say that in 25, margins will have a slight upward bias. Could you, again, quantify that, put some numbers to it?
So we have already given a specific guidance of around profitability of around 200 crores. And EBITDA guidance we have not talked about this time. So we are talking about a PAT of around 200 crores on the revenue of around 3,400 crores. So there is a jump in the net profit margin on that. That is based on the kind of economies of scale that we are seeing in our AC business, in our washing machine business, and it is based on the lot of capital efficiency and other cost control measures that has been undertaken at our end.
What is the current sort of capacity expansion? Where are you expanding capacity? Could you give us a sense? And what's the total?
So we have given a guidance. Yeah. So we have given a guidance of capex of around 370 to 380 crores for the current financial year, which is a very aggressive capex guidance that we are given. That is basically primarily to further expand our capacities in our AC business as well as in washing machine business. We'll be putting over 2 new greenfield plants in northern India, one for AC and one for washing machine, and we are further going to expand our capacities in our plant in Supa in Maharashtra for AC. So based on that, we are feeling that we are positioning ourselves to harness all the growth opportunities which we see coming in near time.
Okay, all right. Hi, Vikas. Good morning and good to see you. And the bulls on the street believes, why does PG Electroplast not get a valuation like Dixon? It's already trading at elevated numbers, but going by the numbers you've seen, the bulls on the street are quite happy. Let's get a couple of numbers out of the way. On the products part of your business, we've got the absolute number, but split it up for us. The RAC business, last year you did around 1,320 crores. On that sort of a base, what kind of growth can you do? And also the washing machine business, it grew by 20% last year. On that base, what does the number head to? So I want the further split down of RAC and washing machine. Please go ahead.
And so in RAC, we are planning and we are targeting a growth of almost around 30% again in our RAC business for the current financial year. And in washing machine, we are targeting a growth of almost around 40% in our washing machine business for the FY 2025.
Okay, all right. And just to understand this washing machine business, the margins are relatively better. And how is the competitive intensity in washing machine? Because you're sounding very, very optimistic. You're talking about a 30% growth on a 20% growth. So tell us more.
So I'm talking about 40% growth, not 30% growth on washing machine.
40% growth in washing machine. Okay. And how is the competitive intensity out there, sir? And are the margins better on washing machine?
So margins are better in washing machine business, and the asset turns are also better in the washing machine business as compared to air conditioners. But overall revenue is smaller because the average selling price of the washing machine is way lower as compared to the air conditioners. So the competitive intensity is definitely tougher, but we are positioned. We have already aligned a lot of clients, and we have launched a lot of new product platforms in our washing machine business, which are giving a lot of traction for us in addition of business.
40% growth in the washing machine business is what you're looking at. Mr. Gupta, good morning. Just a couple of questions on your balance sheet. Will all of this growth come at the cost of higher debt? I mean, you're sitting on debt of about 325 crores. You think you'll have to take on more debt to fund CAPEX?
No. So please understand, Sonia, we are having a cash balance of almost around 180 crores. We'll be utilizing that, and plus we will be funding the capex through mostly by internal accruals. We might take a small debt of around 25-30 crores. That's it, not beyond that.
And the capex would be what, about 380 to 400 crores per annum? Is that what you're looking at?
So 370 crores for the current financial year.
Okay, and how much of that will be invested in new platforms? In the R&D for some of the new platforms?
So basically that will be largely going to further build our capacities and capabilities in our AC and washing machine business. As I told, we'll be putting up 2 new greenfield plants in northern India, one for AC manufacturing and one for washing machines. And we'll be further investing in the new product platform along with the investment in the plant capacity. So we'll be launching new platforms both in ACs and washing machines.
Okay, all right. Final question before we let you go. You mentioned in your release that you're looking at margins expanding. Could you quantify by how much could it expand if you compare it with FY24? And also, is there an export opportunity that's knocking on the doors? Because in the next few years, that could be another revenue opportunity that turns up. Tell us more on both these 2 parameters, margins and exports.
So margin expansion should improve by almost around 100 basis points or like that. So maybe I don't know the exact number that we have given, but we are expecting a reasonable improvement in our margin profile. Regarding the exports, definitely we are exploring that opportunity, but still there are certain cost disabilities for us, which we need to overcome. And I think going forward, as the economy of scale starts kicking in and we start getting a lot of component ecosystem developed in India, so we should be more competitive in the export markets. Going down, maybe 2-3 years down the line, we should be able to do it. We have already started some small steps on that. We have started taking some small steps on that. And we are confident in the next 1 or 2 years, we should be targeting some revenue from the exports, etc.
All right, we'll leave it there. So around 10% last year, so about 11% approximately. I mean, margins is what you're saying you'll do in FY25. Because we'll leave it there. Thank you very much. Good growth guidance across the board. And hope to speak with you mid-quarter again. So that's the management of PG Electroplast. Stocks up, flying away. Strong start, and it's holding on to gains. I think it's even built on some more gains there. 75 on the Nifty as well. 22,673. It was a slow start for the Nifty, but now, of course, looking very, very strong. We'll shift focus to the commodity markets. Manisha is standing by with what is top of mind. There was a bit of profit taking across industrial metals. Is that continuing, Manisha?
It definitely is, yes. Most of the metals have opened the Asian markets on a weaker side. Actually, started with New York session yesterday after we saw the US Fed minutes come in, where there is not enough push for the rate cuts given the current inflation background is the statement that we saw coming in from that meeting, and that has weighed onto the market. What it also has done is that it has strengthened the US dollar index, which is always not well for the dollar-denominated commodities. So if you look at the gold prices, we've come off the all-time highs, 1.7% of a decline overnight. Silver prices fell nearly 3% as well. But the deepest of cut clearly came in for copper. Remember, we were trading at an all-time high for this one, nearly 4.5% of a cut overnight. But the copper prices still are around 28 to 30% higher in 2024 so far. I want to talk about copper some more because here we've seen prices fall almost up to 4.9 from an all-time high of 5.2, which also was a level that the copper prices made within this week itself. Now, the near-term demand in China clearly has been on the weaker side. We've been talking about that. The run-up always was speculative, thinking that a long-term or a medium-term demand is something that perhaps will not be able to meet. So when you look at the LME copper prices, we've seen all-time high of 11,104 onto that. Currently, we are trading below $11,000 a ton onto that one as well. Now, when you look at the supply concerns, markets are looking at a longer term onto that one. If you look at the China inventories, those also have surged to nearly 4-year highs, and that's weighing onto the Shanghai copper prices also right now. More interestingly, there are a lot of short squeezes that we saw when it happened on COMEX or CME for that matter. But there are reports that nearly 100,000 tons of copper is en route right now to CME exchanges to ensure that all the short positions that were done, bearish positions that were done, the delivery for that is coming into the markets. And that is what has also led some premium of those prices. Also, when you look at the COMEX positions itself, the speculative net long stands at 72,000 contracts, which is 0.8 million tons. Now, this is speculative net longs. When you look at the producer net shorts, well, that clearly is a longer number of almost 1.04 million tons. That also is a mismatch that the markets are right now digesting within there. When you look at the Chile and various other producers, well, we are looking at 20,000 tons from Chile as well, which is en route to US by the end of May. And there are larger shipments actually which are in pipeline for the month of June and July. So copper clearly looking at all of this copper moving around the markets, and that is what has led to some profit taking. This is a statement that has come in from International Copper Study Group, which says that copper will end this year and the next in surplus as well. There is that much material that really seems to be coming in from warehouses for the market. So the run-up that we've seen in many of these metal prices, perhaps we've seen the high for a very, very near term. This is what we've done in matter of last 24 hours, really, in sense of prices. Now, this is a high that most of these metals have made it in this week itself or for the month of May. But currently, when you look at the prices, we've come off those kind of prices. All-time high for gold was 2,450. We're trading at 2,370. Silver as well, $2 has been shaved off. And that's exactly what we have seen for other metals. So whether it's zinc, aluminum, nickel, we're off the kind of highs that we made for 2024.
Okay, thanks a lot for that. So big moves coming into the commodity space, and also, by the way, in the markets. A lot of stocks are moving around. So on the other side of the break, we'll be joined by the management of Arvind Fashions to discuss their Q4 earnings and the outlook for FY25. Stay with us.
Azerbaijan Governor Malik Rehmati, East Azerbaijan Imam of Friday Prayers Mohammad Ali Hashim, and security officials were on board a Bell 212 helicopter which crashed in the mountainous terrain of northwest Iran. The accident took place 30 minutes after President Raisi's chopper took off after the inauguration ceremony of Kiz Kalasi Dam on the Iran-Azerbaijan border. He was often referred to as the Butcher of Tehran by activists for being one of the 4 judges who oversaw mass executions of thousands of political prisoners in 1988 after the Iran-Iraq war. According to human rights organizations, around 2,800 to 5,000 people were executed in this period. Raisi was a conservative hardline cleric who came to power in August 2021 after several candidates were disqualified from the election. Raisi's tenure was marked by an aggressive crackdown on women-led protests after the killing of 22-year-old Mahsa Amini. His government enforced a strict women's dress code and also increased uranium enrichment levels after US withdrew from the nuclear deal. Most recently, Iranian forces had carried out a retaliatory drone attack on Israel after 2 senior Iranian generals were killed by Israel in an attack on an Iranian consulate in Damascus. So what happens next? Iran's Vice President Mohammad Moghbar will now take over as the interim president. Moghbar is known for close ties to Iran's supreme leader, Ayatollah Khamenei.
Well, as promised, we have Arvind Fashions, the management joining us now. Q4 was a good growth in profits because of lower discounting along with higher contribution from the retail channel. Their EBITDA margin improved and they have added 24 new stores in Q4. Kulin Lalbhai, the Vice Chairman and Non-Executive Director of Arvind Fashions, is with us. Kulin, hi, good morning. It's been a while since we've spoken to you, so good to see you on the channel. I want to ask you about what the market has looked like, because overall the commentary that we've had from you is that the market has been subdued for the past couple of quarters. Consumer buying patterns have changed a bit. But how is it looking like right now? For FY25, do you see any kind of conclusive recovery in demand?
Yes, so, the last few quarters, in fact, have remained subdued for our industry, post-Diwali. The market hasn't seen too much exuberance. Within that construct, I think, one should de-average it. I think there is a good sort of momentum for the premium side of the market. Our two brands, Tommy Hilfiger and Calvin Klein, which are our bridge to luxury brands, have done exceedingly well. In fact, they've possibly done the highest level of growth in both top line and bottom line last year. So there are parts of the market really performing very well. The belly of the market, is where we've seen a little bit of sluggishness in demand. We do hope that as the year moves on in FY25, we do expect some of that demand to come back, and perhaps as we move along, we will see an improved momentum.
Okay, you'll see an improved momentum. What do you mean when you talk about improved momentum? Because, I'm just going through your power brand segment, right? Just going through it one by one. There was barely a single-digit growth on the top line this time, as well as in FY24, 5% growth is what you saw. Do you hope to get to double-digit in FY25?
Yes, so in FY24, I'll just point out, especially in Q4, most of our channels grew at double digits. The reason why the overall growth came to a single-digit growth is that in one of our channels, which is the department store, we had a little bit of destocking happening. So it's more of a phasing between Q4 and Q1. But the underlying growth is very much closer to double digits in Q4. In the full year FY24, again, there was a channel where we had a little bit of a pivot which is our online channel. We have moved from a B2B wholesale model more to a direct retail model in online, which had a little bit of a one-time impact on our growth. But if we look at the company today, I'm very confident of the growth drivers we have in place. The coming year is going to see strong square footage addition, much higher square footage addition than we had in FY24. We've got a lot of exciting retail formats which we are now rolling out across the country. Our adjacencies, which is footwear, innerwear, kidswear, and we've launched women's wear recently. All of them are clocking very high levels of growth. So I am confident that FY25 will see a much higher level of growth than what we had in FY24.
Got that. Karan, hi, morning. Prashant here. So for the adjacent portfolio, you also sort of guiding that this will expand to a much larger share of your overall business, right?
Yes, it's around 15% today. It's been growing at more than 20% for us. So with that kind of trajectory, we are expecting it to become 20% of the business, in the near term. So it is at a much higher level of growth today.
And here, are you kind of sort of what are you most excited about? Is it the kids wear segment?
So we are excited about quite a few, but the one I'd like to call out a lot is our footwear business. I think, footwear is seeing a structural shift where a business that used to be largely formal, which was the leather black and browns, is moving to a completely fashion sneaker, territory. And our company's core competency has been the casual lifestyle. And we achieved that pivot in the apparel side of the business. And, we are very excited that with this structural shift and our portfolio of brands, we want to replicate something very similar in the footwear side. So, we've got now a 300 crore footwear business, which is scaling up very fast. And we are excited about the potential of that business.
And this is in terms of price point, where is this at, the footwear business?
It kind of mirrors our apparel strategy, which is that our sweet spot is to go after middle India. our largest brand, US Polo, is now a 2,000 crore brand. It's the largest in its category. And the footwear part of that business is seeing huge potential. So I think the middle India is where a lot of consumption growth is going to come. And that's where we will see a large part of this business as well.
Okay. So any more insights that you can give us into what's happening? Because, the sense that we get from a lot of players we speak to is that tier 2, tier 3 cities are picking up now quite a bit, even in the premium and luxury spaces. Is that a sense that you're getting as well, that this K-shaped recovery that everyone's talking about, premiumization, is not only in metros, but also in like tier 2, tier 3, slightly semi-urban areas?
Yeah, so, if you take a step back, what is happening in the apparel business is that there are two types of, movements happening. One is that customers are going to pay more for differentiated products and aspirational products. On the other side, there is the value side where, sharp price points with a lot of efficiency also doing well. So it's the middle that kind of will come under pressure. So if there are brands which are constantly innovating, constantly creating differentiation, creating aspiration, that will keep, those brands relatively in a much better position. So as a company, what we've done the last year is we've really focused on energizing our core brands. We've invested much higher in marketing. We've had 100 bips increase in marketing spend. So we have improved our bottom line by 150 basis points, even after investing 100 basis points more in marketing. We've really upgraded our retail experience, and we're constantly premiumizing product because we believe the brands that will really focus on differentiated aspirational experiences are going to win in this sort of market. And that's what we are doing across our portfolio. And I think if you look at both tier 1 and tier 2, as a matter of fact, even tier 3, there are enough consumers who are wanting these differentiated aspirational products. And I think that's the arc that we are driving towards in our company.
All right. And you're saying that ad spends will remain around the same 4% of sales level, right? In FY25 as well. You're seeing and of course, overall, you're expecting a 12 to 15% growth in revenues for the full year. Kulan, great conversation. Thank you very much. Good luck to you and your team. And appreciate you joining in here on CNBC TV18. Well, that's Arvind Fashions there. Market is up 100 points, so in 3 digits, 22,700. So we're not very far away now. I think the earlier high was 22,794 or so. So, it's basically 0.5% away from where we are at this point in time. Lots and lots of stocks are, of course, moving. Market breadth, I must say, it's not completely one-sided. You got about 1,250 stocks higher and about 1,100 stocks which are lower. So it's very evenly matched still, although the frontline indices are doing well. We take a break. It's a wrap on this edition of Bazaar. Chartbusters will pick up on the action in just a bit.
Will be president till elections are held within 50 days. President Raisi was expected to succeed Iran's supreme leader Ayatollah Khamenei. Now, after Raisi's death, Khamenei's son Mojtaba is seen as a top contender to replace the supreme leader of Iran. But one thing is for sure, and that is Iran will see a period of political turmoil and internal power struggle. However, one thing is for sure, and that is Iran's politics, their view on international affairs, the war in Gaza and approach to Israel is not going to change. India, which recently renewed the 10-year-old Chabahar port agreement with Iran, will be watching developments very closely. Iran is the third largest oil producer in OPEC and produces 3 million barrels of oil per day, or 3% of global output. A formal inquiry will now take place to investigate the cause of crash, which is being attributed to bad weather at present. Several world leaders, including Prime Minister Modi, have condoled the death of the Iranian president and foreign minister, and they have said they stand by Iran in this hour of crisis. According to reports, Israel has denied any role in this crash, and experts say at this juncture, any foreign interference looks unlikely, as it would also amount to an act of war against Iran.
Sun Pharma falls after the fourth quarter revenue misses estimates. Management guides for just high single-digit consolidated top-line growth and refrains from giving EBITDA guidance, as a result of which the street dislikes that. The stock a top Nifty loser today.
Jubilant Food, well, it surged and now it's back to the flat line. The India business comes in line with expectations and the net profit is boosted by an exceptional gain of around 170 crores.
Gland Pharma gains over 6% following their fourth quarter earnings. The management maintains medium-term top-line guidance of mid-teen growth in the base business.
In other earnings reactions, Ramco Cements, well, it's higher in trade. The higher volumes aid the profitability. The margins, well, they remain under pressure, but the street takes heart from the fact that debt is reduced by around 100 crores and they've pulled back on their capex plan as well.
Nykaa trades higher after the company saw good performance in the fourth quarter. Margin improves and the revenue also rises by about 28% on a year-on-year basis. We've seen Metro Brands too report its fourth quarter numbers. The company saw a revenue growth of about 7% and a big rise in the net profit led by tax credit versus a tax expense.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangala Malu, and the street is bracing for fresh all-time highs. Well, the markets have moved to the high point of the day. The Nifty Bank, that's come back. It's come back in style, and the crucial point to note is that the Nifty Bank is back over the 20 DMA. Well, Mangalam, things looking up. You know, our producer and director will just pull up that chart, you know, of the 20 and the 50 DMA. Yesterday we flirted with the 50 DMA, managed to end above that. And now, in fact, we're holding above the 20 DMA. So the Nifty Bank, that's been a bit of an underperformer for the last week or so. That's come back into action, finding its form up 550 points. And at some point of time, we'll get that graph that I'm talking about with the 50 as well as the 20 DMA. Mangalam.
Absolutely, Nigel. You know, we found support at the 50-day moving average for the Nifty Bank, and that's led the Nifty higher by almost 100 points this morning as well. So straight off the bat, a century for the Nifty, now just about less than 100 points away from a fresh all-time high on that index. We've rallied almost 800 points, 900 points from the recent lows that we saw as well. That's the Nifty 200 and 50-day moving average. This is the Nifty Bank that Nigel was talking about. Took support at the 50-day moving average, now above the 20-day moving average as well. And there is, some juice for the Nifty Bank as well, because if you look at the FII data yesterday, there was selling in the Nifty Bank as against the Nifty. So they bought about 600 crores in Nifty futures and sold about 1,000 odd crores in Nifty Bank futures. So if that moves further, could there be a case for some more short covering is something that we'll be watching out for. Of course, today we have the Nifty weekly options expiry play out as well. But how should you trade this market right now? And are we bracing ourselves for all-time highs? Sachidanand Duttekar joins in for a quick technical check on the market. Good morning, Sachi.
Good morning, Mangalam. Good morning, Nigel. Clearly, I think the Nifty has been trending very confidently above its 5-day exponential moving average. The support right now is placed at somewhere close to around 22,560. So unless we don't see a swing below that, we expect this particular trend strength and momentum to continue. And probably in a day or so, we may see Nifty scaling above that life high zone. If you look at the combination, I think after almost a week, we have the Nifty IT as well as the Nifty Bank leading from the front, and I think this is a good combination, at least from even from today's perspective. When it comes to Nifty Bank, I think the support which was reconfirmed yesterday has been elevated to around 47,900, 48,000. So probably we may see this particular base, getting carried forward, and we may see Nifty Bank witnessing further short covering once it starts trending above 48,450 kind of a zone. So we are anticipating that this particular momentum in the Nifty Bank may stretch towards 48,800, and that's why we are recommending building long positions here. On every decline towards 48,400, 48,350, would be an ideal zone wherein longs can be accumulated. From a trading perspective, one can keep a stop loss at around 48,220.
Okay, and you want to give us some individual trading ideas as well?
Good morning, Nigel. Yes, HDFC Bank, after a long time has been, trending confidently above its 5 and 20 exponential moving average. Now, if you look at the support at 1450, it was revisited yesterday, and it led the pullback rally in the Nifty and Nifty Bank as well. So we are expecting that this particular momentum would continue in today's session. From a trading perspective, we are looking at a price target of somewhere close to around 1488. But positionally, I feel that the stock may again rebound towards its 200-day exponential moving average, which is placed somewhere close to around 1500. And that's why we are recommending building long positions here. One can keep a trailing stop loss somewhere close to around 1458, and fresh long positions can be added in HDFC Bank. The other stock which has shown signs of a reversal is Infosys. Now, if you look at the overall structure, the stock was struggling for the last 4 months. Now, after almost 4 months, it is trending confidently above its 5 and 20 exponential moving average. Today, we have already seen a positive crossover in there. So we are anticipating that this particular momentum may stretch eventually towards 1505 when it comes to Infosys as well. We may see a swing towards its 200-day exponential moving average, and that's why keeping positions intact, we may see a trending move towards 1500. The stop loss for the same could be placed somewhere close to around 1440.
All right, take that point, Sachi. Thank you so much for joining in. Speaking about momentum, a couple of these telecom stocks also are finding their feet once again. So Bharti Airtel has now moved to the high point of trade. A decent recovery from the lows, was in the red at some point and now has moved higher with a gain of almost 1.5%. Vodafone Idea as well saw some bit of a decline in yesterday's trading session. Thereafter, there was an up move, and that up move continues today as well, closer to 3% higher on Vodafone Idea, near that 14 rupees mark. Take a short break, come back on the other side. We have Chirag Parekh, who's the Chairman and Managing Director of Carousel, joining in to discuss their quarter gone by. Stay tuned. Welcome back. As we speak, the mid-cap index is actually now turned into the red. So that is something that we need to keep an eye out on. Even the advanced decline chart, that should come up for you on the screen right now. The decliners are a little more than the advancers right now, just mildly so. Even that is split right down the middle. A couple of these stocks which are selling off from the highs. We've seen Chambal Fertilizers at the low point. Lupin is now down 7% as we speak. There you have it, both those lines have kissed each other. Vedanta is the other one, which is down around 4.5%. A big decline coming by in just this hour itself. So we'll just keep an eye out on this as we move forward. The Nifty is still holding up with a gain of about 90 odd points. At a time like this, good to get in some management, speak about the results that came by, and more importantly, the year, how it looks going forward as well. Carousel is the stock that we're talking about. On the back of its fourth quarter numbers, the company saw good business pick up in the fourth quarter with a 30% revenue growth, and as a result of which managed to meet the lower end of their FY24 guidance of 15 to 20% revenue growth as well. Chirag Parekh, who's the Chairman and Managing Director of the company, joins us now to discuss this further. Thanks a lot, Chirag, for joining in. A 30% growth is what you posted in the fourth quarter, as a result of which 15% growth for the full year. I remember the last time we spoke, you said that, the 1,000 crore revenue target that you have has been brought forward from FY26 to FY25. So just wanted to know if that's still on the cards. What's your target for FY25?
Yeah, so first, thanks for having the show. So we are still maintaining our guidance of 1,000 crores. We are seeing a lot of inorganic opportunities. That's one. We also, secondly, we also seeing a lot of traction gaining back into our business. We see signs of the recovery from major markets like US, UK, and Europe, except Germany. new forward plans to expand our B2C brand in the US market, taking the United Granite as our platform. I think we are quite confident. I don't think so we would chase 1,000 crore. I think at the same time, it really depends upon the opportunities they get. On worst scenario, get just delayed by a quarter or two. I think we are confident on even a worst scenario. We are very confident that we will still able to do the 1,000 crore run rate in probably quarter, 1 or 2 quarters later. But I think we are still confident. Yeah.
All right, Chirag. So the bottom line is you're confident of getting to the 1,000 crore mark in FY25 itself. But you briefly mentioned there's an inorganic opportunity as well. So give us a few details then. If this inorganic opportunity doesn't fructify, then what will the revenue number look like? And if it does, then it will be around 1,000 crores, I'm guessing. And also tell us about the margin outlook. You were hinting last time we chatted that it could start moving to around 20%. Does that happen in this year? I'm asking you that because your gross margin expansion has been phenomenal. Please go ahead.
Yeah, so if in organic opportunities, we are carefully seeing it. I think the only thing, like I said, is going to be delayed, then we may hit
Chirag,
the run
just a
rate
request. We request you to hold on. Our team will just repatch the connection with you. I think we found you on a very scratchy line. It's important that you are, maintaining your target of 1,000 crore revenue run rate in FY25 itself. Give or take a couple of quarters. If, you do maintain that, your quarterly run rate in the fourth quarter was close to around 190 odd crores. For you to maintain that by the third or fourth quarter, you should reach that revenue run rate of close to 250 crores per year itself. We would want a considered comment on the inorganic opportunity and margins, as Nigel just pointed out. We just try to repatch that connection with you so that we can get you on a clearer line. And in an otherwise wobbly sort of market, if you just pull up the intraday chart of Carousel India, you'll see a little bit of a spike on account of the management commentary of maintaining their 1,000 crore revenue run rate. This even as FY24 annual revenues were close to around 630 odd crores. Okay, so I believe we have him back on the phone.
All right. No, I think we not yet got him, Mangalam, but we'll have to understand, how much of that, because they had an acquisition as well. I recall, I think we had a chat with them, United Granite. So how much will that contribute? I think roughly they were talking about around 850 crores, 80 crores coming in from United Granite. So I guess the inorganic opportunity could be that 50, 80 crores. We're still waiting for clarity on that front. And in the last quarter, what looked very, very good for them was their mix, because their mix improved. That's why the gross margins moved up to around 59% or thereabouts. I think what we'll do is, let's do one thing. Let's slip into a short break. We'll come back. We'll continue to focus on markets and we'll try to reconnect with them. All right. We have Chirag, who's back with us on the phone line. So let's get some clarity on that. Chirag, we had you in a bit of a scratchy line. So the clarity we were asking you for was that 1,000 crores includes the inorganic opportunity, right? And what could the revenue contribution that you're factoring in from this inorganic opportunity? The rough math that I'm doing is your current business does around 850 crores. United Granite does approximately 80 crores odd. So this inorganic opportunity could give revenues of around 60, 80 crores. Tell us more.
Yeah, so I think, we are still maintaining our growth levels to grow at this on the year 25, about 20%. We kind of roughly close at close to 700 crores. That take us to about 850 crores for FY25. So you're looking at a opportunity for us in organic about 150, some odd 150 crores.
All right. And this 840 crores, 850 crores that you're talking about, that includes the United Granite acquisition as well?
Yes.
So that's around 70, 80 crores is what you're factoring in from there?
Yes.
So inorganic growth opportunity will be around 150 crores of revenue contribution this year. We've got that. So with and without the inorganic growth, we've got the number. What about margins? Gross margins moved up, to the high 50s, which was good. But not everything came down to the EBITDA margins. What guidance could you give us on the EBITDA margin front?
No, I think we are very happy on the gross margin side. Couple of factors here, Nigel. One is we had a great product mix. We also have seen the foreign exchanges working in our favor. Third, we have seen a big increase in the U.S. market, which have better gross margins. We also seen the rise in the IKEA business, which is again a very high gross margin product. We have also launched a lot of new initiatives in the Indian market with higher gross margin. So we are basically targeting on the premium market in India. So I think with all these factors and at the operations side, the high level of efficiency, we have done some lot of R&D and we were able to bring down a lot of material costs. Now, why this margins we're looking at 19%, even with the Red Sea crisis, we're able to achieve this. So I think when this Red Sea crisis, eventually is going to go, and with all the initiatives, yes, I think I will still, we do see a better margin expansion moving forward.
All right, so 19% for FY25 is what you're guiding for. You spoke about India business briefly. Now, that was supposed to be a growth driver for you. In FY24, 132 crores turned into just 140 crores. And this as against your earlier estimates of 30-40% growth out there. What are you factoring in for the India business in FY25? And what sort of margins here are you working with?
Yeah, see, it's not a surprise to anyone that the Indian markets are soft. I think the way we have started ourselves that we need to enter the segment which can give better margins. Second is we have identified the growth in the growth spaces, and we are launching new products which we are targeting the premium and the luxury segment of the market. So while the volume-led growth may not happen, but we will be compensating by value. So we would be targeting the year 25 with premium products. Second, we would be launching a lot of new products. And third is we are building a lot of high-end experience and galleries.
So how much would that overall account for? What sort of growth are you factoring in? And as you do that, because you're selling premium products in India, what sort of margins are you factoring in?
I would really honestly not know, but like I said, the margin, there is a possibility of the margin expansion moving forward in the company. So and the Indian market, we have targeted 15 to 20% growth for the FY25 for the India.
Okay, 15 to 20% growth for India business. You know, the other point that the street wants to understand is you've taken a resolution, enabling resolution for a fundraise. So that 150 crores, I think so. Does that take place in the first half of the year? Is it a story of the second half of the year? And this fundraise is for the inorganic growth. Just want some clarity. How will you do it? Will it be a preference issue? Will you come out with the QIP? What is it?
So we have just taken an enabling resolution, Nigel, for the QIP. It's only for the QIP. We are very flexible. So whenever we see that when the opportunity arises at the right time, we will able to push that button. But we would be using the funds for our organic growth, mostly for our organic growth, which we have new plans. Like we are just started with the Howdens in UK. We are also, last time I said, we are probably in a very advanced talks with some major retailers across, mostly in the US. So we may have to expand our capacity more than million things. Then we would have to invest in a very, very short time. And for that, we will need funds.
So this 150 crores so the 150 crores, Chirag, you're telling us is mostly for the organic growth. Is that correct?
Yes.
And your debt, your last recorded debt is around 300 crores. So put everything together, you could raise around 150 crores via the QIP route. You could be looking at a potential acquisition as well. And plus, you're looking at raising capacity. Where does the debt number move from this 300 crore mark?
No, so I think I said in the next 3 to 5 years of the company, we want to drive the revenue to 2,000 crores in the next 5 years' time, and for that we are trying to now. We just trying to build our base now. So with the QIP coming in, I think our debt level ratios also our ratios will be at a good level. So even if you have to raise debt, to expand ourselves for even in organic growth, I think that gives us a lot of space for us to
All right. Thank you, Chirag, for joining in. Unfortunately, we had you on a scratchy line, but some of the key takeaways that we got, you will reach 1,000 crore revenue in FY25, if not the revenue, at least the revenue run rate by the second half of this year. 150 crore comes in from inorganic with margins around that 19% mark, 15 to 20% growth in the domestic business, and also looking at a long-term 5-year target of 2,000 crores on the top line. The street likes that. The stock, which has already seen a bit of a run-up, continues to hold in the green. We'll take a short break, come back. On the other side, we'll get you more on the markets and a lot of stocks.
Artificial intelligence, that's the buzzword echoing across the world, and companies only expect to see explosive growth in the sector over the next 10 years. So where does India stand today, and what has been the rate of adoption? EY is addressing exactly that question in its latest report. India's legacy businesses are treading with caution, but startups and global capability centers are taking the lead in AI deployment. An online analysis of the publicly disclosed adoption of AI and Gen AI by India's top 50 most valued Indian unicorns shows that 66% are already using AI or Gen AI technology. This indicates that startups have been more proactive in terms of adopting AI technology versus your legacy players. Now, let's take a look at some of the most implemented Gen AI use cases among India Inc. 1/3 of them use Gen AI to execute point tasks using intelligent assistants, while 25% relate to marketing automation. In fact, this quarter has also seen a diversification in investments going into firms using Gen AI or AI applications. However, the report highlighted that hallucination of LLM or large language model responses, data privacy and sovereignty, and the cost implications of deploying Gen AI in production are the top issues. Meanwhile, another report by TCS lists out the same concerns with generative AI, but delves deeper into the kind of impact artificial intelligence can have on the economy. The report, which interviewed over 1,300 CEOs, looked at the potential of AI for business and how it compared with the past disruptive techs like internet and smartphone. While 54% believe the impact would be greater or equal to the internet, 59% say that it would be greater or equal to smartphones. The study also...
Welcome back. You're tuned in to Chartbusters here on CNBC TV18. Well, Upasana joins us to tell us about the stock of the morning, Garden Reach. Upasana, the numbers look very good.
Strong set of numbers reported by the company, revenue and PAT reaching new highs. Now coming to company's Q4 performance, the revenue has seen a growth of 69% on a year-on-year basis. Margins have expanded sharply from 3.4% to 8.9%, and PAT stood at 112 crores versus 55 crores on a Y&Y basis. Now coming to company's yearly performance on FY24 basis, the revenue has seen a growth of 40% and margins have expanded sharply, that is 70 basis points, and stood at 6.5%. Now, company says that it is confident of growth in coming years that is backed by the strong order book that the company is witnessing, and it has also highlighted that the ongoing projects are at a maximum revenue recognition phase. More orders are also in the anvil in the upcoming years, is what the company has said. So, all in all, we are seeing a strong set of numbers coming in from GRSC.
Take that point, Upasana. Thanks a lot for that. Let's also focus on both Nykaa as well as Metro Brands. Nykaa is off highs this morning. The company reported a good performance, which the street was factoring in already because of the fourth quarter update that they'd given us. 28% jump in their revenues turned into 32% jump in their EBITDA. The net profit, of course, on a low base of 2 crores turned into 9 crores. So that's a big multiple jump that we've seen there. Internal details told you that the overall GMV grew at around 32%, led by beauty and personal care, which is the mainstay of the company, a 30% growth out there, led by fashion also, which is up 27%, and others, which includes the smaller parts of their business, fast-growing parts of their business. Nykaa Man, the men's grooming business, as well as B2B business, grew a lot more. But if you look at the contribution margins, while there was improvement in both fashion as well as the others vertical, others was, loss-making, has become less loss-making. There was a contraction in the beauty business, and that is the key to track, the impact of competition on the beauty and personal care margins, which is why maybe the stock is off the highs. Metro Brands, on the other hand, in an otherwise tough environment, portrayed 7% sort of revenue growth with a 10% growth in the EBITDA. They've taken all the tax benefit available with the accumulated losses that they have in the FILA business, and as a result of which there was a tax credit of 50 crores versus an expense of 26 crores, and that's boosted the bottom line of the company as well. They have a target of 225 stores to open in FY25 and FY26 over the next 2 years, with e-commerce sales in the fourth quarter doing extremely well as well. FILA EBITDA losses continue to contract at around 11 crore in the fourth quarter. Let's see when that grows, and restarting the FILA business would be a big kicker for them, along with the Foot Locker stores that they open.
All right, Mangalam, thanks a lot for that. Well, a couple of stocks in the broader markets that we're looking at as well. Indian Metals, which is IMFA, the stock was down close to around 2%. The next few quarters should be good. The street seems to be sensing that. I'm unsure about how quarter 4 will pan out. But ferrochrome prices have spiked up, so that's recovered from the low point of the day. Time Technoplast as well, that's another one that comes out of the set of numbers. So some of these cash market stocks are moving higher and moving higher on decent volumes as well. So just highlighting a couple of these names. Well, we'll wrap up on this edition of Chartbuster. Stay with us. Trading Hour comes up next.
Of those interviewed expect AI to have no impact on the number of jobs created, while 47% expect more roles to be eliminated than created. Finally, a report by Microsoft and LinkedIn found that an overwhelming 92% of those surveyed were already using artificial intelligence at work versus the global average of just 75%. The survey, which included 31,000 people across 31 countries, also found that 91% of Indian leaders believe they need to adopt AI to stay competitive. However, 54% worry that their organization lacks a clear plan and vision for AI implementation. Despite this, employees are eagerly embracing AI tools, with 72% of Indian AI users bringing their own AI tools to work. 75% of Indian leaders stated that they wouldn't hire someone lacking AI skills, outpacing the global average of 66%. The report, aptly titled "AI at Work is Here, Now Comes the Hard Part," it says that AI is transforming the world of work, reshaping talent landscape, and nudging both individuals and organizations to embrace change.
So the big question that we are asking is the worst over for the chemical sector? Is the worst behind? Now, there has been few brokerage reports in the last few days where they've turned a bit bullish on the chemical sector. But if you look at the management commentary post quarter 4, most of the managements do believe, and they have a mixed feedback, and they expect the recovery to be in the second half of FY25. And even when there is a recovery, it's going to be volume-led and not price action. So the margins could still be under pressure even in the second half of FY25. That's a management commentary. But look at the chemical as a space. There has been short-term pain for the chemical sector stocks, but over a longer-term period, they've been massive wealth creators. The next table will show you what I'm saying. Over the last 2 years, most of the chemical stocks have been under pressure. Aarti is down 12%, Atul is down 28%, Navin Fluorine is down 14%, and so is Vinati down 12%. But over a 10-year period, they've been massive wealth creators. Same is with UPL. The stock is down 35% in the last 2 years, but it's gained 15%. But there has been some notable winners as well in the last 2 years. PI Industries has been the best performing chemical stock over the 2-year period, up 54%, despite the fact that it's been a 30% CAGR over the last 10 years. Deepak is up 25%. Again, that's a big wealth creator. So is Tata Chemicals, and SRF marginally up in the last 2 years, but there's been a big recovery over a 10-year period. But look at the valuations now. The 1-year picture, 1-year forward earnings will show off for you. SRF is trading at close to 37 times. PI is trading at close to 30 times. UPL is trading at close to 19 times versus 5-year average of just 12.5 times. Deepak is at 32 times. And so is Tata Chemical trading at close to 27 times on 1-year forward. Even if you look at the other names like Aarti, Atul, Navin and Vinati, all are trading between 35 to 45 times on a 1-year forward. So earnings-wise, so in terms of valuations, they're still not very cheap. Purely going by the valuations, looking to the 10-year averages. But as I said, some of the brokers...
Good morning, hello and welcome to Trading Hour. It is 11 a.m. and here we are with the latest, and the headline is that the market is doing rather well. It is bulls in control. The Nifty, in fact, intraday has conquered 22,700 once again, and a lot of large caps are leading from the front, including banks today. I'm Surbhi Upadhyay. With me, as always, on the show is Reema Tendulkar. Reema, quite a good start to the day.
Oh, absolutely. And now we're just about 0.5% away from our all-time high levels of 22,795. So I think just about 100 points, right? I guess we can start the countdown. 100 points left for our all-time high levels. Today is also the Nifty weekly expiry. And banks, that's where the support is coming through. And one of the factors driving the gains in banks is the decline that we've seen in the 10-year yield in India. So that's boosting the bank bond portfolio. So that explains why the banks are outperforming, particularly PSU banks. The Nifty PSU banking index has a gain of more than about 2%, but even private sector banks like an ICICI Bank, Axis Bank are outperforming, and that's where the strength, the leadership is coming through. And it could be in courtesy on account of the fall in the 10-year bond yield in India on the back of RBI's, extravagant, the dividend that they've given. The metal index has weakened for the second day in a row on the back of weaker China demand and a stronger dollar. So the metal index is still down 1.7% now on the metal index. In terms of earnings, a lot of consumer names, so ITC, Page, Honasa, Bikaji Foods, all these numbers, all these companies will be reporting numbers, and tomorrow it's going to be Hindalco and NTPC that the street will track in terms of numbers.
Just a point, Rima, the bond market shut today because of Buddha Purnima, but the anticipation is that with this bonanza, eventually there could be, once the budget is done in July, there could be some reduction in borrowing, and that could perhaps, that coupled with the fact that there's the inclusion in the global bond indices, including the JP Morgan bond index, more and more money will come in. And actually that's already been happening this year. This year FPIs have pumped in far more money in the bond markets than they have in the equity market, and that of course has been keeping yields fairly benign, with the expectation that perhaps they'll trickle down a little further. So banks are definitely leading this party from the front. But just to add, there are a lot of other stocks as well. I mean, look at something like an L&T, look at something like a Bharti. IT is a strong spot as well today. I mean, stocks like TCS, etc. Leading. Some of the consumer names like Titan. Consumer was a strong play yesterday. That's continuing today. So the short point is that this move that we're seeing in the market right now, it does seem to have, plenty of legs. That's what's playing out. But speaking about, of course, the big, massive headline that came in, after market hours yesterday, this bonanza that the government of India has got from the Reserve Bank. Now, the RBI has announced a record annual dividend of 2.11 lakh crore rupees for the government. The government, by the way, had budgeted just around 1 lakh crores by way of RBI dividend for the year FY24. But what the government is receiving is obviously double that amount. And this is also almost 3 times higher than the 87,000 crore rupee dividend payout that was seen in the previous financial year, which is FY23. Now, in a conversation with CNBC-TV18, Finance Secretary T.V. Somanathan said that RBI's dividend will prove to be beneficial for the government and the government will pragmatically take future steps with regard to fiscal policy. Take a look.
Cash is a short-term thing. The revenue is important. Cash will fluctuate based on expected. Cash is not something which can be managed, or I can't tell you how cash will be managed. But I can tell you that this dividend is good for the revenue of the government. It's good for the fiscal position of the government. It's always good. All revenue is welcome. We will only buy those bonds back which come at yields which we like. So it's not this is not like when we are trying to raise money. There is no failure of the buyback. We have put out a target amount. If it happens, it happens. If it doesn't happen, it's okay, no problem. If conditions are tight enough, people will take the buyback. If they're not taking the buyback, then conditions are probably not very tight. So, I mean, that's a matter for the other side to decide on how much they want to buy. It would be definitely 0.2, 0.3% higher than what we expected as receipts. 0.3% of GDP.
The number. Okay. Of the GDP.
Yeah. Is the delta.
Okay, that's, on the RBI's more than 2 lakh dividend. For the Nifty, it now continues to inch above that 22,700 mark. On the way up, it's banks. But other than banks, you've got L&T, which is, contributing quite handsomely, 1.7% higher. Bharti Airtel is a big mover. And some of that NVIDIA rub-off is showing up in IT names. So Infi, Wipro, also up more than 1%. But to get back to, the macros, Lakshmi Iyer, CEO of Investment and Strategy at Kotak Alternate Asset Managers, is now with us on the show. Lakshmi, morning. Thank you very much for joining us on this, big day. Your first thoughts on this record dividend given by the RBI to the government. What does it mean?
Good morning. It is definitely the much needed, I would say, the magical infusion or the magical portion that the markets were looking forward to, and a complete surprise I would say more than double of what the markets were looking at, or including what was actually projected in the interim budget for FY25. So I think all in all, it is really a very, very big bazooka, which will have far-reaching implications, not just from a slightly micro perspective on the government demand and supply, but more importantly, from a larger fisc perspective and the government's ability to do maybe much more than what probably they would have intended to.
Lakshmi, hi, good morning. Great to be talking to you. Just double checking, right? Bond markets are shut today, right?
But
you're still in office. But you're still in office, so you're still working. All right, then we don't feel so bad. At least we're not pulling you away from a home holiday. But just to get back to the subject at hand, I think the big question since yesterday, 3:30 when this came out, has been what will the government do with this additional 1 lakh crores of bonanza, right? They budgeted 1 lakh, they've got over 2 lakhs. And that's been the debate, whether this will go in pruning the fiscal deficit target, whether they'll simply spend it, whether they'll reduce borrowings. What's your best guess?
So, well, Surabhi, all of these things are possible if you ask me. It's not that it's either or, but certainly, as I mentioned, the government gets much more elbow room to be able to fructify some of the capex-led initiatives which were strongly required. Well, one school of thought which markets have been debating also, could we see some rationalization in the tax structure to, ensure or to enable the bottom of the pyramid to pump prime some consumption? I think these are some of the thoughts which are definitely going on. But if you look at the broad math, this would be close to about 60-65 basis points from a GDP perspective. Now, from a fiscal perspective, the impact could be close to about 40 basis points or 0.4%. Now, will the government decide to probably use that ammo to pump prime its capex and infra-related spends, which is what they have articulated? That could definitely be, and that's top on our list at the current juncture. And mind you, this is just the RBI payout. There is still the PSU payout, which is impending. So I think the booty is pretty strong and formidable, and therefore that opens up a plethora of opportunities for the government as we speak.
So early right now, but how much do you think the capex by the government goes up when they announce the elections? Anyway, they've been spending big money, but what could be the incremental growth that we're looking at now?
So as I said, they can divert maybe half of that. So assuming the impact on the fisc was, say, about 40 basis points. So about 0.2% and 0.2. So probably half and half is what they could probably divert towards the more productive sectors. And for long, capex has been a much desired wish list from a market standpoint, specifically from the capital market standpoint. So I think at this juncture, as I said, too soon to say, and you rightly observed, but probably towing that line at the current juncture, given the fact that the markets had already reconciled to the fiscal deficit that was already outlined, allows some of these to fructify.
Okay, Lakshmi, now let's talk about the market impact. The market obviously will react tomorrow, but the equity side is already reacting. I mean, the rally in bank stocks, I think, is, part of that is resting on hopes that yields will keep moving down. Now, we're already at just about sub 7%. What next?
Yes, you're bang on. So as I said, because it has far-reaching implications on the larger market, including the capital markets, the PSU as a theme, for example, we've been quite constructive on. We've seen buoyancy there. The banking space, which kind of has been, a kind of subservient to the broader markets, that's doing pretty well. From a bond markets perspective, definitely this will... this is in tandem with the buybacks which have been announced, which has got tepid response. But also, if you see the first quarter treasury bill supply also has been cut. So this comes as superimposing as a stronger catalyst, which means are we headed towards 6.75 on the 10-year benchmark in the very near term? The answer is yes. I think you look at the FPI or the foreign portfolio investment buying, that's also pretty strong and robust. Year to date, which is a calendar year, we have crossed 40,000 crores in terms of net purchases. And I think the momentum is likely to continue.
Okay, all right. Lakshmi, good having you on this big development. Thank you for joining in and giving us that quick analysis. So that is the view coming in from Kotak Mutual Fund on the dividend bonanza that the government has received and the implications for the money markets. We, in fact, were catching up with a lot of economists as well to try and understand how this perhaps could impact the fiscal math. Listen into the opinion that we got in the morning.
The immediate impact with respect to market liquidity is, of course, nothing. This is going to come with a lag. And the amount that is done, I mean, look, you can think of the budget both in terms of cash accounting as well as accrual accounting. So it doesn't really matter whether it falls under the 24-25 budget or the 23-24 budget. If we were going to have shortfalls in other sources of revenue, this certainly acts as a balancing factor. So therefore, it's a piece of good news as far as the fixed income market is concerned when we are looking at from the supply of bond perspective. So from what I'd like to see, as a former, I'm a fiscal economist, of course, I would like this surprise addition from the dividend to be used as a saving tool as opposed to accommodating expenditure.
We were putting out in our notes saying that there is a possibility that the RBI dividend will be significantly higher than what the government has budgeted for. And so that way, it's not that big a surprise for us. Yes, it means that the government has three options in some sense. One is that it can reduce the fiscal deficit, 0.3% of GDP, as you mentioned. What the initial thought process was that the government will do only somewhat marginal tweak to the interim budget numbers because the interim budget itself was quite detailed. Now, with this more than 1 lakh crore extra kitty, the budget maths will have to be reworked and it will become very interesting and the market will keep on speculating till it's actually announced.
It's a substantial fiscal bonanza that has come in. We think the government could therefore choose to reduce the deficit marginally when it presents the final budget in early July, which is what we're expecting, but also leave some cushion for any unexpected shifts that might happen on the revenue and the expenditure side. This is actually going to add to the cash surplus that the government is sitting on. This could very well go, above 5 trillion INR, and therefore some sort of a reduction in the borrowing, could happen. Again, the details of this are likely to get announced in the budget. And as Somiran was saying, it's really positive from a demand-supply environment. So our own forecast is that the 7-year as well as the 10-year bond yields could drop to 6.75%.
All right, there you have a lot of views coming in on implications for the bond market and for the fisc, given the RBI bonanza. Well, with that, let's take a very quick break. We'll come back on the other side and get you the latest in the commodity markets.
On the chemical sector, UBS put out a note on the chemical sector. They say that the investors may be ignoring some strong niche positions and growth opportunities within the sector. They are seeing some modest volume recovery for many of these companies, and hence they initiated a buy report on PI indices as well as on Navin Flooring. Interestingly, even Morgan Stanley put out a note on Deepak Nitrate a few weeks back, and they've actually double upgraded the stock to overweight now. They have a target price of close to 3,000. They see a potential 20-25% upside from here. But the key is that they believe that the earnings can double for this particular company by the next 4 years. So it's been a mixed feedback from a lot of analysts. But from a long-term perspective, chemical companies in India have been big wealth creators.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown.
Welcome back. Let's talk about commodities. There has been a retreat in base metal prices. Manisha is now joining in and she's going to be talking about copper. Hi, Manisha.
Hi, Rima. Thank you for that. Well, yes, we've seen copper prices gain up by 10% in the last 1 month, almost 30% in last 3 months. But there is some profit taking that we finally are seeing onto this one. Actually, it is across board, as you said. We have seen the US Fed meeting minutes come in yesterday, suggesting that the inflation is still sticky and a rate cut in September perhaps is not a probability. This is the reason we've seen 4.5% of decline come in for the copper prices. After the US Fed meeting minutes, we also have seen a decline in US, rather strength in dollar index. And that seems to be weighing onto the markets as well. For copper, it also has been about the kind of price moves that we have seen. Pardon me. We've seen an all-time high in the US markets, on LME, in Shanghai and the Indian markets as well. And it has been a one-way rally for last 2 months in case of copper prices. So some profit taking is what the street anticipated you could be looking at for in this metal. If you look at the near-term demand, that in China also seems to be slipping. Well, the metal prices have been rising because the street believe that there is not enough mines or new projects coming in. And a longer-term demand until 2025 or 26 is something that these supplies will not be able to match or fulfill. Now, if you look at the near-term demand, that is not so strong, even as China has been coming out with various stimulus measures, also looking to buy all unfinished projects. Even after that, the demand for the near-term really has not picked up. When you look at the speculative activity, well, that's an important one. If you look at overall CME standing right now, it is the net longs that have come in from the speculators. The producers are net shorts to the tune of 1.04 million tons. Now, within that as well, there are reports that almost 100,000 tons of copper is en route to the exchanges from US to ensure that the sold positions or the bearish positions will be delivered into. Apart from that, there also are reports that nearly 20,000 tons from Chile mines also is coming into US. So there's a lot of copper in the international markets which has started to move around, which also tells you that the premium that the markets were looking at in sense of cash to 3 months seems to be coming off right now. There also is a very interesting statement that has come in from International Copper Study Group, which says that with the kind of movement that we have seen in physical copper, you could be ending this year and the next as well with copper surplus. So until the time the demand really starts to come back, or you see an interest rate cut, or the China data starts to come in positive, I'm assuming that you are looking at consolidation coming in for copper and various other metals.
Okay, all right, got it. So some profit taking coming through after record highs seen earlier. Thank you, Manisha, for the latest from the copper markets. Well, with that, let's shift focus back to equities and how the equity market is looking at all the volatility in the run-up to the big electoral result. Investor Capital Services has recently written a note on what the voter turnout data in the recent Lok Sabha election phases perhaps reveals. They are arguing that voter turnout is influenced by perceived strength of parties at the state level, local issues, voter fatigue, national alignment of parties, and weather-related issues. To discuss more about this and the takeaways from the report, we have with us Mukul Kochar, Head of Equities at Investor Capital. Mukul, great to have you on the show. Thank you for joining in. And very interesting report. And, I can just go back and look at the last 3-4 weeks. So the VIX hitting record levels, a lot of volatility, profit-taking. And at the center of it all was exactly this, that voter turnout seems to be low. Though I think we are still averaging in the 60s, which is not too far away from the mean. But what is your sense on the link between voter turnout and the profit taking that we've seen on the street?
Yeah, so Surabhi, I'll take you to a period before the elections. And, what was remarkable is that, something that influences politics and hence economics in the country for the next 5-10 years was completely in the backseat. It was a given, that everything's going to be okay. So elections were not a discussion point, for equity investors at all going into the elections. And then suddenly this curveball was thrown where the first phase had a drop in voter turnout, and all kinds of discussions started coming to the fore. So the equity volatility was, derived from the fact that this was totally unexpected. A curveball was totally unexpected. All the opinion polls going into the elections were one way, with the lowest being India Today Mood of the Nation polls at 304 for BJP. So, anything that challenged, even if remote possibility or small possibility, challenged the status quo became a discussion point, and hence the increase in VIX. So that's essentially what happened. I mean, it was because we were very complacent, because we weren't looking at the elections as an event altogether, that suddenly it was thrust upon us. as we look into the voter turnout data and do that analysis, I mean, I think the way we stand today, given the level of information we have, we go back to the opinion poll. And as we've discussed in the turnout data, it doesn't really reveal anything advantage for one party over the other. So the last well-known data point for us is still the opinion polls that came in right before the election. So unless something really changed in the last month for the electors, I think the opinion polls right before the elections are the data point that we should focus on.
So if the BJP gets about 300, 303, which is similar to what they got last time around, what will be the market reaction? Will they be okay with it? Will we continue to move on? Or will there be some disappointment? And one more question, Mukul, what is smart money doing ahead of this election? They've made a lot of money. So have they just booked some profits? They're holding on to cash position and just waiting to see the outcome?
Yeah, so I'll answer both questions. So first on the number expectation. So if you did the math prior to the election, the number that was going out for the ruling alliance, it was a stretch, right? It was difficult, and it's also been explained by some people as an aspirational number to sort of give a target for people to go after, right? Realistically speaking, that number looked a stretch. So I think in the mind of investors, the 303 becomes one operative number, because anything over that you can make a safe argument that the ruling dispensation or the current dispensation is gaining increased acceptability, and hence that can continue, right? So 303 means more penetration into the country by the ruling dispensation. More than 303 ruling dispensation gets stronger. Less than that, you can make the argument, hey, we peaked on that, so what happens after 5 years? So obviously a weaker statement. And then the next operative number is 272, which is the absolute majority that allows you to have a stable 5 years of government, right? So 272 and 303 are the numbers. Between 272 and 303, there can be some argument that BJP has peaked. Above 303, of course, you can start making the argument, hey, there's still room to run. So that answers that question. Which are the numbers to focus on? I think 272 and 303 are the two numbers to focus on. The next argument is, what does the market do after that? If we do get over 303, I think the market is quite well priced. I don't think we do much. There is going to be some relief rally. And what has the volatility come from? On the desk, what we see, the smart money, as you said, the institutional investors, let's just call them, it's pretty much business as usual. I haven't seen a change in stance or flows from institutional investors on our desk, through this volatility. I think where the nervousness or where the more trading is happening is, I think my sense is more on the retail side, as well as ETF flows globally, which are also retail driven. So I think institutional money has remained smart through this entire volatility, is my opinion, and the retail is where the volatility is taking place. And post elections, we expect a little bit of a rally, but not that much. Yeah, sorry.
No, we're just hearing all your points and pretty interesting ones, Mukul, but unfortunately a little short on time. We have a very big interview also coming up with Infosys, but we would really want to catch up again, let June 4 get over, and then want to get your view on the market call once this big event is out of the way. What should investors be focusing on? So look forward to that conversation. But thank you for this. Thank you for the pre-election views and how to read a lot of the electoral cues that we are getting. Good to have you on the show. All right, we'll take a break on that note, come back with more on the markets in just a bit.
And ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would.
Well, hello and welcome to the CNBC TV18 special conversation. The buzz continues to be around AI and generative AI specifically. Look at the standout blowout numbers that have come in from NVIDIA overnight. The company crossing $2.5 trillion in market cap. It is now the third most valued company in the world, surpassing, of course, Alphabet and Amazon. Joining me now to talk about Infosys' AI strategy, AI opportunity, as well as the metrics that they are going to be using to measure success and return on investment, and of course to talk about the outlook as far as IT spending and discretionary spending in the deal pipeline is concerned, is Salil Parekh. Salil, always a pleasure. Appreciate you joining us here on CNBC TV18. It's good to speak with you. We haven't spoken to you since the earnings, but you know, as I pointed out, look at what's happened with NVIDIA overnight. Performance which is standout, blowout, and we get you on a day to talk about the AI opportunity. So let's speak about Infosys in specific. At the end of your earnings call, you spoke about how the company has generated 3 million lines of code using LLMs. You called it industry leading. Give me a status check on where things currently stand as far as Infosys' AI strategy is concerned.
So thanks, Shireen, for having me here. Always good to be here. On generative artificial intelligence, that's really a completely new way of looking at things. What it's doing is basically manufacturing intelligence, whether it's tokens or whether it's assistants or whether it's agents. So that example of the lines of code is something that was created by large language models that we train on very narrow sets of data for specific large organizations and also for internal. So this is something extremely exciting with our clients. It's different from what's going on in the consumer world. So this is for large organizations. In the consumer world is what you're seeing and what you just mentioned with some of the examples. In large organizations, the work is really focused on how do we connect with customers better, how do we make things more efficient, and that's where generative AI is starting to help by the creation, manufacture of intelligence. Our approach has been make sure we work across the board with large language models on narrow data sets, what we call narrow transformers, and now even what are called small language models, where within a large organization, we take that data and make things better. For example, we've done something with a bank where we've been able to extract, they've been able to extract information, analyze it, sort it, and improve how their credit rating works. We work with a telco where they've brought together all their customer sentiment and through their customer service area, improve how their service level is, how they connect with their customer is, and reduce the cost. So this, the level of impact is just phenomenal that we are seeing. It's small still because we're working today on 200 projects, but as we go through, as the economic environment changes, we see more and more of this coming to organizations.
Salil, as you pointed out, it is still small, but you believe that the opportunity is going to expand as you move along. Now, what could this 200 become over the next 3 to 5 years? You're currently working on 200 projects. Give me the kind of headroom that you see for potential growth. Also, quantify for us, in terms of the revenue expected by the work that you're doing as far as these specific generative AI projects are concerned. What could that potential deal pipeline look like for you as well as revenue?
So there, we have not shared externally things in the nature of the metrics you're mentioning. What we anticipate in terms of opportunity is, as the economic environment changes, both for cost efficiency, but also for customer connect growth, generative AI is going to be more and more spreading in large organizations. Now, the thing with large organizations is, there's a coexistence of technologies over the years. You probably well know that there are many large organizations that are still using COBOL. So we have everything from COBOL to generative AI that's going to work in the mix, and that's where we are very good with our AI-first approach, making sure all of that is moving to the new areas. One statistic which could be quite interesting, for example, is the way we are training all of our employees. 6 out of 8 employees at Infosys are getting trained on generative AI and artificial intelligence technologies in different levels, because there are a large number of these new models and there's different ways to work on it. And we have areas, for example, software engineering, process optimization, customer service, different areas in which we are making this use.
Yeah. I understand, Salil, that you haven't given us any indication of the revenue expected on account of the projects that you're working on generative AI, or in fact the deal pipeline that you have the ambition to pursue. But I still want to understand, what are the metrics, for instance, that you will use to measure success or use to measure return on investment? If you could share that with us. And this is not specific only to Infosys, because many surveys of CEOs at this point in time do indicate that everyone is grappling with this. How do you measure the generative AI adoption and the KPIs associated with that? So what are the KPIs that you're looking at to measure success?
So for us, it's really in terms of the objectives, it's where the impact is. So there's impact we see with our clients in how they connect with their customers, what they're doing with their employees, and how they're optimizing their operations. And for each of those, there are benefit metrics, whether it's an improved time to market, a better level of connect with customer, a much more efficient, therefore less costly process. And those are the sorts of metrics our clients are looking at. Today, the discussion on generative AI, at least in the broad world, is much more oriented on what individuals' use of generative AI is. Our intention and focus, because of our business, is much more with what large organizations are doing. And there's a very specific way that we've developed, where we see now many of the clients looking at more carefully this approach on looking at the data within a client organization. The foundational blocks really to make anything work with generative AI within a large organization, first is data, making sure both the structured data and unstructured data and social media is properly analyzed and captured. And the second is the cloud, where you need that level of infrastructure, whether it's public cloud or private cloud, that helps to leverage it. And we are now, through our digital move over the last few years, very strong on both cloud and data, and that's helping us as we connect with our clients.
Salil, let me address this question a little differently, and I'll pick up on a note that HSBC has put out, which asks the question if generative AI will actually be deflationary over the medium term. And it says that, a decent share of revenue for Indian IT comes from low to medium complexity coding. So there is a potential threat from generative AI as it looks set to automate part of this work. How do you respond now to something like that? You've talked about the opportunity, but it's also being seen as a potential threat for the Indian IT services sector.
So for us, what we are seeing is it's opening up newer areas where we can deploy generative AI. So the example I gave you of the credit or of the telco, these are things which could have been done with a lot of effort, but with generative AI, it becomes much simpler and much less error prone to do. So we are seeing an expansion of that opportunity set that's available. And then we're seeing productivity benefits. For example, even in the way software engineering is done, we see benefits of productivity there, where we will see efficiency used to allow people to do different things. So at this stage, given it's a small size within our business, we don't see a big change, but we are seeing both types of work at least show up from our client organizations.
Salil, generative AI, as you have pointed out several times through the course of our conversation, still nascent and small piece of the pie that you're looking at. But if I were to ask you, and this is what we heard from TCS, they said that the AI pipeline is actually doubled to 900 million. Could you give us an indication of where things currently stand for Infosys?
So there, my view, first, we don't share a pipeline view outside of our overall large deals number, which is our focus. But what we are seeing, we were a few quarters ago doing things which were more like proof of concepts. Today, these are actual projects with clients where they're seeing the benefit. And that's a huge change. And we see every client discussion a combination of that. Now, when you look at AI, there are things to keep in mind. Artificial intelligence and machine learning is something we've been using for a very long time. What we are referring to in this new change, this manufacturing of intelligence, is generative AI. So if there are discussions on metrics, we want to be clear as and when we share them, it's more focused on generative AI.
No, I get that. I'm still trying to extract a number from you, at least a ballpark number from you. But, Salil, you talked about how 6 to 8 people or 6 to 8 employees at Infosys today are being trained on generative AI. So I also want to understand from you what this eventually means as far as your hiring trend is concerned. Because if I were to look at, what has happened on hiring at this point in time, down about 7.6%, almost 8% for the quarter, declining by a little over 26,000. So what is the hiring strategy going to be? I know that you've said that it will be driven by agility, but what does that mean both in terms of the kind of people that you hire, what you do on campuses, and the number of people that you intend to hire going forward?
So there, Shireen, it's a combination of various parameters. So one, as of course you know, over the last several quarters, the economic environment has been slowing. And we've seen a lot of the digital transformation work slowing down. Most of what we are seeing in terms of large programs are cost programs, efficiency programs, automation, and consolidation of partners, those sort of programs. And that's the reason where we've seen less work on the digital transformation side. Now, the point with generative AI is much more on what we see as a trend in large organizations over the course of time. What we think in terms of hiring, as we see the changes, as interest rates come off or the inflationary environment comes off, and we see the economic environment where large organizations are starting to spend on digital programs, transformation program, we will see that starting to come back.
So at this point in time, you're not seeing any visible signs, any incipient signs of a pickup as far as digital transformation projects are concerned. And, again, I come back to the hiring question. Attrition has been about, 12% for you. Utilization continues to be around 82 to 84%. So what is the hiring trend going to be for you in the foreseeable future?
So there, we have what you described earlier, quite an agile hiring model where we go to campus, but we also recruit campus graduates through the quarters, and that will continue. We also recruit lateral hires in, that will continue. And as we see the discretionary work or the digital transformation work starting to come back, more and more of that will come through. We've not at this stage given the annual target of hiring, but we are remaining agile as we see changes happening in the environment to make sure that we are ready to support our clients for that.
But do you see the absolute number being lower, significantly lower, given not just the economic environment, but also the benefits accruing from higher productivity and so on and so forth?
I think, again, because these are two different factors, the generative AI piece or productivity piece is on a small footprint today in terms of what we are doing with it. The economic environment is what was driving a lot of the digital transformation work, and even some of the discretionary spends, and by different industry was at different stages. As we commented at the results time, the discretionary spend, we've not seen a change at the end of Q4 or at the start of Q1. So we will wait and see how that plays out. And based on that, we will see what the environment for recruiting is and what the environment in the future is for digital transformation.
Salil, you talked about discretionary spend and you said that at this point in time it looks like pretty much around the same levels. But are there any optimistic signals that you're picking up from clients at this point in time? Because while geopolitical tensions are escalating, the US markets and the US economy continues to be strong, continues to be buoyant. So are you picking up any indications from clients on doubling down perhaps or picking up the pace as far as discretionary spends are concerned?
So there, one of the comments we'd made again during the earnings time, which holds, generally the discretionary spends approach looks similar at the end of Q4, start of Q1. We'd also said on financial services, we see a little bit more activity than we'd seen in Q4. And the same thing is visible to us today. That, coupled with what we see people working across the board on cost efficiency, and then in a smaller way with generative AI, is what we see as the outlook today.
Okay, speaking of outlook, let's talk about M&A. You did an acquisition in the engineering services space for $450 million. Potential M&A targets, will you be looking at Gen AI capabilities much more, given the fact that that continues to be an ambition that you want to bolster? Explain to me what will drive the M&A strategy for you from here on.
So there, we have done a phenomenal acquisition in engineering services. Actually, we did two, a smaller one and a larger one. Both are very strong. The larger one focused on automotive work. This is a company from Germany, but working across the world. It's an exciting space. We already have a very large business in engineering services, and we see good traction for growth. We will continue to do this. Environment is a good environment for us to look at acquisitions. We continue to have a strong balance sheet. We generated $2.9 billion of free cash last financial year. So we are well set for that. We're looking more in spaces which are related to that. So for example, we look at engineering services. We look at some other SaaS areas. We look at geographies as well. There are various geographies around the world which are doing well, and we're looking at those as a expanding footprint. On generative AI, there is not so many companies which are doing services, so there's not so many areas to look at it. But if something comes, we will of course look at that.
You know, Salil, you said that this is a good environment to go shopping, and you are looking at acquisitions, you know, to add to your capabilities as well as enhance your geographical penetration. Are we likely to see, you know, deals close in this financial year? Are things looking hot on some potential targets that you are looking at this point in time? And what's the appetite in terms of size?
So there, again, as you've seen over the last several years, we've done small acquisitions which have done very well for us. This one is a similar one, slightly larger. We are open to doing things which are in that type of a size range. There's a lot of discussions, but with acquisitions, you never know till a lot of the parameters come together, including a cultural fit. So it's like difficult to predict what it'll look like, but we are definitely in several discussions and keeping an open eye given the macro environment for acquisitions.
Okay, an open eye on acquisitions, but let's also talk about large deals, Salil. Robust at 17.7 billion the last quarter, up 80% year on year. You know, and you hope that the benefits of that will accrue to you in FY25 as well. How confident do you feel about building on that momentum?
Well, that's going phenomenally well. So what that does is it gives us a very strong foundation for this financial year. It was the largest of large deal values that we've had. A net new, or the new part of it, not just renewals, was very high. And most of those deals were on cost and efficiency. There were some on digital, but mostly cost and efficiency. And so that is the sort of market environment we're seeing. What that means is we believe we are very well positioned to work with clients, even when they want to consolidate partners and they want to look at cost and efficiency, because we have automation, lean, which has been working extremely well. And now you add a little bit of the productivity part of generative AI, that gives an added boost to the whole business. So we feel strongly the pipeline is on cost and efficiency pretty good, and we will continue to see good traction on that.
Okay, a quick word in on margins as well. Salil, the margin guidance stands at between 20 to 22%. But if I could borrow from TCS and ask you to give us a margin beacon, for the medium to long term, what could we expect, especially with all the changes that you're bringing about, not just in terms of cost optimization, but also in terms of the opportunities that you see?
So there, I think you talk about a very critical part of our business. We launched a margin program inside the company about a year ago, and last financial year we already see strong traction. It's got 5 different areas focused on. Within that, there are 20 initiatives. Each of those are moving well. So we feel very comfortable with where that program is, and that will support our underlying margin ambition. In terms of the beacon, as you know, we don't have a view that we share externally beyond the financial year, but we have very high ambitions inside to keep on working on that margin program as we go through the next several years.
Well, I know that you haven't held out a number, but since you talk about having a very high ambition on the back of the work that's already being done, give me a range. What is the kind of ambition that you have set for yourself internally? What could that potentially look like? I'm not holding you down to a guidance, but what's the ambition?
So internally, we will not share the number externally, but internally we have these levers, and the way this program is working, our CFO Jayesh is driving it personally, and we have buy-in and drive from a top leadership in making this happen. So my feeling is that this is going to give us a good set of results over the next several years.
Well, speaking of results and that guidance that you've been held at, Salil, we're pretty much through the half of 2024, and you of course have a grip and a pulse check on what's happening with your clients at this point in time. The possibility of being able to deliver on the or better on the guidance held out, is that looking likely at this point in time?
So there on the guidance, we are very clear with the guidance was 1% to 3% on a constant currency basis, the growth. We will, of course, relook at the guidance at the quarterlies at the end of it, so we'll come to it in a few weeks. But at this stage, we confirm the guidance at 1 to 3%.
What gives you comfort or what gives you confidence today, Salil? We are, of course, talking about many of the uncertainties that continue to prevail as well as some of the headwinds. But where do you see the tailwinds at this point in time that could perhaps get you to review your guidance higher?
So what gives us comfort for the 1 to 3% guidance really is one, the large deals, which was really exceptional, so that gives us a foundation. Second, we see the discretionary spend has remained about the same, which has not become worse, which gives us some comfort. It's not changed to positive, but it's the same level at the end of Q4, start of Q1. And then a little bit on financial services that we saw the movement to a small, better movement, which gives us a positive. And finally, generative AI, where we've completely transformed the company. So as that starts to pick up, whenever that happens in our revenue, that gives us some support.
So again, and I know that you're probably not going to give me a number, but when do you expect that inflection point to be, when you start to see the work that you're doing on generative AI kick in as far as revenues are concerned?
So that, Shireen, is not that easy to have a date on, because there's a lot of global factors that will play into it. Essentially, when will large organizations start to spend on digital programs again? And that part of that will be spent on generative AI transformation program. Right now there is early projects which are small projects. So it's difficult to say when that will happen, but we know that all of these are cycles, and as the cycle plays out, we will start to see some benefits.
Salil, you said that Infosys is transforming itself to be future ready, to be ready for a world where generative AI becomes much more significantly adopted, that is. In line with that transformation, what about management structure? What about people coming in, especially at the senior level? You saw a plethora of senior level exits. Are you looking at bringing more people on board? Are you looking at changing structure in keeping with the kind of transformation that you envisage?
So there, we've been extremely fortunate. We've had a really strong leadership team. So we have all of our leadership positions filled with people from internal movements. And it's quite unique if you look at what we have. We have individuals in the leadership team who work with Infosys for 15, 20, 25 years. In fact, yesterday we celebrated someone who's finished 20 years in the leadership team. 2 weeks ago, it was 25 years. These are people who have worked with each other through those years. And a company like ours, in an industry like ours, is very international in different places. So that ability to work as one Infosys, to know each other, makes a huge difference. And I think it's a big differentiator with anyone else who has to build teams by hiring from 6 different companies at different levels. And that is something that's maybe not well appreciated, but for us a huge advantage. And we think that's a benefit that we are playing out pretty nicely.
Salil, before I let you go, I want to come back again to the jobs issue and to the workforce issue, because many companies at this point in time, you can call it right-sizing, downsizing, reorganizing, so on and so forth. And many are using AI or generative AI as perhaps the reasons for why they believe that they are right-sizing, downsizing, reorganizing. Is Infosys looking at that? Is that a possibility at all at this point in time?
No, we are not doing any of that. In fact, others in the industry have done that. We've been very clear that that's not the approach we are taking. In fact, my own view is for large organizations, all technologies will coexist. We at Infosys are very strong in generative AI, and over the next several years, we'll have more and more people joining us who become experts in generative AI, and we will be serving the world's large organizations. So for us, the ongoing view is an expansion, both over years with clients and with the number of employees.
So my last question to you, when you talk about a transformed Infosys, what are the 3 attributes that you believe will reflect the kind of transformation that you are working towards and you're hoping for?
So for us, really, the transformed Infosys is everything we do today, like any of our service offerings, things which were more traditional, everything is infused with AI and generative AI. All of our employees are trained on that. And the work we're doing with clients, we track metrics on various rankings, and we are now leading in several of those rankings as an AI-first company. So those are the elements of transformation that we're looking at. And all of that then translating over time to increase client relevance, increase work with clients, and overall benefit for all of our stakeholders. So those are the metrics in terms of the transformation that internally we are driving now.
Well, I look forward to hearing numbers from you in terms of what that transformation will finally result in, and also the work that you're doing on generative AI, when that is expected to kick in as far as revenue contribution is concerned, and how much. But Salil Parekh, always a pleasure. Appreciate you joining us here on CNBC TV18 with a deep dive into Infosys' AI strategy as well as the outlook for the sector going forward. We will take a break here on CNBC TV18, but a lot more coming up. Don't go anywhere. We're back in a moment with more.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain.
documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
The pressure is building on Israel. In a historic move, not one but 3 European countries, Norway, Ireland and Spain, have announced that they will recognize an independent Palestinian state. The announcements were made in quick succession.
Stocks trade up with gaining, stocks outnumbering losers by a fair bit. Nifty very close to its fresh all-time high, gains across all sectors. There are some draggers though, like utilities and pharma, but all in all, a good trading session so far.
The Reserve Bank of India doles out a record 2.11 lakh crore to the centre from FY24 from its surplus. The largesse amounts to 0.3 to 0.4% of GDP, and that can help the government trim its deficit or boost spending. Now, how will the government use this money? That remains the big question.
Sun Pharma slips after it guides for a single-digit growth in FY25. Lupin slides on new competition in a key drug, while HEG drops as margins crimp. Garden Reach Shipbuilders and PG Electroplast both jump on posting heady growth in both sales and profits.
Nvidia clocks an unimaginable 600% growth in profits and guides for a stronger quarter ahead than most expected. The $150 billion company in 2020 has now turned $2.5 trillion enterprise in 2024 and has now set its sights on the AI needs of the governments as its new growth frontier.
Good afternoon. You're watching us here on Halftime Report. It's an all-boys show. It's Mangalam Malu with Hormas Fatakia. Looking very good for the markets. In fact, in colloquial terms, what do you call it, Hormas? Within kissing distance of a fresh record high for the Nifty. Almost 40 points away right now. 150 point up move is what we're seeing on the Nifty. The good part is it is being led by the Nifty Bank, which is higher by 650 points. Hi, Hormas.
Mangalam, it's a all-boys show and it's a terrific Thursday, if you'd like to call that. It's the weekly expiry of the Nifty and it is within, as you said, touching distance of the record high, and it's almost there. But the heartening bit, as you just said, as the Nifty Bank, that is leading the gains, because the Nifty Bank has been a bit of a pain point over the last two trading sessions. They're struggling to sustain above that mark of 48,000, and it is doing so very convincingly now. There you can see the Nifty is now nearing 22,760 on the upside at the highest point of the day. Let's focus on some of the stocks that are on the move. There are plenty of them in the broader markets, and Gland Pharma is the first one. It's gaining over 4% following its fourth quarter results. The management has maintained its medium-term top-line guidance of mid-teen growth in the base business. Vivek is here with more details. Vivek, good afternoon.
Well, that's right. So Gland Pharma is the stock in focus, reacting quite positively. In fact, quite a mixed bag. That's how the street is actually reading this set of numbers. So first, let's have a look at what brokerages have had to say. Like you mentioned, Goldman Sachs has maintained a buy stance. They have a target price set at 1,975 rupees a share. What they're saying is that the good part is the management has gone ahead and maintained their medium-term top-line guidance of mid-teen growth as far as the base business is concerned. We'll come to the other business a little later on. Nomura has gone ahead and maintained its neutral stance. They've kept the target price at 1,570 rupees a share. They're saying that fourth quarter was a mixed bag. As far as the core business was concerned, it was strong. However, the CDMO business, that is Sensex, was quite weak in this particular quarter. What the management has said in the conference call is something that the street is taking quite a bit of confidence from. Management expects, the CDMO arm Sensex to get to high-teen EBITDA margin in the medium term, which according to them is in the next 2 years. What did they say as far as the con call was concerned? The legacy biz revenue run rate has improved sequentially. They're saying that the recently launched drug Halaven generic also should go ahead and aid revenues going forward. They're saying the EBITDA loss widened, while it widened to 72 crore versus 17 crore on a year-on-year basis. They're saying that no near-term pickup in Sensex, which is the key concern. But at the same time, the guidance that they're given is something that the street is taking quite a bit of confidence from.
All right, so while the numbers weren't as heartening, the guidance is something that the street likes, and that explains why Gland Pharma is moving higher in today's trading session in an otherwise wobbly day for the pharmaceutical space in particular. But, we were talking about the markets on the whole and how the Nifty as well as the Nifty Bank are doing well. The advance decline ratio is still split right down the middle. So if you just take a look at, the number of stocks which are advancing and declining, those crisscross lines come up for you. They are pretty much embraced and in a bit of a lock with each other over the last hour or so. So now that we've spoken about a stock which is doing well, let's speak about a stock which is not doing well in today's trading session. That's HEG, tanking in trade after reporting a weak set of numbers. We spoke with the management as well. So let's get in our special Insight Edge segment with Nigel telling us the insight that he got from the conversation with the management.
Well, that's right. A couple of pieces of news playing out on HEG. First of all, the numbers were rather weak. If you look at it on the top line, there was a degrowth, of course, on 11%. EBITDA got hit far harder, and that meant that margins came down to single digits. And this is the lowest margins we've seen in the last 3 years or so. The power and fuel cost, and in spite of seeing a decline on the top line, the power and fuel cost was constant, telling you that that's the problem pocket for them. And the net profit number as well took a clonk. So that's the first part of the news, that the results were rather disappointing. The second part was they announced a scheme of arrangement. What was that? They announced that now in the time to come, you'll have two listed entities. One will be HEG Graphite and the other one will be HEG Green Tech. Keep in mind that this Green Tech entity, that's the one that will house the manufacturing of graphite anodes for the lithium cells. As of now, there's no revenue coming out of there, but that could be a driver going ahead. So that's why, they're saying that they're going to be rooming this business. As of now, 95% of their money comes in from graphite electrodes. So that's bulk of their business. How does the holding shape up post this scheme of arrangement? The promoters, they seem to be more bullish on the Green Tech business because they're doing a merger of, one entity into them, a couple of entities actually. And that's why their share goes up to around 70%. While in the current business, well, it stays at around 56%. That's the graphite electrode business. Now, we spoke to the management earlier today, and a few important highlights that they gave us. They're saying that the Green Tech business, they believe that could be a 1,000 crore EBITDA number in the next 3 years or so. We'll have to hold them on that number, but that's what they believe. On HEG Graphite business, well, they gave us some important points. They said, yes, the margins were disappointing, but be ready for 2 more quarters of pain. The recovery will only be there in the second half of the year. And in volumes, they're talking about 75% capacity utilization on a capacity of around 1 lakh tons odd, which tells you that they'll be doing around 75,000 tons. And finally, they said that the cash balance as of now is around 1,000 crores. But 700 crores out of that will be used by HEG Green Tech. So put all this together, the numbers are a little disappointing. The path ahead, they believe that HEG Green Tech can deliver good numbers. But for the time being, the stock's under pressure. In fact, let's listen in to what the management had to tell us.
The margins continue to be under pressure, and I have said in the last interview also that it's still inching down, and the needle coke prices are also coming down with a lag. So that is why the margin is under pressure and it's likely to remain so for next 2 more quarters, it seems. For the last, since we declared the expansion in November 23, it's only the last quarter of Jan to March that we got this capacity. So on that capacity, our total utilization was in excess of 80, between 80 and 85. Going forward for 24-25, we expect to be around 75% of the new capacity of 100,000 tons.
When the capacity utilization will go till 75%, the EBITDA will be approximately 350 crores from that. So you can expect they could be 1,000 crores of EBITDA coming from this green tech company in next 2-3 years. We are sitting with 1,000 crore of cash, of which roughly 700 crores will be utilized for this TACC business.
The stock has taken it on the chin today, has HEG 9% lower now as we speak. Time for a short break here on Halftime Report. Up next, we get you an exclusive conversation lined up with Kamlesh Goyal, the founder and chairman of Go Digit Insurance. He discusses the company's D Street debut. Stay tuned. Back on the other side.
Manner in the hope that this will help bring peace with Israel. The formal recognition in all these three countries will be made on May 28th. However, an angry Israel immediately called back its ambassadors from Norway and Ireland, warning that such a move will fuel extremism, terrorism and instability. With the rising civilian death toll in Gaza and the International Criminal Court evaluating the application for arrest warrants against Prime Minister Benjamin Netanyahu and Hamas leaders, all eyes are on Israel's next move. Let's try to understand why these countries have done this. Norway's Prime Minister said, and I quote, "There cannot be peace in the Middle East if there is no recognition." Spain's Prime Minister also reiterated that it's essential that the two sides, Israel and Palestine, negotiate for peace, and it's for this reason that we recognize Palestine. While the Irish Prime Minister said that Palestinians in Gaza are enduring the most appalling suffering, hardship and starvation, and permanent peace can only be secured upon the basis of the free will of a free people. So what exactly is the significance of recognizing Palestine as an independent state, and what is the two-state solution? Simply put, the Israel-Palestine conflict is one of the oldest and persisting conflicts in the whole world over who gets what land and how it's controlled. And a two-state solution hopes to resolve it. It's fundamentally about how or whether to split the country's territory between the Jewish and Arab population, Israel for the Jewish people and Palestine for the Palestinian people. Some 143 out of 193 member states of the United Nations recognize a Palestinian state, including India, that supports the two-state solution. In 1988, India became one of the first countries to recognize the Palestinian state. However, countries like the United States and the United Kingdom don't.
We're looking at a good traction in the year. The tire industry is expected to grow about 6 to 8%.
Back with us on Halftime Report, and let's focus on the new kid on the block now. And shares of Go Digit listed at 286 rupees a share compared to its issue price of 272. It was a subdued listing so far, but the stock has picked up after that, almost 12% higher now from its issue price. My colleague Yash Jain spoke to Kamlesh Goyal, the founder and chairman of the company, and began by asking him about the potential premium growth trajectory for Go Digit Insurance. Listen into a slice of that conversation.
We as a company don't really work on the basis of some guidance or something like that. I think we by nature look for opportunities as they arise. It could be in any new product, it could be an existing product or a new channel. And that is how I think we look at business. And this listing is a huge milestone, but I think we work business for the long term, and that is exactly what we will do. Life and business is never a straight line. It's more like a roller coaster ride. I think we'll hit some highs, we'll hit some lows. But we will do what is really good in the long term for the company to the best of our ability. I think today on a listing day, that's one assurance I can give on behalf of myself as well as Digit to all our investors, and really thank them for their confidence. I think incorporating the company and getting listed in just about 7 years, somebody was telling me in the morning today that it seems to be like a first company to have achieved that. We are really thankful to God and all our customers and partners. But life will go on, huge milestone, but I think the journey continues.
Okay, I won't press you on the exact numbers, but sir, the industry has been growing at about 18%, 19%. You've been growing twice of that, at least if we take the recent numbers. Just wanted to ask you, could that kind of outperformance continue for the next few years to come?
Yes, I think, as I said, we don't give any guidance. We honestly don't know. And as I said, we look at things slightly more from a long-term perspective. If we see opportunity to grow significantly faster, we will. If we don't see opportunity to significantly grow, that's it. But we will do run business what we think economically makes sense. And I know pressures of stock market and guidance all is there, but we just don't do that at all, Yash.
Okay. So it's a 7-year-old company, as you also mentioned. There is a lot of investment when it comes to distribution in terms of digital infrastructure because, of course, it's digital native in that sense. Could the underwriting losses, at least for a few more years, continue because investments could be higher? And how soon do you expect to reach that break-even point as far as underwriting level is concerned?
I think both of us will have to go to an astrologer for these answers. As I said, we don't believe in doing any forward guidance. And being listed today, I think it's a promise I've made to myself. I'm not going to violate that today or going forward. I wouldn't want to comment on any of that because, as I said, 7 years back, somebody would have told me that, in 7 years, as we are starting issuing our first policy, and we'll actually get listed. Not even 7 years. We issued our first policy in October. 6.5 years we'll get listed. I wouldn't have believed it.
Correct.
So life is, I think, full of surprises and also some unpleasant surprises. I think we're prepared for both. And in the long term, I'm sure our country will do well. Companies will do well who really think long term. And that's where we see Digit to be.
Last couple of questions, sir. Motor right now contributes 60%. Non-motor contributes 40%. A lot of analysts see that as a risk because if something goes wrong in motor on the pricing or on the industry, it could take a bigger impact on the company. Do you see more diversification coming onto the product portfolio, moving a little away from motor and entering other segments like health and so on and so forth? And what is the ideal product mix that you would aspire to have in that sense?
So, Yash, I think in all my investor meetings and analyst meet, I say I've been in insurance for 36 years, worked in many countries. In my understanding, there's no ideal product mix. In my understanding, there's no ideal channel mix. What is profitable today might not be profitable tomorrow. What is unprofitable today might be profitable tomorrow. So we don't believe in having any of this. If motor offers more opportunity, we become 95% motor again, we won't mind. If motor is not offering opportunity from 60, if we go down to 20, we won't mind. Because all this will depend upon the opportunities we see in the market. And that's the message I think I've been also conveying.
Okay. On the geographical distribution side, about more than 55% of the revenue comes from 3 states. God forbid if there is a large catastrophe incident in any of these states, it could have a bigger impact on the company. In terms of your increasing geographical reach, the next 2 to 3 years, how do you see that panning out?
I think in geographical reach, the only comment I'll make is that you could have some very large industrial business groups who have assets all over India. Say somebody is in solar or power plant and they have assets all over India, but their head office is in Mumbai or somebody's head office is in another state. And all the business of all the assets which are there gets booked in one particular state. So I think this geographical spread to a large extent comes out of this. It's not really that the assets are also allocated or located only in this top 3 states. That's the only thing I have understood about this business, and that's the answer I can give you, Yash.
One big trigger for motor is going to be, the freeing up of motor third-party rates, which continue to remain regulated. If that happens, you have 60% of your portfolio coming from motor. How much would it help a company which has a high concentration on motor and is growing at a very strong pace?
I think as a company, we believe in freedom in pricing, freedom in product design. So anything regulator can do to make this pricing freer is more than welcome. I think a bigger challenge for the industry is that in the last 4 years, we have only seen price increase in 1. So while the Motor Vehicle Act itself provides for minimum compensation going up by 5%, I know there is inflation. So I think in my personal view, I feel that time has come either regulator to really look at the pricing seriously or if they have any compulsions, just to make it free pricing and let the market decide. But having in this situation where you are controlled but the pricings are not increasing, I think it's a slightly difficult place to be in.
Right, interesting conversation coming in from the management of Go-Digit. Recent listing opened slightly subdued and thereafter has kept its pace up and now up around 13% from its issue price. The stock at close to around 307 rupees. What we'll do is take a short break, come back on the other side. We'll speak about another big mover, albeit not in India. It's Nvidia, which has clocked in an unimaginable 600% growth in profits and guides for even a stronger quarter, much more than what most expected.
Across the board. And so is the vehicle industry going to, particularly the passenger car, 6 to 8%. So that should give us a good traction. The truck industry, of course, is a little flattish and will be a little flat during the year. It may have quarter to quarter up and down, but in the end of the year, it will land up more or less flat. The OEM I'm talking. I'm not, replacement market is different story. Replacement market is moving all right. And so that is the growth forecast for the industry. We are looking at maintaining the growth momentum and trying to work on about 8 to 10% increase in our sales in the year for 25. We had first done a place with the IFCI, 240 crores, and another 500 crores with the QIP this year. And the two together, our debt has come down substantially by nearly 18% during this year. Our net debt has come down by 18%, and our debt equity now stands at 0.85 to 1. So, in fact, we are quite happy about our debt. And that is absolute number of debt is nearly 3,100 crores. So that's where we are, and we hope to maintain a better debt profile continually.
We are diverging to Bangkok.
Back on halftime report and on to some action from the US. And AI favorite Nvidia reported strong first quarter results, actually very strong first quarter results. The company is guided for a revenue of $28 billion in the second quarter. The stock has crossed the $1,000 mark after a 6% gain in extended trading and is now the third most valuable company in terms of market cap. Rima is here with more. Rima, over to you.
Thanks so much for that, right? What a blowout quarter it's been for Nvidia, cementing its place as a tech powerhouse and a leader of the AI chip revolution. Now look at those numbers. The company has reported a revenue jump of 268% and a profit jump which surpasses 600%, beating even lofty estimates. With this kind of a performance, yesterday in after-hours trading, the stock surged 6% and finally crossed that 1,000 rupee mark for the first time ever, taking its market capitalization to $2.5 trillion. In fact, the market capitalization of Nvidia has surged almost 4 times since January of 2023. We're talking 18 months ago. And if you go back in time, its market capitalization was a mere $150 billion in January of 2020. This is nothing short of absolutely stunning, miraculous. And with this swelling of market capitalization, Nvidia is the third most valuable publicly traded company after Apple and Microsoft. And to give you another stunning statistic, Nvidia's market capitalization, if you consider the after-hour close and its market cap at $2.5 trillion, is more than that of Tesla and Amazon combined. Well, what's driving it up are real hard numbers. Its revenues rose quarter after quarter by close to about 18%. And as we said, on a year-on-year basis, it was up to 60%. Its 3-year revenue compounded annual growth rate, the 3-year CAGR, stands at a whopping 66.2%. Its gross margins are 78%. Its operating margins are 65%. And its EPS, if you look at that EPS, it's exploded from a mere $1 for so many of the preceding quarters. In the latest quarter, it stands at over $6. Its dividend has increased by 150%, and not just that, the company companies also announced a stock split of 10:1. And to top it all up, its Q2 guidance has also topped lofty expectation at $28 billion. So it's no wonder that 90% of the analysts who track Nvidia have a buy call on it. And the highest target price on the street is by HSBC at 1,350. And here's also something interesting which caught my eye, which came out from the earnings call. The company told analysts about a new area that's rapidly growing as an opportunity for the company, sovereign AI, which basically means that many nations around the world are building up their own domestic computing capacity as data privacy concerns come into focus, and this is contributing to increasing demand for Nvidia's product. Now, sovereign AI is emerging as a growth driver. In fact, one of the examples shared by the CFO in the call was that Swiss.com, which is majority owned by the Swiss government, has recently announced that its Italian subsidiary will build Italy's first and most powerful Nvidia-powered supercomputer to develop the first LLM, large language model, natively trained in the Italian language. And this sovereign AI, could take place and, capture many of the other countries as well. So the CFO said, the importance of AI has caught the attention of every nation. So from nothing in the previous year, they believe sovereign AI revenue can now approach high single-digit billions this year. Back to you.
All right, so that's the big move that we've seen on Nvidia. Blowout quarter, but the last few quarters have been blowout, and the big move that we've seen in the stock price, as Rima pointed out. Thanks a lot for interesting nuggets out there, Rima. Take a short break, come back. We get you the management of Sun Pharma on their Q4 earnings, the top Nifty loser today. Stay tuned for that.
Iranian President, 63-year-old Ibrahim Raisi, has died in a helicopter crash. Raisi, along with Iran's Foreign Minister Hossein Amir Abdollahian, East Azerbaijan Governor Malik Rehmati, East Azerbaijan Imam of Friday Prayers Mohammad Ali Hashim, and security officials were on board a Bell 212 helicopter which crashed in the mountainous terrain of northwest Iran. The accident took place 30 minutes after President Raisi's chopper took off after the inauguration ceremony of Kiz Kalasi Dam on the Iran-Azerbaijan border. He was often referred to as the Butcher of Tehran by activists for being one of the 4 judges who oversaw mass executions of thousands of political prisoners in 1988 after the Iran-Iraq war. According to human rights organizations,
Back with us on halftime report, and the markets continue to do well. The Nifty continues to remain around 22,750, but there are plenty of movers in the broader markets. Pull up Bharat Dynamics, and that stock is up another 6% today, and it is up for the 8th straight day, Mangalam. It's up 50% in the last 8 trading sessions is Bharat Dynamics. It's closing in on the 3,000 rupee mark now. The IPO price was 430.
Don't lose sight of the fact that we're now just around 15 points away from a fresh record high on the Nifty, 22,782 as we speak. In fact, less than 10 points away. So that, the counter may perhaps come up for you right now. It's less than 10 points away from a record high for the Nifty. So what we'll do is actually we'll go across to the management of Sun Pharma, the top Nifty loser, speak about their growth plans going forward, and perhaps when we come back, we may have the Nifty closer to a fresh record high. Let's hear out the management of Sun Pharma.
So our revenue guidance of high single-digit growth of FY25 is based on all the businesses which are poised for growth. As far as the EBITDA margin guidance, we have not been given guidance on EBITDA for last couple of years at this point of time.
Okay, sir. So, just a follow-up question. Do you think that the high single-digit revenue growth that you're seeing, you think you're being a little conservative at the start of the year? Maybe you could go ahead and outpace that as far as the second half is concerned. And a follow-on question, you're expecting R&D spends to be quite high, especially when you're comparing it to FY24, almost 8 to 10% of the total sales. So where is the incremental spend going? Is it mostly going towards the specialty portfolio?
See, our guidance for FY25 on the revenue side factors in all the known factors and the business-related growth positions. With regard to the R&D spend, you will observe that it has been steadily increasing through the year, supported by incremental specialty R&D spend. In the current year, you have seen that FY24 overall R&D spend is about $380 million plus. Substantial increase from 26% to 39% overall increase has happened in specialty R&D. In future, we are expected to start more trials as our pipeline, and major part of R&D increase will be towards the specialty, and that's one of the factors why we are given the guidance of R&D spend between 8 to 10% of the revenue for FY25.
Thank you for that clarification, Mr. Murali. See, the other question that we have is especially when it comes to the US-based business. So do you expect further pricing pressure, or has there been an abatement as far as generic price erosion is concerned?
So as far as the US generics pricing environment is concerned, we always maintain it continues to remain competitive, and pricing is a function that's product specific.
Okay, sir. And now coming to the specialty products portfolio, by when are you looking to launch the specialty product for alopecia, FY25? Could you give us a more specific guidance for the launch timeline?
So we have maintained that we are on track for approval, post-approval launch. However, you should also factor in certain time for the pre-launch activities, which is very customary for an innovative product before launch.
So going forward, what is your guidance on growth in the specialty business in FY25? Do you expect products like Winlevi to further ramp up? And based on what we've seen in terms of sales, both on a quarterly basis as well as on an annual basis?
So I'd just like to give a context in terms of the global specialty business. For the full year, we surpassed $1 billion with a growth of about 19% plus over the previous year. And Sun Pharma is the only Indian pharma company with a substantial innovative business. The contribution from specialty business have grown from 7% in FY18 to 18% in FY24. And the business continues to grow at a healthy rate, which is about 19% in the current year. And our flagship product, Ilumya, which is the revenues about $580 million in FY24, also grew a healthy rate of 21.7% over the previous year. When you look at the specialty business growth in the coming years, we strongly believe that our key products and specialty is in the growth path. This will be supported by the new product launches, which is in the pipeline. We are also expanding our global specialty product portfolio to the geographical footprint across various other opportunities available. And that, as a result, as mentioned, the specialty business contribution to the consolidated group revenues will continue to inch up and increase.
All right, so that was the management of Sun Pharma. But like we pointed out, while the conversation was underway, the Nifty has gone ahead and hit a fresh record high. Not just that, also hit the 22,800 mark for the first time ever. It's a moment of celebration. Why do I say that? Because in the very recent past, we saw the Nifty go all the way up to 21,800. So from those levels, it's a near 1,000-point up move that we've seen. And not only has the Nifty moved higher, it's been led higher by one of its biggest underperformers, which is the Nifty Bank. So the Nifty Bank is doing well, up around 700 points. HDFC Bank is doing well. We've seen a big traction come by in all the other contributors as well for the Nifty. Case in point, something like an L&T, which has moved to the high point of trade with a gain of almost 3%. Infosys, we had the management, Salil Parekh, join us for a mega CNBC-TV18 exclusive. A decent weight on the index there as well, up around 1.5%. And Reliance, that too continues to do well. Steady 0.5% gainer since the morning itself. So no real draggers for the Nifty. The ones which are underperforming are the pharmaceutical stocks, which actually do not have as much weight on the index as well. So in cricketing terms, we can say all the top performers of the Nifty going out and getting great starts.
Absolutely in good form as well, right? Returning to form, if I can say that, because HDFC Bank has been one of the underperformers for the Nifty for most parts of this year. And all of them, Axis Bank, ICICI, HDFC, SBI, 4 among the top 5 contributors on the Nifty are the banking stocks. You can pull up the contributors list as well and you will get a fair idea of how the banking stocks are leading this charge on the Nifty today, on the weekly expiry day as well. So that is a decisive move on the Nifty that we are seeing courtesy the banking stocks. We'll get some more reactions going as well on this record high. There you can see that the Nifty Bank now heading towards 48,500, which is a bit of a resistance level as it was pointed out earlier. So some banking stocks leading the charge and the Nifty Bank heading towards 48,500.
Right, so let's welcome Gautam Shah of Goldilocks Premium Research joining in. Gautam, you've been fairly, bullish on the way forward for the market. We're closer to 22,800 now, a near 1,000-point rally from earlier lows. I remember you saying that if we don't close below 22,000 for a very long time, there could be a case for an up move. How much more could the up move be for those who would have missed out on the 1,000-point rally?
Hi, Magnum. Thanks for having me. Well, I think with what markets have done in the last 7 days, it's pretty clear what the market feels about the event ahead. And with the participation being as good as it can get, momentum being extremely strong, and in some sense, this new lifetime highs is without any major participation of 3 big heavyweights, which is Reliance, HDFC Bank, and the IT space. So it just tells you that the rally has been quite broadened out. And if these 3 pockets were to start doing well, which is my view, I think we are going to build up on the game. So as we get into the event, I don't think there is a case for major excitement or major disappointment. I think the market trend continues to be positive. We have our own local, tailwinds that are going our way. So I think we will see higher levels. Just stick to quality stocks. Do not overanalyze and just tag along. I think that's really the key takeaway.
Gautam, good afternoon. Thanks a lot for joining in. You last spoken to us last month and you had mentioned that a close above 22,800 would trigger a very sharp 5 to 6% move on the Nifty. Do you stick to that stance? You see levels of 23,000 and above very soon now?
See, if you look at the last 4 months, we've oscillated in the 1,000-point band of 21,800 to 22,800. There have been 3 or 4 attempts to break out, which did not work out. There were 3 or 4 attempts to break down, which did not work out. And as I highlighted earlier, this is typical consolidation after the kind of runaway rally that we saw later last year. But now I think you have just too many positives coming together with the elections and global markets doing well, China factor coming back, liquidity being very, very strong, and obviously the entire momentum of the market and the confidence of people. So keeping all of these factors in mind and obviously looking at the chart, I believe that this time we will definitely get past 22,800. And if it does happen, you could see a 5 to 700 point kind of a rally. It's not very large in percentage terms, but I think the real opportunity is still in the broader markets where one should be committed into.
Well, broader markets, as we speak, all through today's trading session, they were slight backbenchers in today's trading session. In fact, the mid-cap index is up just about 0.5%, even as the frontline indices are well above 1%, for the Nifty Bank above 1.5%. And you have the market breadth, which is still at an even keel, an equal number of stocks which are advancing and declining. Gautam, you did point out that the 3 heavyweights of the market have not done well so far in this rally. What also has happened is that this rally has happened despite the FIS selling in both the cash market, them having near record short positions in index futures, and the India VIX rising because of the event as well. So there are a lot of conflicting factors for the market. Despite the counterweight on the other side, the Nifty is moved higher. What happens when this starts to unwind? Will that be more than the 5 to 7% that you've spoken about? Or could there be a case of a bit of a melt up as well?
See, Mangalam, there are a couple of points that people need to understand. I think historically I have seen 4 elections, while being at the market. And every single time, 1 month before the election, you see a large rise in VIX. because there are people in the market, there are large institutions, large corporates who want to hedge their portfolios, and that's probably the reason, VIX has gone up. It's almost like an insurance that a lot of people have taken against their long side portfolio. So don't read too much into the FI, short positions that are there in the market. It seems more from a hedge perspective. But having said that, I think India VIX is now approaching a very important resistance in the form of 23 and then eventually 27. Historically, we've seen in the last 20 years that whenever we get into that band, VIX stops out and then we see a cool off. So what I see post June 4th is that the market is going to go back in a huddle in some sense, and we start looking at global markets for triggers. And I think FI selling has really not been a trigger, because if I compare today's bull market to what happened in the past, I think domestic liquidity has completely taken over. And I think this overshadowing is going to continue for months and months to come. So I think things are only going to get better, and we are not richly valued as yet. So I think if you put in all of this in context, the trajectory is up. Magnitude is still questionable.
One final question from my end, Gautam. By the way, just as we speak, the Nifty has made a new high of 22,837 now. Within just a few minutes, a 40-point move on the Nifty. But Gautam, since you were mentioning stick to quality stocks, I was just looking at the top gainers on the Nifty from the 3rd of May, which was the last instance when the Nifty made a record high. It's auto and FMCG are the prominent names, as you can see there. Britannia, Hero, Mahindra and Mahindra. Where among these do you find value, or is there any other sector that you find value now that the market is at a record high?
See, number one, this has become a value market. I mean, the concept of buying growth stocks at any price, I think, has not worked in the last 3 years. It's pretty clear. The market has shown us that in the last few years. And even now, the market is hunting for value. So I think the way I see it over the next 6 months, I think the value is in FMCG. Because it's a sector which has done nothing for the last 6 to 8 months. These are super quality companies. The management commentary is very, very good. And the charts are very well placed. So I'm actually betting for the FMCG index to move towards 50,000. So all the top stocks led by ITC and HUL should do well. This is followed by pharma, which we continue to like. And metals, every time I've been on your channel, I've spoken about it. And I think the best for metals is yet to come. So stay committed in just about every name in the metal space.
All right, FMCG, pharma and metals are the spaces to be in right now. Pharma's on the dip in today's trading session. Metals also a bit on the back foot. But from a long-term standpoint, rather the medium-term standpoint, Gautam believes that the next up move would be led by these three sectors itself. Gautam, always a pleasure speaking with you. Thank you so much for joining in. Congratulations to all the participants for a fresh high on the Nifty once again. 22,826 is where we are at. And as we're speaking about the Nifty itself, important to know that it's also a Thursday, which means it's a Nifty weekly options expiry. And ahead of that, if you just keep an eye out on the key indices today, the Nifty Bank has done extremely well. In yesterday's trading session, the FI has actually sold about 1,200 crores in Nifty Bank futures and bought about 600 crores in Nifty futures. So they were shorting the Nifty Bank, and that's where a lot of unwinding is taking place. The Nifty has done well, a record high for the mid-cap index as well, even if it is underperforming the frontline index in terms of the absolute gains that it is seeing today. The Nifty Bank yesterday closed exactly at the 50-day moving average, and from there it's moved forward and it's conquered the 20-day moving average. The key to watch out for now will be what HDFC Bank does. We've heard about HDFC Bank from Gautam, etc. But HDFC Bank has a very strong congestion between 1480 to 1500. Why do I say that? Because around 1485 and 1482, we have both the 20 and the 50-day moving averages. And at 1500, we have the 200-day moving average. Can the HDFC Bank stock cross past this crucial juncture? If it does so, then maybe we would see further up move on all the frontline indices. Just from an expiry standpoint, there was a lot of writing right from the word go at the 22,700 put on the Nifty and the 22,600 put, and also a lot of punt buying at the 23,000 call. That punt buying seemed like it was, perhaps done for the Nifty to cross the record high, and once it did cross the record high, maybe the street would see a bit of a melt up out there. So that's why we've seen a big up move in the premium of the 23,000 call as well at around 1.5 rupee a pop this morning. That's turned into 4.5 rupees itself. We have to look at the shots that we're seeing in a couple of these pharma names. Sun Pharma and Lupin really stand out, and which is where a lot of short positions are being added. But otherwise, the kind of up move that we're seeing in the market seems like may perhaps move a lot higher by virtue of short covering in both the Nifty Bank and a lot of the punt buying that we've seen at the 23,000 call.
A pretty confident commentary from Gautam as well, right? The best of the metals is yet to come, considering the rally that we've seen in most of these names like Hindustan Zinc and Vedanta and the likes. But good time to get a technical check in the market as well. Aditya Agarwala of Invest for Edu is joining in this afternoon. Aditya, good afternoon. It's a record high for the Nifty. 22,800 was a barrier. Now that it is crossed, 23,000, 23,200, what's the next levels you're watching out for?
Good afternoon. Thanks for having the show. Oh, clearly it's a day of celebration if you're a bull, and especially about 7-8 days back, markets were languishing around 22,000 and people were talking about a breakdown from 21,800. Now we're back at all-time highs. Definitely, there is momentum in the markets. We can scale past 23,000 on the upside, and 23,150 is what I'm eyeing for on the Nifty, and this could be a sharp one considering the kind of breakout that we are seeing in trade today. And clearly, I was listening to Gautam as well, and I think metal and bank will lead this rally. The setup of the metal index is clearly showing traction on the upside, and there is enormous bullishness in the entire metal pack. So I think banking too, after this sharp up move in today's trading session, should see a decent upside on the bank Nifty, closer to about 49,500 to about 50,000 on the bank Nifty can be seen. We are still some distance away from the all-time high on the bank Nifty, so it has to move in that direction for the Nifty to scale past 23,000 as well. Having said that, one should not lose sight of the fact that the VIX is also spiking up, and it will spike to levels of 30 as we come closer to the outcome, which is a usual case every election time. So keep an eye on that, because with this sharp up move, you can have bouts of profit taking as well. So don't be blindsided and just be super bullish. Yes, there is bullishness, and markets will scale closer to about 23,000. It's just about 150 to 200 points away.
All right, Aditya, thank you so much for joining in on this occasion and you are giving us a sense of where the market is likely to head from here on itself. It's a short conversation, but we'll continue it for another time, because we're also joined by Devina Mehra, who's the chairperson of First Global, joining in on the phone line. Devina, thank you so much for joining in. We've heard a bunch of bullish commentary that has come in, and it's also at these times where we need to, also not lose sense of perspective. Now that the up move has happened on the markets, where do you see the risks emanating from, and what kind of sectors would you still back despite the rally that we've seen?
Hi, I'm outside, so I can't see your screen, but I bet you have confetti and balloons and so on. But coming back to the market view, my view has been kind of twofold on two fronts. One is the medium-term outlook, where I remain positive, and one is like a 1-2 month volatility possibility, where there is still a possibility of some volatility. So as far as our PMS is concerned, we have hedged ourselves because we always err on the side of caution in case there is a big move, down move at any point. But since we remain positive on a 1-2 year basis, we are fully invested, so we are not in cash because you can't afford to miss out on an up move also. So that's broadly been the case. The other part, which I have been warning about for some time, has been the frothy end of the market. So we have largely steered clear of companies with, let's say, less than 5,000 crore market cap. So that's been the strategy, so as not to get caught out in those kind of areas, because a lot of new investors don't remember how much small caps can fall. The whole index fell almost 80% in 2008-9, fell almost 2/3 in 2018-19. So that's been the broad strategy. In terms of sectors, one sector which I've been speaking about for a long time has been capital goods and industrial machinery, where we've been overweight since October 2021. Most people sort of discovered it about a year ago. But the question now we ask is whether the run is over. We have cut back, but we are still overweight. Where we have been overweight last year and a half has been auto components, pharmaceuticals, some construction. So that still continues even after our rebalance in April. Where we have added in the last month and a half has been metal. So that's broadly in terms of sectoral themes that we are playing.
You know, Devina, we may not be having confetti and balloons right now, but the ones who would surely be having that are the ones who invested in PSUs since last year. What's your call there? Is there more upside left for the PSUs going forward, considering the election outcome and the hopes of continuing of the same government going forward?
PSUs actually, I mean, there are many diverse things in there. So right from the manufacturing companies to the banks to, let's say, the oil companies and all that. So I don't like to talk of it as one big lumpy thing, because our decisions are fairly sectoral and fairly company by company. As far as the election outcome is concerned, I don't think, that should be an overhang on PSUs, logically speaking, because, not many of your viewers may remember, they may be too young to remember, but 20 years ago, there was a big electoral upset when the NDA government actually advanced the elections by 6 months because they were so confident of winning. And then it was an absolute shock decision where most of the cabinet also lost their seats. And as you know, the market was circuited down, trading was halted. But the market forgot it in like a week's time, and that 1 year was among the best years in the market history. So I think we spend too much time thinking about elections and politics. The market has a logic of its own.
Take that point. Always good to hear the voice of reason and get a sense of perspective. Thanks a lot, Devina, for joining in, bringing us up to speed with all that has happened in the past and reminding viewers that equities, no matter the kind of move that we've seen on the upside, is still a risk asset. So better to err on the side of caution itself. Always a pleasure listening to you, even more so when the markets are moving the way they are. 22,830 on the Nifty. What we'll do is we'll take your leave on the equity part of the show right now. Come back on the other side. Manisha Gupta joins in with all things commodities.
.800 to 5,000 people were executed in this period. Raisi was a conservative hardline cleric who came to power in August 2021 after several candidates were disqualified from the election. Raisi's tenure was marked by an aggressive crackdown on women-led protests after the killing of 22-year-old Mahsa Amini. His government enforced a strict women's dress code and also increased uranium enrichment levels after US withdrew from the nuclear deal. Most recently, Iranian forces had carried out a retaliatory drone attack on Israel after 2 senior Iranian generals were killed by Israel in an attack on an Iranian consulate in Damascus. So what happens next? Iran's Vice President Mohammad Moghbar will now take over as the interim president. Moghbar is known for close ties to Iran's supreme leader Ayatollah Khamenei. He will be president till elections are held within 50 days. President Raisi was expected to succeed Iran's supreme leader Ayatollah Khamenei. Now, after Raisi's death, Khamenei's son Mojtaba is seen as a top contender to replace the supreme leader of Iran. But one thing is for sure, and that is Iran will see a period of political turmoil and internal power struggle. However, one thing is for sure, and that is Iran's politics, their view on international affairs, the war in Gaza and approach to Israel is not going to change. India, which recently renewed the 10-year-old Chabahar port agreement with Iran, will be watching developments very closely. Iran is the third largest oil producer in OPEC and produces 3 million barrels of oil per day, or 3% of global output. A formal inquiry will now take place to investigate the cause of crash, which is being attributed to bad weather at present. Several world leaders, including Prime Minister Modi, have condoled the death of the Iranian president and foreign minister, and they have said they stand by Iran in this hour of crisis. According to reports, Israel has denied any role in this crash, and experts say at this juncture, any foreign interference looks unlikely, as it would also amount to an act of war against Iran.
Welcome back, and joining us on the show now is Peter McGuire. He's CEO, Exim Australia. Peter, hi, good to have you. And while the Indian equity markets are making higher highs, we have seen commodity markets actually see a bit of a pause. We're looking at some healthy profit taking, if I can call it that. But I do want to start with metals as a sector, where we've seen copper prices come off quite sharply, almost 3% off from the kind of all-time highs that we saw it touch within this week itself. How are you looking at the US Fed meeting minutes yesterday and its impact on overall commodities as a sector?
Well, good afternoon, Manisha. Congratulations on the Nifty. And I tell you what, it's very, very exciting to look at it from, Australian lens. If I look at the base metals, and yes, I think they were exhausted to the upside. They were very, very strongly bid up over the last couple of weeks when you're looking at what you've seen as far as copper, nickel, lead, zinc, tin, all of them really, really strongly bid up. And they've just given up some of those gains. And where I look at the minutes, and as far as the Fed's concerned, it's still waiting to see. There's no real action plan in the sense of when we're going to see rate cuts. I think we're just sitting here from a timeline perspective. September's pretty much the thought in mind. And are we going to get, another rate cut later in the year, or is one going to be it before the election? So there's a lot of water to pass under the bridge between now and then, Manisha.
So at these current levels, what's your sense, Peter? Would you say some consolidation is on cards right now, or are these buying opportunities?
I think I wouldn't be surprised for a little bit further softness, and then I think they'll bounce again to the upside. So like anything, they give up those gains. I noticed you're looking at the best part, aluminium 3% and a bit down, zinc 2% and a bit, copper was really spanked hard. So yeah, look, it's not unusual to see those big wipeouts. But, it's just a time of, the bears were in. It was probably very short-term trading. And that's where you've got to trade that market. You've got to be mindful that, you can't take your eye away from the wheel.
No, you can't do that. Well, yes, yesterday was a 1.3% of a decline in the New York session, and the Asian markets are down 1% and more right now. So there is this follow-up sell-through that we have seen happen in the second time zone as well right now. And it's not just about the base metal prices, Peter, because gold has gone down. Silver as well has given up huge amount of gains. How would you look at silver to begin with?
Well, I think that's probably a good time to buy, Manisha. It really shot to the upside, through $32 odd. On the COMEX. So I think that probably at current levels, it's showing a good opportunity. I still feel as though that the best time is going to be ahead of it over the 2024 window. So as we roll into election time and plenty of other concerns as far as dollar and equity markets and so on, I think the flight to safety is going to be one of, gold and its little brother will be the place to be. And it might be a time to buy at the moment.
So when for the base metal prices, Peter, when you say that there is some more correction on the downside that could be remaining, so approximately what percentage on the downside are you anticipating?
Oh, I think a couple more percent, Manisha. I wouldn't be surprised, to let it, let a bit of more hot air out of it. It'll bounce, but it's normally, you see that sort of move when it's so strongly bid up. It can wipe out, 5 or 6%, and then it just gets a floor and then takes a deep breath, and then off it goes again to the upside. So it's not unusual. It could be a point in time that it's going to be choppy. But the time to be in the market was probably over the last couple of months. It's shown incredible uptick. And but I think there's certainly more upside than downside.
All right. One final question then, Peter, and this is about the crude oil prices. Most of the oil marketing companies in India are doing well, and that is because the crude oil prices have corrected quite a bit in the last 2 or 3 sessions. Are you looking at more correction? Do you see 80 giveaway for Brent?
Well, you run at about 81.50, 81.60 at the moment, Manisha. I wouldn't be surprised to take it another little bit down. It'll find support, I think, around that $80.50 sort of mark. And until we get some sort of clear indication as far as geopolitical or something else to drive the markets higher, I think it'll consolidate at this sort of number at the moment. But keep an eye also on US dollar index.
Well, yes, that is one thing to watch out for. The dollar index as of now just about holding below that 105. And that is one of the reasons that you have seen this pressure come in for many of these dollar-denominated commodities. But as always, Peter, thank you so much for joining us and making sense of what really is happening in the international commodity prices there. But with that, that's all the time that we have on Halftime Report. Business Lunch will take all the action forward.
artificial intelligence, that's the buzzword echoing across the world, and companies only expect to see explosive growth in the sector over the next 10 years. So where does India stand today, and what has been the rate of adoption? EY is addressing exactly that question in its latest report. India's legacy businesses are treading with caution, but startups and global capability centers are taking the lead in AI deployment. An online analysis of the publicly disclosed adoption of AI and Gen AI by India's top 50 most valued Indian unicorns shows that 66% are already using AI or Gen AI technology. This indicates that startups have been more proactive.
Market scales fresh peak in afternoon trade. Nifty rises above 22,800 for the first time ever. Sensex reclaims the 75,000 mark, and rally is fueled by big gains in banks and mid-cap index also at record highs today.
The RBI doles out a record 2.11 lakh crores to the centre for FY24 from the surplus. The largest, amounting to 0.3 to 0.4% of GDP, can help the government trim its deficit or boost spending. How will the government use this money? That remains the big question.
Sun Pharma slips after it guides for single-digit growth in FY25. Lupin slides on new competition in a key drug, while HEG drops as margins crimp. But Cardin Reach Shipbuilders and PG Electroplast jump on posting heady growth in sales as well as profits.
Infosys CEO Salil Parekh tells CNBC-TV18 the IT major has moved from proof of concepts to executing AI projects, and 6 out of 8 employees are being trained on an AI in anticipation of its spread. He also points to a pickup in financial services activity, even as there's no noticeable rise in discretionary spends.
And Nvidia clocks an unimaginable over 600% growth in profits and guides for a stronger quarter ahead than most expected. The $150 billion in 2020 company turned $2.5 trillion enterprise in 2024 has now set its sight on the AI needs of governments as its new growth frontier. Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar. With me, as always, is my co-anchor, Sonia Shenoy. Hi, Sonia. It's
Hi.
after many days of turbulent market, listless market, volatility. Today, we are seeing a one-way rise, and what a record-smashing day it has been.
Yes.
And one more thing to really point out is that the FII sell-off, that has been one of the concerns for the market. So a large part of the momentum has been also driven by our own investors, the domestic institutional investors, who continued buying despite the volatility. Many factors at play, but election uncertainty is something that was really bothering the market. So today's momentum is clearly important. Over 1% up on Nifty as well as Sensex. At the moment, Nifty is gaining over 230 points above 22,830 levels. Bank Nifty and the bank's financials, blue chip banks, are the ones which are really driving the growth, outperforming the key indices. 1.7% up in trade, and mid caps are slightly underperforming to the key indices, but there is a good showing of closer to 0.5% of gain, and that is also seen in the advance decline ratio, which is slightly in favor of the advances there. No point talking about the individual names except for some of the ones which are pressured because of news developments, especially the high beta metal stocks. They are not doing that well, and Sun Pharma because of a weaker guidance, Sonia.
Absolutely. I mean, what a day today, right? And you know, the record high assumes even more importance today because of the kind of rally we've seen in the month of May. So if you just pull up a 1-month chart, right, you'll notice that from the lows in May, somewhere around the 9th, 10th of May that we hit that low, the market has rallied. There you have it. The market has rallied 830 points just from the lows of May. So it's been one hell of a ride this month. Very, very volatile. But the important bit is that this is an out-and-out bull market. This is a market where every dip is getting bought. Most global and local investors are bullish on India. Give and take, of course, a lot of the election volatility, but most experts are also waiting for the event to move out of the way before the next leg of an up move. So very, very good day for the market so far. And of course, the RBI dividend was the cherry on the cake today. So that was the big positive as well. But let's talk about that. The RBI has announced a record annual dividend of 2.11 lakh crores for the government. This is a bonanza for the government, which had budgeted just over 1 lakh crores, and the payout is double of that amount. This dividend is nearly 3 times higher than the 87,000 crore rupee payout in FY23. In a conversation with CNBC-TV18, Finance Secretary TV Somanathan comments that the RBI's dividend will prove to be beneficial for the government and will pragmatically take future steps with regards to the fiscal policy. Listen in.
Cash is a short-term thing. The revenue is important. Cash will fluctuate based on expectation. Cash is not something which can be managed, or I can't tell you how cash will be managed. But I can tell you that this dividend is good for the revenue of the government. It's good for the fiscal position of the government. It's always good. All revenue is welcome.
All right, record dividend by the Reserve Bank of India, one of the key factors today. Let's also listen into some of the opinion that's coming in from a host of experts on this record dividend from the RBI and what does it really mean for liquidity, for the July budget, math and more on that. Listen in to some key opinions.
The immediate impact with respect to market liquidity is, of course, nothing. This is going to come with a lag. And the amount that is done, I mean, look, you can think of the budget both in terms of cash accounting as well as accrual accounting. So it doesn't really matter whether it falls under the 24-25 budget or the 23-24 budget. If we were going to have shortfalls in other sources of revenue, this certainly acts as a balancing factor. So therefore, it's a piece of good news as far as the fixed income market is concerned when we are looking at from the supply of bond perspective. So from what I'd like to see, as a former, I'm a fiscal economist, of course, I would like this surprise addition from the dividend to be used as a saving tool as opposed to accommodating expenditure.
We were putting out in our notes saying that there is a possibility that the RBI dividend will be significantly higher than what the government has budgeted for. And so that way, it's not that big a surprise for us. Yes, it means that the government has 3 options in some sense. One is that it can reduce the fiscal deficit, 0.3% of GDP, as you mentioned. What the initial thought process was that the government will do only somewhat marginal tweak to the interim budget numbers because the interim budget itself was quite detailed. Now, with this more than 1 lakh crore extra kitty, the budget maths will have to be reworked and it will become very interesting and the market will keep on speculating till it's actually announced.
It's a substantial fiscal bonanza that has come in. We think the government could therefore choose to reduce the deficit marginally when it presents the final budget in early July, which is what we're expecting, but also leave some cushion for any unexpected shifts that might happen on the revenue and the expenditure side. This is actually going to add to the cash surplus that the government is sitting on. This could very well go, above 5 trillion INR, and therefore some sort of a reduction in the borrowing, could happen. Again, the details of this are likely to get announced in the budget. And as Somaran was saying, it's really positive from a demand-supply environment. So our own forecast is that the 7-year as well as the 10-year bond yields could drop to 6.75%.
Okay, well, that's the big macro development. But pharmaceutical major Sun Pharma is the top Nifty loser after the company's revenues came in below estimates. The US sales also missed street expectations. However, the margins came in better than expected. The group CFO, CS Muralidharan, spoke to CNBC-TV18 about the company's guidance for FY25 and the steady increase in R&D spends. Let's listen in to excerpts of that conversation.
So our revenue guidance of high single-digit growth of FY25 is based on all the businesses which are poised for growth. As far as the EBITDA margin guidance, we have not been given guidance on EBITDA for last couple of years at this point of time. See, our guidance for FY25 on the revenue side factors in all the known factors and the business-related growth positions. With regard to the R&D spend, you will observe that it has been steadily increasing through the year, supported by incremental specialty R&D spend. In the current year, you have seen that FY24 overall R&D spend is about $380 million plus. Substantial increase from 26% to 39% overall increase has happened in specialty R&D. In future, we are expected to start more trials as our pipeline, and major part of R&D increase will be towards the specialty, and that's one of the factors why we are given the guidance of R&D spend between 8 to 10% of the revenue for FY25. We mentioned in yesterday's call also, we believe that these are some site-specific issues. We are working to address them in due course. After we have completed the entire remediation work, the facilities will be presented to the FDA for re-inspection. That's what I said, that once we complete all the remediation work, which is ongoing, we will definitely invite the FDA for a re-inspection of these sites.
All right, so that was from Sun Pharma, and actually the pharmaceutical space is in news today. But before that, an important news flash on your screen, and that has impacted Jio Financial Services stock as well. It has seen a sudden upward spike, so keep an eye out on that. They seek shareholders' nod for foreign investments up to 49% of equity, an important piece of development there. And of course, the shareholders' nod will be required. The stock is up closer to 5% in trade at the moment. Now, we have some news flow also, which could be negative for two pharma companies, Lupin as well as Cipla, as there is competitor for some of the drugs. Vivek has more details on that, on how these two companies could be negatively impacted. Tell us, Vivek.
Well, good afternoon. So two companies that we are tracking, number one is Lupin and the other one is Cipla. So what's actually happened overnight is that as far as one very key drug is concerned, a US-based company, Amphastar Pharmaceuticals, has received the US FDA approval for albuterol sulfate inhalation aerosol, mainly used for any kind of worries that the patient may have in terms of respiratory disorders. Now, this is a negative read-through as far as Lupin as well as Cipla is concerned. Remember, albuterol is actually the second largest revenue contributor to Lupin as well as Cipla's US revenue base. And what most of the analysts, as well as what Citi is saying, is that the new player that comes in, while number one will take away market share from the incumbents, there is also the worry that the new player will resort to significant price erosion or significant price cuts to the tune of almost 15 to 20%. And this is something that the street is worried about. In fact, what Citi says is that albuterol HHA and the product is one of the top products for the company's US basket for both Lupin as well as Cipla. Lupin is slightly more impacted, and incremental competition may have some negative impact. On the back of that, Lupin under significant pressure, Cipla still holding out.
Okay, thanks a lot for that. Well, on to a CNBC-TV18 exclusive now. Infosys is working on 200 generative AI projects, says the MD and CEO Salil Parekh. Adds that the IT major is looking at acquisitions in SaaS and maintains FY25 constant currency revenue growth guidance at 1 to 3%. Listen in.
Working today on 200 projects, but as we go through, as the economic environment changes, we see more and more of this coming to organizations. As the economic environment changes, both for cost efficiency, but also for customer connect growth, generative AI is going to be more and more spreading in large organizations. 6 out of 8 employees at Infosys are getting trained on generative AI and artificial intelligence technologies in different levels, because there are a large number of these new models and there's different ways to work on it. What we are seeing, we were a few quarters ago doing things which were more like proof of concepts. Today, these are actual projects with clients where they're seeing the benefit. And that's a huge change. And we see every client discussion a combination of that. The discretionary spend, we've not seen a change at the end of Q4 or at the start of Q1. So we will wait and see how that plays out. And based on that, we will see what the environment for recruiting is and what the environment in the future is for digital transformation. Generally, the discretionary spends approach looks similar at the end of Q4, start of Q1. We'd also said on financial services, we see a little bit more activity than we'd seen in Q4. We're looking more in spaces which are related to that. So, for example, we look at engineering services, we look at some other SaaS areas, we look at geographies as well. There are various geographies around the world which are doing well, and we're looking at those as a expanding footprint. Very clear with the guidance was 1% to 3% on a constant currency basis, the growth. We will, of course, relook at the guidance at the quarterlies at the end of it, so we'll come to it in a few weeks. But at this stage, we confirm the guidance at 1 to 3%. What gives us comfort for the 1 to 3% guidance really is one, the large deals, which was really exceptional, so that gives us a foundation. Second, we see the discretionary spend has remained about the same, which has not become worse, which gives us some comfort. It's not changed to positive, but it's the same level at the end of Q4, start of Q1.
All right, some very important comments coming in from Infosys, and the race for the tech companies will be to capture the AI market. With that, we'll slip into a short breather on Business Lunch, but when we return, we get you all the highlights from NVIDIA's fantastic first quarter earnings. Stay tuned for all the details.
AI technology versus your legacy players. Now let's take a look at some of the most implemented Gen AI use cases among India Inc. 1/3 of them use Gen AI to execute point tasks using intelligent assistants, while 25% relate to marketing automation. In fact, this quarter has also seen a diversification in investments going into firms using Gen AI or AI applications. However, the report highlighted that hallucination of LLM or large language model responses, data privacy and sovereignty, and the cost implications of deploying Gen AI in production are the top issues. Meanwhile, another report by TCS lists out the same concerns with generative AI, but delves deeper into the kind of impact artificial intelligence can have on the economy. The report, which interviewed over 1,300 CEOs, looked at the potential of AI for business and how it compared with the past disruptive techs like internet and smartphone. While 54% believe the impact would be greater or equal to the internet, 59% say that it would be greater or equal to smartphones. The study also found that 49% of those interviewed expect AI to have no impact on the number of jobs created, while 47% expect more roles to be eliminated than created. Finally, a report by Microsoft and LinkedIn found that an overwhelming 92% of those surveyed were already using artificial intelligence at work versus the global average of just 75%. The survey, which included 31,000 people across 31 countries, also found that 91% of Indian leaders believe they need to adopt AI to stay.
Welcome back. Still a very, very good looking screen. Just look at that, 213 points higher. There's no stopping this rally right now. And the best part is it's across the board. The banks are participating. The bank Nifty, in fact, is up 700 points as we speak. And the Sensex is just, kissing distance away from that record high. But to some important opinion now, JP Morgan Chase CEO Jamie Dimon sees huge opportunities in markets like India, Japan and Singapore, and adds that he continues to remain cautious about the Fed, the impact on equities and more. He spoke to CNBC on the sidelines of the JP Morgan Global China Summit. Listen in.
So 40% of our Asia business is China and Hong Kong. That means 60% is not. Huge opportunities in India, huge opportunities in Japan, Singapore, Southeast Asia, et cetera. We've been in most of those countries for 75, 100, 125 years. We've been in Asia for 150 years. So, to me, the way, and each country is different. So I really don't like talking about Asia as one. They have different laws, different customs, requirements, different trade, different needs. So we just keep on investing in each one. But those opportunities are going to be big for a very long time period. And Asia will be growing faster than the rest of the world. So, that is still true. It was true before. It's still true today. When we look at risk and rates, we don't always look at guessing what the future is, kind of look at the range of outcomes. Do I think that rates can go up a little bit? Yes, I do. And if they do, is the world prepared for it? Not really. Okay, so I think Could inflation be stickier than people think? I think the odds are higher than other people think, mostly because the huge amount of fiscal and monetary stimulus is still in the system, and it's still maybe driving some of this liquidity you see, markets going up, prices of certain assets, stuff like that. So I'm just in the cautious side. Now again, I'm usually cautious, so maybe that's my normal state of affairs, but put me in the cautious side in this one. The world said it was going to stay at 2% all that time. Then they said it was going to 6%. Then they said it's going to go to 4%. It's been 100% wrong almost every single time. Why do you think this time it's right? So I look at the range of outcomes. And again, the worst outcome for all of us is what I call stagflation. Higher rates, a recession, that means corporate profits will go down. And we'll get through all of that. I mean, the world will survive that. But I just think the odds are a little bit higher than other people think.
All right, some important global development then in the global markets. Nasdaq and S&P 500 futures climbed after AI favorite Nvidia reported a blowout first quarter earnings, and the company's first quarter revenue rose 268%, while the profit surged over 620%. In fact, Reema Tendulkar is right here to give us a quick roundup of those numbers and the stock move and the surge in the company's market cap over the years and more. Tell us, Reema.
Thanks so much for that. So AI tech giant Nvidia has reported a blowout quarter, cementing its place as a tech powerhouse and a leader of the AI chip revolution. And these are the numbers. Record revenues, record profits. Revenues have gone up by 268% year on year, and profits have gone up 628%, surpassing lofty estimates. And with this kind of a performance, yesterday, the stock surged 6% in after-hours trading to cross the $1,000 mark, taking its market capitalization to $2.5 trillion. In fact, the market capitalization of Nvidia has surged 4x since January of 2023. And if you go back in time, its market capitalization was a mere $150 billion in January of 2020. And now we're talking about $2.5 trillion. This is absolutely nothing short of stunning and miraculous. And with this swelling of the market capitalization, Nvidia is now the third most valuable publicly traded company in the United States after Microsoft and Apple. And to give you another stunning statistic, Nvidia's market capitalization, if you consider the after-hour close rise, the market cap of $2.5 trillion, it's more than that of Tesla and Amazon combined. You know what's driving it up are real hard numbers. First, on this quarter's performance, right? Revenues up 18% quarter on quarter. Profits are up close to about 260%. Its three-year revenue compounded annual growth rate. The three-year revenue CAGR has accelerated to 66%. Its gross margins are 78%. Its operating margins are 65%. And look at the way the EPS of this company has exploded. It was a mere $1 odd in the preceding quarters, and this quarter it shot up to $6. Its dividend has increased by 150%, and not just that, they've announced a stock split of 10:1. And to top it all up, its Q2 guidance has also topped lofty estimates at $28 billion. So it's no wonder, it doesn't come as a surprise that 90% of the analysts who track Nvidia have a buy call on it, and the highest target price is at $1,350 by HSBC. And here's something interesting which came out of the earnings call yesterday. The companies told the analysts about a new area that's rapidly growing, sovereign AI, which basically means that many nations around the world are building up their own domestic computing capacity as data privacy concerns come into focus, and this is driving increasing demand for Nvidia's products. So sovereign AI is now emerging as a growth driver for the company, and this is what was shared as an example by the CFO in yesterday's call. They said Swiss.com, which is majority owned by the Swiss government, has recently announced that its Italian subsidiary will build Italy's first and most powerful NVIDIA-powered supercomputer to develop the first LLM, large language model, natively trained in the Italian language. So the importance of AI has caught the attention of every nation, and from nothing in the previous year, sovereign AI, they believe the revenues from sovereign AI can approach high single-digit billions this year. Back to you.
Okay, thanks a lot for that. Well, that's the move on Nvidia. Remarkable, really, the kind of performance that this company has seen over the last many quarters. But more news and updates to follow on the other side of the break, so do stay tuned in.
However, 54% worry that their organization lacks a clear plan and vision for AI implementation. Despite this, employees are eagerly embracing AI tools, with 72% of Indian AI users bringing their own AI tools to work. 75% of Indian leaders stated that they wouldn't hire someone lacking AI skills, outpacing the global average of 66%. The report, aptly titled AI at Work is Here, now comes the hard part. It says that AI is transforming the world of work, reshaping talent landscape, and nudging both individuals and organizations to embrace change.
So the big question that we are asking is the worst over for the chemical sector? Is the worst behind? Now, there has been few brokerage reports in the last few days where they've turned a bit bullish on the chemical sector. But if you look at the management commentary post Q4, most of the managements do believe and they have a mixed feedback, and they expect the recovery to be in the second half of FY25. And even when there is a recovery, it's going to be volume-led and not price action. So the margins could still be under pressure even in the second half of FY25. That's a management commentary. But look at the chemical as a space. There has been short-term pain for the chemical sector stocks, but over a longer-term period, they've been massive wealth creators. The next table will show you what I'm saying. Over the last 2 years, most of the chemical stocks have been under pressure. Aarti is down 12%, Atul is down 28%, Navin Fluorine is down 14%, and so is Vinati down 12%. But over a 10-year period, they've been massive wealth creators. Same is with UPL.
Welcome back. You're watching Business Lunch. A quick look at the market. What a record-breaking day it has been, and the momentum really carries on. Nifty 50 at this point, 22,855 odd levels, over 1% comfortably and rising high. Two of the big heavyweights are continuing their momentum and contribution to Nifty 50, Reliance Industries as well as HDFC Bank. Those two heavyweights are at their peak at the peak of their trading day today. So keep an eye out on that, and Bank Nifty also doing very well. So Sonia, it's a good day of trade today. And
absolutely. I mean, there's no questions about that, right? 75,000 on the Sensex for the first time ever. Big milestones getting hit, and in 800-point rally is what you're seeing right now. No complaints at all, Nisha. So it's a great afternoon on Dalal Street, but that's all the time we have on Business Lunch. Thanks a lot for watching. Midcap Radar comes up next.
On 35% in the last 2 years, but it's gained 15%. But there has been some notable winners as well in the last 2 years. PI Industries has been the best performing chemical stock over the 2-year period, up 54%, despite the fact that it's been a 30% CAGR over the last 10 years. Deepak is up 25%. Again, that's a big wealth creator. So is Tata Chemicals, and SRF marginally up in the last 2 years, but there's been a big recovery over a 10-year period. But look at the valuations now. The 1-year picture, 1-year forward earnings will show off for you. SRF is trading at close to 37 times. PI is trading at close to 30 times. UPL is trading at close to 19 times versus 5-year average of just 12.5 times. Deepak is at 32 times. And so is Tata Chemical trading at close to 27 times on 1-year forward. Even if you look at the other names like Aarti, Atul, Navin and Vinati, all are trading between 35 to 45 times on a 1-year forward. So earnings-wise, so in terms of valuations, they're still not very cheap. Purely going by the valuations, looking to the 10-year averages. But as I said, some of the brokerages have turned positive on the chemical sector. UBS put out a note on the chemical sector. They say that the investors may be ignoring some strong niche positions and growth opportunities within the sector. They are seeing some modest volume recovery for many of these companies, and hence they initiated a buy report on PI Industries as well as on Navin Fluorine. Interestingly, even Morgan Stanley put out a note on Deepak Nitrate a few weeks back, and they've actually double upgraded the stock to overweight now. They have a target price of close to 3,000. They see a potential 20-25% upside from here. But the key is that they believe that the earnings can double for this particular company by the next 4 years. So it's been a mixed feedback from a lot of analysts. But from a long-term perspective, chemical companies in India have been big wealth creators.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. from chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed. Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer as always. And the big news today, of course, is the fact that Nifty has hit a record high. We have the Midcap Index at a record high across all the major indices. It's a sea of green. So really nothing to complain for today at least. Bulls can heave a sigh of relief.
You're absolutely right. Nothing to complain, a lot to cheer, in fact. And, it's at a record high. In fact, we'll put out some data as far as the mid-cap index is concerned. Rally is quite breathtaking. But lots lined up on the show, so let's start with the headlines first. Market scale fresh peak in afternoon trade. Nifty rises about 22,800 for the first time ever. Sensex reclaims the 75,000 mark. Rally fueled by big gains in banks. Mid-cap index also at record high.
Lupin slides over fears of new competition in a key drug. This after US-based Amphastar gets FDA approval for albuterol sulfate, which is used to prevent and treat difficulty breathing, wheezing and shortness of breath.
GMM Pfaudler under pressure after the company's revenue declined 14% on a year-on-year basis. The management says the international business and Indian market face some pricing pressure.
Garden Reach Shipbuilders jumps after posting good Q4 numbers. EBITDA is up 3.5%, while margins have come in higher by 500 basis points at 8.9%. The stock surges in trade.
Q4 numbers boost PG Electroplast. The company reports revenue growth of 27%, while margins rise from 9.1% to 10.8%. The stock surges in the trading session.
Okay, all right. So, the fear was that maybe after touching those record high levels, the Nifty would retrace from those levels, but it has actually built on to those levels. So right now, we are comfortably above the 28,800 mark, and right now at that 22,850 mark, actually. The mid-caps are doing well, 0.4% higher. And in a market like this, we can say that mid-caps are actually underperforming. Despite that 0.4% of a gain that we are seeing, Bank Nifty is a star today, 800 points higher on the Bank Nifty. PSU Banking Index, that's the top gainer, and it's the banking space that continues to do very well. Pharma, CPSE, metal, FMCG and energy, these have come in for some profit booking, but again, there's nothing that bulls can complain about.
Right, and we've been highlighting for quite some time, about how the banking underperformance was something that was a bit of a worry. Today, that's come out. The market's gone ahead and scaled a fresh record high. In today's trading session, in fact, if you look at the mid-cap and the broader end of the market, there appears to be a slight underperformance. But, let's give some perspective as to how exactly the mid-cap index is done. And we're talking about just the last 10 trading sessions. In fact, the mid-cap index in the last 10 trading sessions has continuously gained and is up 6% in just the last 10 days. And when you're talking about the Nifty 500 or the NSE 500 index, that's up over 5% in just the last 10 trading sessions. So absolutely nothing to complain about as far as the broader end of the markets are concerned. But this is our special segment, Mid-Cap Movers, where we have Hormaz to take us through the mid-caps that are moving around in the session.
Well, we had some bit of inkling that this might happen today, courtesy the Nifty had closed at the highest point of the day yesterday, and we are building on to that now, and the broader markets as we speak are underperforming the Nifty, but it's been no complaints that the bulls can make. So we'll start off with the gainers. There are plenty of them within the broader markets as well, and PNB Housing at the highest point of the day now, 8.5% higher, very ably supported by CAMS. That Saregama is the one there outperforming, 12.5% higher now at 460 is Saregama, and Engineers India is having a good day for itself as well. The markets are at a new high or not, the PSUs will continue to do well, and those stocks continue to outperform today as well. Bharat Dynamics is up for the 8th day in a row now. It's up 50% in the last 8 trading sessions, 6% there. Cochin Shipyard continues to build on its post-earning gains. Masgaon Dock will report results today. IRFC is nearing a record high. It made a high of 191 today, and RVNL continues to gain from strength to strength as well. Plenty of earnings reactions from yesterday, and those stocks will come up on your screen. Gland Pharma A positive reaction to an otherwise subpar results. Garden Reach Shipbuilders, though, 16% higher at a record high, and GMM Pfaudler seeing a negative reaction to its earnings. Some stocks on the back of strong volumes, and they'll come up on your screen. And Sumitomo Chemicals is one of them. PNC Infratech, after yesterday's surge, is extending those gains on very strong volumes, as 4% higher, and GSK Pharma as well, another 4.5% on very strong volumes. But some stocks in an otherwise strong market that are bucking the trend. HEG, after the earnings there and the demerger that they announced, 9.5% lower for HEG. And Hindustan Zinc, after that gravity-defying rally that the stock had seen. We highlighted the concerns about the float yesterday, and it's down 6% in today's session. Sterling and Wilson, a 5% circuit there, and Deepak Nitrite also at the lowest point of the day, down 5%. Back to you.
All right. Okay. Thank you so much, Hormaz, for joining us with that list as always. Let's now welcome Jay Thakkar of ICICI Securities for a technical check on the markets. Jay, it's been a relentless rally, at least for today. That's what I can say. But what are the charts suggesting? Can we build on to these gains, or there will be some volatility ahead of the big day?
Very good afternoon to you, Sonal and Vivek. And first of all, congratulations to you, all the viewers of TV18, Nifty, and most of the indices are hitting the lifetime highs. So congratulations. And I think the way, Sonal, 22,800 has been taken off today with an increase in volumes. Clearly, a good support from the banking pack, which was not performing since a couple of weeks now. That is clearly showing strength now, trading above the levels of 48,000, clearly indicating that this rally now has formed a short-term base around the levels of 22,600 to 700 range on an immediate basis. Until that range is held, the next target on an immediate basis for the next weekly expiry is 23,000, and beyond that it would be 23,400, wherein we have ICICI Direct report as well for a target of 23,400. Prior to the election results. As far as Bank Nifty is concerned, I think it's inching towards 49,000 in the short term. So overall, the trend in the short term remains positive until these lower levels are held. Hence, I have two buy recommendations, Sonal. The first one is from the IT pack. It's on Birlasoft. The stock is likely to bounce back from its current levels. It's trading around the levels of 616. So one can buy Birlasoft futures. One can target 630 to 645 in the near term, placing a stop loss at 607. And a second buy recommendation definitely would be from the banking pack, and we have been seeing the stocks are coming back into the momentum. So Bank of Baroda is likely to inch towards the upper end of the range. It's trading around the levels of 270 in futures. One can target 280 to 288, placing a stop loss at 262.
Thank you so much for that, Jai. Indeed, a day of celebration as far as the market participants are concerned. You've given us two stock picks as well in Birlasoft and Bank of Baroda. But let's now take a quick break. On the other side, we will be joined by the Chief Operating Officer of Mac Estates, Rishi Raj, to talk about the quarter gone by.
India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBCTV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs.
If FIs would buy, markets would rally. If FIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics.
Welcome back. You're still tuned into Midcap Radar, where we have been talking about earnings, and we are towards the fag end of the earnings season as well. Let's talk about Ashirvad MFI now. Abhishek is focusing on that. The stress is weighing on performance of Manappuram. He'll explain the numbers and what went wrong this time. Abhishek.
Well, it seems like MFI sector is witnessing pain. We are seeing across lenders that MFI portfolio is showing pain, and Ashirvad Microfinance over there also stress has weighed on the performance of Q4 FY24. So NII growth is about 8.7% YOY and about 3.2% sequentially. The other income is down 44% YOY and 28.7% sequentially. Provisions have risen massively by 165.7% YOY and about 34.5% sequentially, so that's weighed on the bottom line. That PAT has actually grown up by just 1.15% YOY, and it has declined around 20% sequentially. If you take a look at the asset quality, gross NPA ratio has increased massively to 3.75% versus 2.78% in the previous quarter. Net NPA ratio has also increased to 1.71% when compared to 1.34% in the previous quarter. Now, on balance sheet, loan growth shows that there has been a loan growth of 18.8% on a YOY basis. Back to you.
Thank you so much, Abhishek, for that. In fact, even Morgan Stanley has taken note of this particular miss as far as Ashirvad is concerned, saying that the company has missed the PAT estimate by almost 25% to what they were anticipating. But the next stock on the radar is GMM Pfaudler. The stock slumps on the back of its fourth quarter numbers. Vamakshi is here with the earnings fine print.
Well, absolutely. A weak set of numbers coming in from GMM Pfaudler. Revenue is seeing a decline of almost 14% YOY, and this is largely being driven by a 9% decline in their overseas business. There is even a sharper fall seen in their domestic business. The domestic business was down almost 27%. But the operational performance for the company actually saw an improvement. Gross profit margins have improved by almost 686 basis points, and this improvement is largely being led by a decline of almost 28% as far as the operating expenses for the company is concerned. They also witnessed a 32% decline in cost of raw materials, which actually aided the gross margins. The EBITDA margins also improved by around 135 basis points, and this was largely being led by the overseas business improvement. Order intake was up almost 8.7% for the quarter, but for the entire year, order intake actually dipped by 11%. Resultantly, we also saw a nearly 22% dip as far as the order backlog is concerned. The management has also given a guidance for FY25. They expect the revenue in FY25 to stand at 3,700 crores. In FY25, the revenue growth was somewhere around 8%, and in FY25, they're expecting a slower revenue growth of almost 7%. EBITDA is also seen at 630 crores, but they're expecting an improvement in their ROCE to 25%. The management also sounded quite cautious in their commentary as well. They highlighted that the international business was facing some pricing pressure. The Indian market also saw pricing pressure, and this was significant as compared to the overseas business, especially in the glass line business due to intense competition. So overall, a weak set of numbers. There are some concerns around pricing as highlighted by the management, and as a result, we're seeing the stock decline in trade today.
Okay, all right. Thank you for that, Vamakshi. But stay on. The other stock that you're focusing on is Saregama. It's rallying over 11%. It's a good quarter this time around.
Well, a good quarter for Saregama indeed. We're seeing a revenue uptick of almost 29% come in for the counter. In fact, revenue, EBITDA as well as profit for the company are at a multi-quarter high. The highest revenue growth was seen in the music business as well. We're seeing a 27% jump in the music business. And in fact, the revenues generated from the artist management vertical is also aiding the revenue growth of nearly 20%. The EBITDA margins have improved for the company, coming in at 26.8%. 0.6%. This is an improvement of almost 250 basis points, and this improvement is largely being led by the music division, which saw an improvement of almost 740 basis points on an EBIT level. The net profit has also seen a sharp jump of almost 23%. So overall, it does seem like the company has come out with a good quarter, and as a result, we're actually seeing the biggest intraday gain on this counter since March 21st, 2023.
Thank you so much for that, Vamakshi. Stock surging on the back of those set of good results. But let's now slip into a short break. But as we promised, when we return, we will be joined by Rishi Raj, the Chief Operating Officer of Max Estates, to discuss the quarter gone by. Stay tuned.
Space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Welcome back. You're still tuned into Mid-Cap Radar. Well, Max Estates is the stock on our radar on the back of their fourth quarter numbers. Company's lease rental income has come in at a 4-year high in FY24. The company aims to double the same in FY25. In the quarter gone by, in quarter one of FY25, there have been a lot of updates in terms of fundraise and new residential projects as well. So let's discuss that. We have Rishi Raj, the Chief Operating Officer of the company, joining us now to discuss that. Good afternoon. Thank you so much for joining us. Well, can you give us a sense of the residential bookings in quarter 4 and FY24? Because you've given targets of 4,000 crore rupees in FY25, but what was it like in quarter 4, and is that something that you can continue to do in quarter 1 of FY25, or you think things will improve from here on?
Good afternoon. Thank you for having me in your show. Just to recap for your audience, we at Max Estates are in Delhi NCR in premium commercial and residential. As far as your question for residential is concerned, in FY24, we successfully launched our first residential project in Delhi NCR in Noida called Estate 128. And there we booked 1,800 crore in FY24 at an average price realization of 18,000 rupees per square foot, which was unprecedented for market like Noida. So that's FY24. We have built a residential portfolio, and we have added in our residential portfolio 2 more projects in Gurgaon. One is a joint development that we did last year on 12 acres of land on Dwarka Expressway, a very prime location, well connected with Gurgaon and Delhi. Our approvals are on track, and we will be launching it in July of this particular calendar year. For that, our guidance to the market in terms of booking value is 4,000 crores. Just to add to that, we have added another 18 acres of land in Gurgaon, contiguous to this 12 acres of land, again on a joint development route to keep expansion in a relatively capital light way. That 18 acres gives us another 4 million square foot. And the gross development value of that, the potential of that is 9,000 crore plus, which we plan to launch in the subsequent 2 years, in 26 and 27. So in summary, the total booking value potential of our residential portfolio today as we stand is approximately 15,000 crores, of which 1,800 crores for our Noida project is already booked, which is under construction now.
Right, Mr. Raj. So 1,800 crore in FY24. FY25, you've given a guidance of 4,000 crore. Now, 4,000 crore, now you also said that this is in a joint development. So what would be your share in this? The other part of the question is, there is this particular project, Estate 360. Have you factored that in as far as the guidance is concerned? When do you expect to launch it?
So as far as when you say Estate 360, this is the project that we are going to launch in July of this year on 12 acres of land on Dwarka Expressway. The guidance of 4,000 crore includes the share of landowner. The revenue share is roughly 1/3, 2/3. 1/3 belongs to the landowner.
Okay, so 2/3 will be for Max Estates. Yes, please go ahead.
2/3 will be for Max Estates. And the new acquisition that we announced over last couple of weeks, which is an addition of 18 acres over 12 acres in Dwarka Expressway, on Dwarka Expressway in Gurugram, that has an additional GDV potential of 9,000 crore plus.
Yes, that is something that you have informed to the exchanges as well. Mr. Raj, I wanted to understand the fundraise in that context, because that was another event that the street seemed to like. Will all of that fund be used in the residential projects that you've spoken about, or some of it will go to commercial as well? Over how much time period will you be utilizing those 400 crore rupees?
Yes. So let me just share with the audience about this fundraise. This is from New York Life. New York Life, which is a leading insurance player from US, has been a strategic partner in real estate business since we started our real estate business back in 2016-17. They are 24% shareholder in the Listco, and they are 49% joint venture partner in our commercial office platform. The most recent announcement was related to they buying 49% stake in 2 of our rent-yielding Grade A plus operating asset, which is Max Towers and Max House. With this, they are now a platform partner across all commercial office portfolio of 4.5 million, some delivered, some under construction. The total investment from this is around 388, around 400 crores that you mentioned. And this will be one of the many sources that we will be using as a growth capital to fund our growth moving forward, both residential and also in future commercial. The 400 crore that we are talking about will be used in the residential growth opportunity that we are planning over and above what we have already announced, which is the 18 acres. Over and above that, we will be using this 400 crores in the coming months.
Yes, Mr. Raj, we got that. We also want to ask you about the lease rentals and, what is the kind of income revenue stream that you're seeing from that particular vertical. Total lease area of close to 0.91 million square feet, with lease rentals of close to 66 crore. FY25, how will that number pan out? Number two, you have a partner on board as far as the commercial assets are concerned. Will you also in the future look at creating a platform and go via the REIT route or back to the markets?
Yes. So first, coming on the lease rental income, in FY25, we are expecting lease rental from our operational assets to be in the tune of 120-125 crores. But I would also like to share with your audience that when you look at 4 to 4.5 million square foot of portfolio that we have on the commercial office front, 3 delivered, 2 under construction, 1 in Gurgaon, 1 in Noida, the total annuity income potential at 100% occupancy is in the tune of 450 to 500 crores.
So that will be by when, Mr. Raj? 450 to 500 crore rupees?
By FY29.
By FY29. Okay. And right now, what is the split between residential? Yes. And right now, what is the split between your overall portfolio between residential and commercial?
So now we have 12 million square foot of total portfolio, of which delivered and under construction commercial is 4 to 4.5 million. Rest, including the new acquisition of 4.4 million square foot of residential that we announced, is 7.5 million square foot. And coming back to the question on how are we thinking of partnerships on the residential front, we are very open for all 3 models: outright purchase, joint development route, and we are also open to bring in New York Life kind of a partner for co-investment in a residential portfolio moving forward.
If I could just quickly interrupt you, any plans for a REIT? I think we just missed that.
Not yet. It will be one of the many exit strategies that will be available for us for our commercial portfolio. Today, our focus is to build a scalable commercial office portfolio. As I mentioned, 4.5 is what we have. We will continue to build, and at the right point in time, decide for the exit at a portfolio level through multiple choices that we may have at that point.
Thank you. Thank you so much for your time, Mr. Raj. Explain to us very clearly, how you expect FY25 to pan out. But we've run out of time, for this particular interaction. We'll have you once again post the Q2 results. But that's all the time we have on this edition of Mid Cap Radar Mutual Fund Corner when we return.
Create effective strategies with insightful expert opinions. On the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
The pressure is building on Israel in a historic move. Not one but 3 European countries, Norway, Ireland and Spain, have announced that they will recognize an independent Palestinian state. The announcements were made in quick succession and in a coordinated manner in the hope that this will help bring peace with Israel. The formal recognition in all these 3 countries will be made on May 28th. However, an angry Israel immediately called back its ambassadors from Norway and Ireland, warning that such a move will fuel extremism, terrorism and instability. With the rising civilian death toll in Gaza and the International Criminal Court evaluating the application for arrest warrants against Prime Minister Benjamin Netanyahu and Hamas leaders, all eyes are on Israel's next move. Let's try to understand why these countries have done this. Norway's Prime Minister said, and I quote, "There cannot be peace in the Middle East if there is no recognition." Spain's Prime Minister also reiterated that it's essential that the 2 sides, Israel and Palestine, negotiate for peace, and it's for this reason that we recognize Palestine. While the Irish Prime Minister said that Palestinians in Gaza are enduring the most appalling suffering, hardship and starvation, and permanent peace can only be secured upon the basis of the free will of a free people. So what exactly is the significance of recognizing Palestine as an independent state, and what is the 2-state solution? Simply put, the Israel-Palestine conflict is one of the oldest and persisting conflicts in the whole world over who gets what land and how it's controlled. And a 2-state solution hopes to resolve it. It's fundamentally about how or whether to split the country's territory between the Jewish and Arab population, Israel for the Jewish people and Palestine for the Palestinian people. Some 143 out of 193 member states of the United Nations recognize a Palestinian state, including India, that supports the two-state solution. In 1988, India became one of the first countries to recognize the Palestinian state. However, countries like the United States and the United Kingdom don't.
We're looking at a good traction in the year. The tire industry is expected to grow about 6 to 8% across the board. And so is the vehicle industry going to, particularly the passenger car, 6 to 8%. So that should give us a good traction. The truck industry, of course, is a little flattish and will be a little flat during the year. It may have quarter to quarter up and down, but in the end of the year, it will land up more or less flat. The OEM I'm talking. I'm not, replacement market is different story. Replacement market is moving all right. And so that is the growth forecast for the industry. We are looking at maintaining the growth momentum and trying.
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today we are going to put focus on factor-based mutual fund investments. It is different from fundamental investing. Factor-based funds are funds that use a single factor or a combination of factors to build the portfolio. What are these factors? To decode this and understand these funds, and also understand the difference between fundamental investing and factor investing, and whether this particular investment style is seeing a lot of growth. Let's get in our experts on the show today. We have with us Nisreen Mamaji, the founder at Moneyworks, and Bharat Lahuti, co-head factor investing at Edelweiss Mutual Fund, joining us now. Nisreen and Bharat, thank you so much for joining us today. Bharat, let me come to you first up, because we usually say go the fundamental way, use fundamental investing when it comes to any sort of asset class. But what is factor investing? What are some of the factors which are considered in this case?
Thank you for calling me on the show. Just to come back to factor-based investing, it's not a new concept. If you look at it, what is factor-based investing? One is to understand what are factors. Factors are primarily stock attributes that drives the performance of the stock. It could be as simple as that a company is growing, the growth becomes a factor. If company is trading at a below intrinsic value, value becomes a factor. If company is delivering higher ROEs, the quality becomes a factor. So if you look at it, factor-based investing is similar to fundamental-based investing, where we are looking for certain attributes which drive the performance. It is not only for picking up the stock, it is also for asset allocation. Whenever the asset does well, you try to understand what is driving the asset allocation, which asset is doing well. And consequently, you can build portfolios, not only from equity perspective, but across asset classes, you can build portfolios through factor-based investing.
Okay, makes sense. Thank you for breaking that down for us. Nisreen is also joining us now. Nisreen, your take here. Of course, we know some of the, as Bharat also mentioned, it's a century-old practice, but have the factors changed over time? How can you break that down for us?
Sure. So, there are various kind of factors. There are macroeconomic factors and there are style factors. So macroeconomic can be, economic growth, like exposure to the business cycles. Real rates, what is the risk of the interest rate movements? It can be also inflation, exposure to changes in price, credit risk, like default risk for, lending to companies, emerging market, political and sovereign assets, and liquidity, if you have illiquid assets in your portfolio. But the style factors are the more important, which is basically, index and ETF related. Are they passive funds or the index and ETF funds outperforming the index? Now here, basically, we look at, a couple of factors. One is value. Now, when you pick stocks that seem to be cheap based on certain measurements, like price compared to earnings. Now, inexpensive compared to the attributes, that is a low PE, does well in, say, a recovery market. So you can invest in a value kind of a strategy or a value factor investing in a recovery market. Then you have size, whether you're investing in a smaller company because they grow faster than a bigger company over a period of time. So another factor that you can consider is size. Okay. You can also look at momentum. Now, momentum is, when you choose stocks that are doing very well recently because they might continue to do well in the longer frame. Now, a price momentum catching up onto the short-term winners does very well in a bull market. And so typically, you will look at the 6-month return, the 12-month return, and your standard deviation will be, say, for a 12 months. So when you look at that and then you create a portfolio based on momentum stocks, that would be considered momentum factor investing. You can also look at quality, like, investing in companies with a strong financial health, steady earnings, good management. These are typically non-cyclical in nature when they're looking at high profit and low debt. Or you can be looking at volatility, like you have a low vol product where you select stocks based on, which don't have a very high price swing because they tend to be safer. There's not much volatility. The highest price stability will be the standard deviation will be the least. Then that does well across market conditions. Typically, it will have a stable balance sheet, which are non-cyclical, such as health, IT, or consumer. So these are typically the stocks that can belong to a low volatility product. So you can also have dividend yield, where you pick up companies according, which are paying higher dividend, which can mean better returns. Now, a value index will, go ahead.
No, of course. No, that is very well explained, actually, Nisreen, all the points that one can look at while they're looking at factor-based investing as well. And Bharat, you have expertise in this as well. So can you tell us, is it safe to say that fundamentals, growth, stock-specific details are not the only reasons to invest in a particular stock, a particular name? Is that what factor investing suggests in this case?
It spoke about its earnings growth, valuation, margins improvement. There are other behavioral factors also, like the other guest spoke about momentum, low vol. If you look at during periods of uncertainty, most of the investors flock towards safety stocks which displays low volatility. And consequently, that is the driving factor for the performance during that period of time. In periods of bull market, you would see actually momentum factor does extremely well. So these are behavioral factors, nothing to do with more about the financial parameters of the company, but it's more to do with how investor reacts to the news, information, and consequently the performance gets driven because of that.
Makes sense. So Bharat, what works better than return-wise? Fundamental investments or factor-based investments? How do fund managers choose which way to go about it?
So fundamental or factor-based investing, both approaches have some similarities and some differences. If you look at similarity, both of them actually are looking same numbers, whether it's earnings growth, margin improvement, return ratios, valuation. So broadly, if you look at it, both are using same stuff. What is different in fundamental investing is people look in terms of depth of analysis of management, how much management is able to deliver or not. Can they make a judgmental call on management? They also look at the products in terms of what is the longevity of the product which the company is building out. As compared to the factor-based investing, if you look at it, it actually quantifies some of these growth parameters which management is talking about. Whether the product which management has introduced in the market has that led to increase in market share. If you are able to quantify it and look at earnings growth, then you will be able to invest. So if you look at it, it's more a systematic way of doing things rather than a judgmental way of doing things in factor-based investing. In terms of return-based, if you look at it, what does well to that extent, on a longer run, both factor-based investing and fundamental investing will deliver similar kind of performance. But when you look at from a risk-adjusted perspective, factor-based investing does far more better when you look at it. Because if you look at it, it gives you a more smoother ride because you are actually tuned to many set of factors, not only growth, quality, value across time periods. And hence that gives you a better, smoother ride.
Okay, makes sense. So Nisreen, now Bharat explained what do fund managers look at, whether factor investing or fundamental investing. But how does an investor choose which type of fund should they go for? What have the returns looked like here if we compare both the categories?
Basically, I just like to add to what Bharat said is like fundamental investing is more like a detective. You dig deep into the company's financial health, market position, competition, and the management to find its true value. Factor investing, on the other hand, uses specific rules and historical data to choose between these investments systematically. So, fundamental investing will rely on, say, like an in-depth analysis of the individual companies, can spot opportunities that rules-based method might miss. But skilled investors can sometimes pick up these undervalued stocks and do really well. But by and large, I think the retail investor would do very well to invest in a factor-based kind of a style, because there you will get specific traits. You can try, like I've mentioned, 4 traits earlier. You can get better returns, which has been proven historically over the, benchmark and the indices. You can reduce your risk and you can balance your investments. So for example, if you select a 50-50 ratio between, say, a momentum style and a low vol style, you will typically cover all the, stocks possibly in the universe, say Nifty 200, and you will also not have any stock duplication. So by adopting a complementary style like momentum as well as low vol, you can do a 50-50 in both of these for the retail investor. That makes a lot of sense. And you can still beat the market returns by at least 6%. So your alpha will be 6% in nearly 99 to 100% of the cases over a 5-year period if you compare with the Nifty 100, just the index. So, both have their strengths, fundamental as well as factor, but you have to get into your own risk tolerance, your own goals, and, the time period that you're investing for, so that the investor himself will be able to analyze whether his goal is, nearer or further away, his own risk tolerance, his investment horizon, and also knowledge and resources. How much time can you devote to actually picking up stocks by doing a fundamental analysis? Since you won't be able to, because, by and large, through experience, one can say that the investors will not be able to devote so much of time to doing a fundamental analysis. So they are better off investing into factor investing products and selecting a ratio between 2 very well-proven styles like momentum and low vol.
Okay, all right. That's a very interesting answer and a very interesting conversation as well. But we'll have to take a quick break. On the other side, we'll continue our discussion with our guests on factor-based mutual fund investments.
All right, so in case you've just joined in, there's a vertical up move that you've seen in the stock price of ITC, and that's because the company has reported its results after a very long time during market hours, and it seems like it's a good set coming in from the internals that we're looking at. The revenue has come in at a little over 16,500 crores, slightly shy of street expectations out there, but the internals are pretty strong. So the street was working with a revenue of close to 17,000 crores. The company has reported a revenue of 16,579 crores. So that's a miss of close to around 400 odd crores. But that's more than made up for, by the other factors in the company, which is the internals. The EBITDA is coming in a little over 6,162 crores. Again, the street was working with a number closer to 6,300 crores, and the net profit at 5,020 crores compares with our poll of 5,115 crores itself. The most important part for ITC this time around was the way cigarette business would grow. And out here, the street was working with a revenue growth of around 4 to 5%. Guess what? The company has gone ahead and reported a revenue growth of around 7.5% for the cigarette business and a 5% growth in the cigarette operating profit. So that's telling you that we have, seen a little more, or the back of the envelope calculations would tell you that the cigarette volume growth would actually be in low single digits, closer to 2 to 3%, as against street expectations of 0 to 1%. So cigarette volume growth has come in slightly ahead of expectations. We will get the exact numbers in just a bit, but for now, cigarette volume growth looks like it is 2 to 3%, as against street expectations of 0 to 1%. The FMCG business, out there, a 7 to 9% growth was expected. The company's reported a 7% growth, but here too, the most important thing is the margin of the FMCG business. And out here, the margins have come in at 9%. This compares with 8.3%. So there has been a 70 basis points improvement in the FMCG margin, with a revenue growth at the lower end of the range, 7% as against a range of 7 to 9%. Looking at the hotel business as well, they've reported a revenue close to around 898 crores, and this compares with 781 crores. So that in the hotel business also is a growth of close to 15%, bang in line with street expectations of 14 to 16% growth. So one would ask, where is it that the miss has come about? The miss for ITC's revenue has come in from the agri business, which has actually declined 3,100 crore as against 3,600 crore. Here the street was expecting a growth of about 5 to 6%. And the paper business also has seen a decline of about 10%. But out there as well, the street was hoping of pitting itself for a decline of around 5 to 10% as well. So short point, the internals of ITC are a lot better than what the frontline numbers would tell you. 16,579 crore on the top line. While it's below street expectations, it's led lower by the agri business. The internal, the core businesses of the company, which are tobacco, FMCG and hotels, are doing extremely well. The EBITDA is also lower largely because of the EBITDA decline that we've seen in the agri business itself. There's been a 100 crore decline out there, and in the paper business there's been a decline of close to around 150 odd crores. So that explains why on a consolidated full company basis the EBITDA is slightly below street expectations. But if you look at the core businesses itself, the FMCG EBITDA margins or EBIT margins have improved year on year. We've seen an improvement in the growth of the cigarette business more than what the street was anticipating. The cigarette volumes have done a lot better as well. And hotels, which have actually seen a bit of a turnaround across the board, across the sector, have seen a growth of 15% on the revenue. And it's a lot higher on the operational front, where, we have 200 crores of EBIT turning into 267 crores. So the core businesses of ITC looking extremely strong. The next trigger now moves on to the elections, thereafter the budget and what happens on the regulatory front. As of now, from the numbers that we have and the internals, it looks like a bit of a beat and, unlike what the frontline numbers would tell you. The stock, if you just pull up the intraday chart, the stock which has seen a correction of almost 50-60 rupees from the peak has actually seen a bit of an up move and currently sitting with a gain of about 1%. Prakash Diwan joins us now. Prakash, ITC, on a reported basis, the frontline numbers look like they're below expectations, but that's because they've been led lower by the agri business, which has problems of their own. When looking at the internals, the cigarette business has actually shown a revenue growth of nearly 8% versus street expectations of 4 to 5%. The FMCG business has grown 7%, higher than the others in the industry. And we've seen a big growth, a delta in terms of revenue and operational performance continue for the hotel business. Where do you stand on ITC and what do you make of these initial numbers that we have?
First and foremost, Magnum, I think I would still be positively disposed towards this stock, and that's been for a long time. And what these numbers actually tell you is that some of these areas that we've always been waiting for growth to come by, especially FMCG and hotels.
All right, Prakash, I think we've got you on a bit of a scratchy line. We'll try and, reconnect with you. But just for those who've tuned in right now, to put those numbers back in perspective for you, the ITC has reported their fourth quarter numbers right now. The revenue has come in closer to, about 500 crores below what the street was anticipating. It's come in around that 16,599 crores. That compares with CNBC-TV18 poll of 16,992 crores. The EBITDA, 6162 crores. Street expectations were close to 6,300 crores. And the net profit at 5,020 crores as against street expectations of 5,115 crores. While the frontline numbers are below street expectations, the internals are strong. And that explains why the stock still holding up in the green. Prakash is still back with us. Prakash, I hope we can hear you now. We've got you on a better line. Please go ahead.
No, so I was saying, Magnum, I'm quite positively disposed towards this stock. And the two areas that seem to be very encouraging, while agri has been a bit of a letdown, is that the FMCG numbers have grown. And you can imagine if that, if the company starts firing on that cylinder, it's going to go places. And the second thing is the hotel business, which is due for some sort of a restructuring, and on a standalone basis, if it starts seeming promising from what these numbers tell you, there's very clear indication. The theme is very positive, the environment is conducive, and the business is growing. So I would be very disappointed with a little bit of a off the mark in terms of expectations being slightly higher and the numbers being lower. I think the stock should do very well from this set of numbers. And you actually have a lot of triggers that are now building up once again. So, with the way the back overhang is gone, the numbers tell you that what's likely to grow will grow on a secular basis and not just on a quarter-on-quarter basis. I think for the next couple of years, you'll see growth from hotels and FMCG, apart from the cigarette business, also, of course, tagging along. So very positive on this.
Take that point. Shirish Pardeshi, who's the co-head Research Center Broking, joins us now. Shirish, what were you penciling in when it came to the cigarette volume growth and cigarette revenue growth? The companies reported nearly 7.7% jump in the cigarette revenue and almost 5% jump in the cigarette EBIT.
Yeah, I think number came little closer, though it is tad lower in FMCG. But my guess is that cigarette volume should be in the range of about 2 to 3%. If I give the benefit of 3% price increase, what has happened and mix change. So, but overall momentum looks like in a weaker rural environment, this number looks better. While in terms of FMCG, though, the expectation falls short by about 100 basis points. But I think given the base and the food categories are doing excellently better, I think the momentum for FMCG has picked up. Probably the EBIT margin decline could be saying that the price element would have adjusted to a certain level, and because of that the EBIT growth would have been a little lower to my understanding. While agri was expected to come lower than the base, and I think it has come little 13%, which is decline, which has come. Paper, I think the inventory adjustment should have by far now adjusted because of the international pulp prices were lower. But I think I would expect, given the FMCG part of the business and the recovery in the paper business with the inventory settlement, I think there is a hope. Obviously, maybe another 1 or 2 quarters we will see the hotel demerger, which will have. So, but the good positive part is that company is given a 7.5 rupees final dividend. I think that should be also cheering, and that's why maybe that could be taken positive.
All right, 7.5 rupee final dividend. Your estimate is close to 2 to 3% cigarette volume growth. The street was working with a number anywhere between 0 to 1%. So on all parameters, looks like it is a bit of a beat in the tobacco business. The FMCG, we take your point, it's coming at the lower end of street expectations of 7 to 9%. The revenue growth is 7% out there, though the margins have improved. Agri business has weakened. Hotel continues to do well. So I guess that's all the time that we have right now on ITC. So if you just, all right, we'll, just to reiterate those numbers, revenues a little over 16,579 crores, net profit at a little over 5,000 crores. And we do have, the cigarette margins, which have seen a bit of a dip, but no problems as far as cigarette volumes are concerned. Estimates are it could be anywhere between 2 to 3%, which is about 100 to 200 basis points higher than what the street was anticipating. Prakash is with us still. Prakash, would you go and buy the stock at these levels?
Absolutely. Absolutely. See, look at the kind of scale that the company has achieved, and we're talking about the margin improvement even with that. So I understand the disappointment on top line, but then that could be more to do with pricing not being able to go up, volumes still to kind of in some of the categories to rev up. So all that is transactional, Mangla. But on a fundamental basis, I think the stock offers you such a good opportunity to participate in some very fast growing themes, which no other stock does on a consolidated basis. So I definitely believe even at this level, it's worth buying. And of course, as a matter of disclosure, I have this in my long-term portfolio since a long time.
All right. We also have Deven Choksi joining us. Deven, ITC numbers, you've looked at them now. What are your thoughts on the initial numbers that the company has reported and the internals?
Hi, Mangalam. Good afternoon. Well, I think initial first reaction, I think the numbers are pretty much in line with expectations. Fortunately, I think the margins are also, I think, protected to a greater extent. Unlike, I think, many other FMCG companies where I think you had a situation about the pressure on the margin, out here, it appears to be, I think, on a protected side to a greater extent. Though I haven't seen the breakup across all the verticals, but would like to believe that I think the numbers are by and large, I think, in line with expectations. The cigarette sales probably, I think, has been slightly on a higher side, but I think that shouldn't be an issue because other places, I think, in other verticals, the numbers are looking, I think, relatively more stable, I believe.
All right, so let me just give you the breakup, Deven, for your benefit and for the benefit of our viewers who've just tuned in as well. The cigarette business has posted a revenue growth of 7.7%. At the gross level, the revenues are close to around 7,925 crores. The FMCG others business has seen a revenue growth of 7%. On a gross basis, the revenue is close to around 5,300 crores. Out there, the margins have improved by about 70 basis points. Hotels continues to do well, 15% revenue growth, and the growth on the EBIT is a good 30% as we speak. And the agri business is where we've seen a revenue decline of nearly 14%. Paperboards has seen a decline of nearly 10%, but that was largely expected by the street. So those are the internals. With these internals, what is your assumption on the volume growth, and what is your call on the stock right now?
So I think the fundamentals of the businesses remain intact. On the contrary, hotel business, I think, which is similarly echoed by the Indian hotels, I think looks pretty stable from the growth perspective. Given the volume that is taking place in form of the occupancy, and at the same time average room rate, I believe that this particular business is also going to be up in the current financial year, that is 24-25. Of course, would like to hear more from the management on when the commentary comes on this particular subject. But I think we remain distinctly bullish about the two verticals. One, definitely the hotel business, and the second vertical is FMCG business. Both these verticals have relatively larger ability to contribute to the performance of the company.
All right, Deven, Prakash, Shirish, thanks a lot, all the gentlemen, for joining in and giving us a quick view on what ITC results look like. With that, we're closing in, towards the closing end of the market. Closing bell will take the market action forward. But for all of them, once again, a wrap on ITC numbers. The revenues and EBITDA on a reported basis are slightly below street expectations. But in terms of internals, they are largely in line or mildly better than expectations when it comes to the cigarette business. In particular, 2 to 3% is the estimated volume growth as against street expectations of 0 to 1%. FMCG revenues have grown at around 7%. The street was working with a number of 7 to 9%. Margins have improved out there as well. Hotels continues to do well. The weak areas of the company have been agri and the paper business. The stock at the high point of trade. Not just the stock, but the market as well. So we take a short break, come back on the other side. Closing bell will take the market closing forward.
On about 8 to 10% increase in our sales in the year for 25. We had first done a place with the IFCI, 240 crores, and another 500 crores with the QIP this year. And the two together, our debt has come down substantially by nearly 18% during this year. Our net debt has come down by 18%, and our debt equity now stands at 0.85 to 1. So in fact, we are quite happy about our debt, and the debt is absolute number of debt is nearly 3,100 crores. So that's where we are, and we hope to maintain a better debt profile continually.
We are diverging to Bangkok, one.
Iranian president, 63-year-old Ibrahim Raisi, has died in a helicopter crash. Raisi, along with Iran's foreign minister Hossein Amir Abdollahian, East Azerbaijan governor Malik Rehmati, East Azerbaijan Imam of Friday prayers Mohammed.
The Korean indices are also trading above the flat line, but the Japanese indices are the ones that are outperforming.
The last 1 year, its market cap has surged more than 4 times.
The all-time highs, which is just about 200 points away, still very much in sight. The line of sight is there.
The fiscal surprise would be positive only when we realize how the dividend would be treated.
But it's also a problem of plenty, so I think every government will welcome this as well.
You've got the mid-cap index, which is up about 0.5%, 230 points higher.
Leadership is looking very similar to the 2003 to 2008 bull market.
We expect 2 more quarters of these low margins.
So I think just about 100 points, right? I guess we can start the countdown. 100 points left for an all-time high level.
6 out of 8 employees at Infosys are getting trained on generative AI.
Nifty has gone ahead and hit a fresh record high.
We have the mid-cap index at a record high across all the major indices. It's a sea of green.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good afternoon, you're with Closing Bell, and it's a mega move. The bulls have announced their comeback in style. It's taken them just about 8 to 9 trading sessions to come off from what were mid-May lows. Around 13th of May is when the Nifty hit a low of around 21,800, 1,000-point march, and it's a resounding move right now. In fact, it's building 300 points up on the Nifty, and we're almost at the doorsteps. Yeah, 22,900 on the screens.
Oh, absolutely. So we've not just crossed 22,800, we've crossed 22,900. The Sensex is mounted 75,000. And it's just like green means go. It's just been going on and on, particularly in the last 1 hour. And it's a blue chip day because mid-caps are trailing a bit. The mid-cap index is just up 0.3% at a time when the Nifty and the Sensex are up 1.3%. You know, Nigel, this is the 6th consecutive day of gains for the Nifty and the 10th consecutive day of gains for the mid-cap index. So one-way move.
Well, that's right. And maybe the action's not yet done because we have expiry that plays out. That's the weekly expiry that plays out. And at the start of the day, the bearish view was that we won't get past 22,700 odd. We're at 22,900. So some of those shots have already got squeezed out. A few of them may be waiting as well. So that could be another reason why we'll see an additional fill-up in the last 60 minutes or so. It's going to be volatile, but let's see how it goes. The Nifty Bank coming back, coming in style. You have both the pillars of the market doing well. The domestic-facing themes, the banks, they did well today. And also you had a bit of a rub-off because of the NVIDIA results. You had some positive commentary coming in from the tech names as well. So IT and banks do well. Well, beautiful looking screen today.
Well, now, add in capital goods and autos. So both those indices too are higher. So the capital goods index has moved up close to about 2% and autos is up 1.5%.
It's a fabulous looking screen, right? Because you've got a lot of different large caps participating. It's not just one stock or 2 stocks. It's across the board. Banks are leading. Some of the IT names have been doing well. FMCG, Reliance in the last couple of days. So if you just dial back and, we put up that question saying what changed? Where has this 1,000-point rally come in from? 1,054 to be precise, but the numbers are changing so rapidly that I calculated this barely 10 minutes back and those numbers are already outdated. But basically 13th of May is when we hit that low of 21,821. So what changed? Just 4 very quick points. Number 1, politics. The big jitter point was when those electoral polls were coming through and the voting outcome, the voter turnout was low. From that point onwards, it seems the market narrative has shifted and the market seems comfortable with the fact that even if we have, the sitting government crossing and getting a number of 272 plus around 300, there will be political continuity and policy continuity. So that's number 1. Number 2, there's a lot of global catch-up that India has had to look at, and that seems to be beginning now. Because remember, Wall Street has rallied between 3% to 7% on the NASDAQ in the last 1 month, and we have missed out on most of it. So it seems some of that is now neutralizing as well. Number 3, earnings. There are no major disappointments or major downgrades as Q4 is winding up. In fact, most estimates on the street for Nifty earnings for FY25 are still in between 13% to about 15% growth. So that's that. And number 4, of course, yesterday, if banks needed a trigger, they really got it in the form of that RBI bonanza. The fact that the dividend is so big is leading to a lot of speculation on what it means for yields. In general, consensus is that yields are likely to stay very benign. Maybe they fall another 20, 30 basis points. And that could perhaps spell some trading gains for banks. At least that's one narrative. And that seems to be explaining the trigger, the spark that the Bank Nifty needed. By the way, the Bank Nifty is still not at its all-time high. It's just about 2% off that peak. But that was that one engine that was not firing. That's decided to come to the party. And this is where we are. But guys, having said this, I mean, I just want to place on board yet again. We're looking at all-time highs. Again, minus FPI participation. FPIs remain on the sell side. That's not changed. Almost on a daily basis, we're still getting those 1,000-point sell figures. But then, hey, it's our party. It's local. And it's on.
Well, maybe the last leg comes in when the FPIs decide to, do short covering.
Yeah.
And that could be the last, leg for our rally. But, even on the mid-cap end, right, the mid-cap index is just up close to about 0.3%. But there are many pockets doing well. And one of them is the entire shipbuilding stocks. So Garden Reach Shipbuilders is reacting to numbers. So that stock has surged close to about 17-18%. But even outside of that, Cochin Shipbuilders, that's shipyards, is up close to about 12-13%. Mazgaon Docks is up 7-8%. So, even the mid-cap end on individual stocks, the screen is very much alive. RVNL, IRFC, so railway stocks. So we're, about 7-8 days away from the election verdict. And all the stocks which did well on the back of government policy are the ones where there is buying. So whether it's railways, defense, shipbuilding. So that clearly tells you how the market is entering into this, the election verdict.
Well, that's right. Let's get in a technical comment then on how do you trade from here. Rahul Mohinder joins us to fill us in with that. Hi, Rahul. Well, a 300-point rally is what you're seeing, and it's a large cap heavy day. Because if you look at the breadth of the market, still you have more number of stocks declining in comparison to number of stocks that are advancing. Even the mid-cap index is up only around 0.3%. But Rahul, how would you trade it? I mean, if you already had a long position, I guess you should be trailing your stop loss. So where does that number come in at? And also, what levels are we looking at on the upside from here on?
Okay, let's start with an index perspective, and then I'll move to some stock-specific ideas. Number one, if you look at the two indices, the Nifty index and the Bank Nifty, of course, the Bank Nifty is the one to be chasing. And I mentioned this, 2 days ago on the show, that even though the Bank Nifty is slouching, that's the one that has more potential. Even from this point, we have well past 1,200 to 1,300 points to hit a new high, which definitely makes it a strong candidate. And when you start looking at the internals, you start seeing a lot of consolidations which are attempting a breakout. I mean, for example, an SBI, which has been range bound for the last 2 or 3 weeks. You can see Axis Bank coming out. I mentioned earlier in the week that Kotak Bank too was a good opportunity when it had that drop earlier this week. So banking is, I think, my heavyweight theme, and Nifty Bank would be the index of choice. So even at this point, I do think that you'll probably see levels of 48,400 respected, and we could potentially get to that 50K plus mark on the Nifty Bank. So that's it from the Nifty Bank. If you look at the Nifty, there is somewhat of a hurdle, somewhere closer to 23,000, give and take 50 points from that 23,000 marker. I think there could be a strong barrier, and not just being a round figure, but technically too, there's some important, resistance barriers we hit there. And looking down the line, maybe we have a good pause around 23K, and then we move to about 23,300 to 23,400. So I think that's the kind of upside we're looking. As a percentile, it's not huge, but that's the trajectory which traders need to keep in mind given the next 3 to 4 weeks down the line. So I don't think we're really getting past 23K in such a gush that we'll immediately hit that 23,400. I think there will be some pausing. Of course, we all like it straight line, but one should be ready for that kind of a correction. But coming to stock specifics, I talked about banking, and again, SBI, as I mentioned, the 795 to 840, very nice range that it kind of held through for 2 weeks, still within that. But one is seeing that attempt, and one can clearly see that the stock has the potential to move to about 855, 860. So give a stop loss of 825, one could go long. ITC, of course, numbers are out, but 450 to 452, a safe target you could be trading in for. Keep a stop loss below 436 on this one. Very tight stop. Reliance could be the momentum driver and, could even hit the 3K mark. I was just watching the kind of volumes, on an intraday chart, quite sporadic as those up moves came in. And therefore, I think that would definitely be on my list too. That should help the index a good bit.
Oh, yeah, absolutely. Reliance actually started moving, and that did sort of change the mood. And what we have, of course, is this big all-time high number. Thanks for that. Rahul, we'll come back to you for some more ideas in just a bit. By the way, looking at the screen, Reliance is one stock that's powering ahead. The other one is L&T, looking very, very smart and strong with a gain of about 3.5%. And some of the Adani Group companies are major movers in today's trading action as well. Look at ports, look at enterprises. Both of these stocks up between 3 and 7% actually almost on Adani Enterprises now. Let's bring in our first guest on the show. Devin Choksi is joining in. Devin, hi, good afternoon. What a comeback by the Bulls, right? Just ahead of the major event, that, pivot day on June 4. What would your advice be? Because now it seems, the market's sort of covered all its uncertainty and we're going into the event at all-time high levels. So how would you, look at the placement over the next couple of sessions till we get to the event?
Yeah, good afternoon, Surbi. Leave aside, I think that euphoria, for a while, it's the calculation pertaining to the election and the results thereafter. I think the numbers on the economy front, they look absolutely, very convincing. Beginning of this month, we had the number pertaining to the GST collections of 2 lakh crore plus. Today, we have a collection numbers, dividend payout numbers from RBI to the government of 2 lakh crore plus. Now, if you look at, the possibilities because of these numbers, that is something which is what the market is liking about. Every rupee which the government is collecting from whatever the resources, including, the RBI's dividend, it is understood that this will help the government in spending money for the infrastructure. If government ends up, spending this money on the infrastructure, and if there is a 7 times, trend changing possibility on that, what we are talking about is 14-15 lakh crore worth of amount being spent in the economy, or amount getting exchanged, changing hands happening in the economy. And that could also mean that somewhere around 1,50,000, 1,80,000 crore worth of GST collection also happening on the top. So obviously, the spending increases, the consumption increases, and entire economy will move faster. And that is what is convincing people out here. At the same time, the corporate sector is talking about absolutely very robust kind of a performance going forward. In most of the commentaries that we have heard so far in this result season, I guess in each and every sector, squarely, the companies have talked about their business expansion plans. They have talked about, the business growth in the subsequent quarters and all. So from that perspective also, the market looks pretty convinced about going forward the journey as it is. Maybe the valuations are stretched, but given the situation of higher amount of liquidity into the system, and given the situation that domestic money is chasing good amount of stocks, the bull market valuations will remain stretched. So maybe 10-15% kind of a stretch valuation, if you get some opportunities at a lower levels in some of the large cap companies which we find, I guess that is where probably we'll make money out of this market and just stock specific basis.
Okay, let's get to some pharmaceutical, news flow. There is some news which could be negative for Lupin and Cipla. There is a competitor for albuterol sulfate. Ekta joins in with the details and the implications. Ekta.
Thanks for that. Well, the news is that Amphastar has received US FDA approval for albuterol sulfate, which is basically an inhaler that Cipla and Lupin have been selling for the past couple of years, and where they have significant contribution, which, they have around 10 to 15% market share each in this particular inhaler, and hence they are important products for both of these companies. Now, there is a negative read-through for both Lupin and Cipla, simply because, like I mentioned, albuterol is the second largest revenue contributor to Lupin and Cipla's US revenues. The new player, we don't know as yet, but it is assumed that there could be some amount of price cuts that they could resort to. which could be to the tune of around 10 to 25%, and that could result in price erosion. But remember that this is basically par for course for other companies to launch the same product or the generic version of certain drugs in the US market, and hence there could be a price erosion that Lupin and Cipla could face, but they already have a significant amount of market share. And the street was anticipating incremental competition for albuterol. So yes, while the news is negative, it is largely normal business for US generic companies to see other companies launch the same generic version of the drug, and hence maybe eventually we could see some amount of recovery take place.
Okay, thank you very much for that. But one stock where the bears are in control is Sun Pharma. That's the top Nifty loser after the company's revenues came in below estimates. US sales also were lower than street expectations. That said, the margin performance was a tad bit better. Group CFO CS Muralidharan spoke to CNBC-TV18 about the company's guidance for FY25 and the steady increase in R&D spends. Listen in to excerpts from that conversation.
So our revenue guidance of high single-digit growth of FY25 is based on all the businesses which are poised for growth. As far as the EBITDA margin guidance, we have not been given guidance on EBITDA for last couple of years at this point of time. We mentioned in yesterday's call also, we believe that these are some site-specific issues. We are working to address them in due course. After we have completed the entire remediation work, the facilities will be presented to the FDA for re-inspection. That's what I said, that once we complete all the remediation work, which is ongoing, we will definitely invite the FDA for a re-inspection of these sites.
Okay, all right. Deven, good afternoon. Good to see you, Vin. What's your take then on the pharma stocks? You know, they've pulled back considerably, though for the year to date, still they're the big outperforming sector. Your take?
Hi, Nigel. Good afternoon. Well, I think we continue to hold the strong buy on pharma companies, particularly the larger ones like Sun, Cipla, and Dr. Reddy's, where the contribution of specialty generic products, I think, is increasing, and also the margin because of that. Given that situation, I think most of these companies are absolutely firmly positioned into the US market included. And that is where we believe that I think the higher amount of business contribution in the subsequent period of time to continue. Even if you look at the growth and the valuations at this point of time, even for a company like Sun Pharma, I think on a growth of around 34-35%. And if you normalize after the exceptional items, it is somewhere around close to 39%. I would think that I think the valuations are still not so expensive. I think the valuations, I think at 37, 38 times price earning trailing 12 months. I believe that I think it is still not expensive given the kind of growth that they are achieving. So from that perspective, I think we like some of the larger companies, though fully understand that I think the market might correct to a certain extent. And should it happen, I think in a near future, probably I think it becomes a buy opportunity for earning 20-25% return from the lower levels into the next 1.5 year time.
Okay, so valuations are fairly attractive. Deven, that point is taken. But right now, the street is concerned about the fact that the company is only guided for a high single-digit top line. And they're also talking about high R&D spends, which could, according to analysts, maybe hurt their margins. Deven, thank you very much for joining us today on Closing Bell. We'll get into a break. On the other side, we'll invite Vinay Jaising, MD and Co-Head Portfolio Management Services at JM Financial. Stay tuned.
And security officials were on board a Bell 212 helicopter which crashed in the mountainous terrain of northwest Iran. The accident took place 30 minutes after President Raisi's chopper took off after the inauguration ceremony of Kiz Kalasi Dam on the Iran-Azerbaijan border. He was often referred to as the Butcher of Tehran by activists for being one of the 4 judges who oversaw mass executions of thousands of political prisoners in 1988 after the Iran-Iraq war. According to human rights organizations, around 2,800 to 5,000 people were executed in this period. Raisi was a conservative hardline cleric who came to power in August 2021 after several candidates were disqualified from the election. Raisi's tenure was marked by an aggressive crackdown on women-led protests after the killing of 22-year-old Mahsa Amini. His government enforced a strict women's dress code and also increased uranium enrichment levels after US withdrew from the nuclear deal. Most recently, Iranian forces had carried out a retaliatory drone attack on Israel after 2 senior Iranian generals were killed by Israel in an attack on an Iranian consulate in Damascus. So what happens next? Iran's Vice President Mohammad Moghber will now take over as the interim president. Moghber is known for close ties to Iran's supreme leader Ayatollah Khamenei. He will be president till elections are held within 50 days. President Raisi was expected to succeed Iran's supreme leader Ayatollah Khamenei. Now, after Raisi's death, Khamenei's son Mojtaba is seen as a top contender to replace the supreme leader of Iran. But one thing is for sure, and that is Iran will see a period of political turmoil and internal power struggle. However, one thing is for sure, and that is Iran's politics, their view on international affairs, the war in Gaza and approach to Israel is not going to change. India, which recently renewed the 10-year-old Chabahar port agreement with Iran, will be watching developments very closely. Iran is the third largest oil producer in OPEC and produces 3 million barrels of oil per day, or 3% of global.
Welcome back. The move is on. 22,900 still on the screen. I'm not sure if that 23,000 peak is going to be conquered today itself or not. But it's a fabulous move for what it's worth. By the way, ITC has seen a really good reversal. ITC practically at the highs of the day right now. There's a volatility on the stock. It fell, but now we can see it rising back again. We'll have Mangalam back up on this in just a bit, because the thing is that optically the numbers look like they were a little below estimates. But the two main engines, which is the cigarettes business and the FMCG business, they seem to be firing away pretty well. So the markets are taking that on board as well. Well, let's move on and say hello to our next guest on the show. Vinay Jaising, MD and Co-Head Portfolio Management Services at JM Financial is with us. Vinay, great to have you, and good day to have you on as well. I mean, it is a full-blown bull charge once again on the street. It seems that the market has digested those election jitters. But you tell us, I mean, we're looking at this big binary event on the 4th of June. What after that?
Well, I think if you were sitting not in India but any other part of the world and looking at investments in India, you want the big binary event to get over before you take your call of what investments you want to come into the country. So I think that's step one. FIIs who in the last, I would say last month have been sellers of as much as $3 billion, they're already at about 16.5% weightage. One of the lowest in the last 10 years in terms of what their ownership is for India. Today, DII is a little more than what FIIs own in India. And that number is coming at a time where MSCI has actually raised their numbers from, let's say, 6% 10 years ago to 18% today. So, you wait for the election to come in, you wait for a politically stable government, and things should, as far as liquidity is concerned, do much better. So that's step one. What more after that, look at the 100-day agenda, which, whichever political party comes into the picture, which showcase. You have the manifestos already spoken about. If the existing party comes into the power, you'll hear a lot more on infrastructure, rails, roads, power, capex, and the way to move ahead in that. So you'll hear a lot of noise on the budget, whether, the capex spend is going up. I think these are the two things we would look ahead for. One is liquidity post stable government, and second is what is the manifesto or what is the road ahead with the party which comes into the power showcases to us. Post that, I think analysts will look at rating their numbers, or just simply put, if the existing government comes into power, just raising the bar on the P of what they would look at purely for stability.
Vinay, morning. So getting straight down to the portfolio choices and bets from here on, right? You've been a believer in specialty chemicals. In every conversation you've spoken about it. What have you made of the Q4 numbers from the companies in your coverage? What does it tell you about the outlook? And how are the current valuations?
So as far as specialty chemicals are concerned, this is one of the spaces wherein we've gone more wrong than right. Touch wood, the other spaces, including CapEx, we've gone a lot more right. The results of most of the numbers which have seeped in are not as exciting, courtesy China. As a result of which, we've actually reduced our weightages in specialty chemicals. Having said that, one of the companies we are looking forward for results to come out is Blue Jet. It's a pseudo specialty chemical moving into the API/pharmaceutical space. Therein it has 3 engines running. One engine basically is the sugar-free engine. The second engine is the API engine, and the third is the contrast media, wherein it's a market leader globally. So as far as specialty chemical as a space is concerned, you're close to the bottom, but you probably are a quarter or 2 away from seeing demand really come up for the rest of the world.
Hi Vinay, good afternoon and good to see you in. And I think on specialty chemicals, you had a couple of stocks that you like. Tatva Chintan, I think, was one of them, and there was one more, I think so.
So Blue Jet, Tatva Chintan, and Arkin were the names which we were mentioning to you earlier.
Okay.
Arkin's kind of played it straight, so we are at the bud, incrementally reducing our weightage out there because we've made the easy money. As far as Tatva Chintan's concerned, it's been rather disappointing, as I was mentioning. The story remains the same, which is in the next 1 to 2 years, you need to see them move to building capacitors or getting into the EV part of the space. Today, they are a big manufacturer for CVs. For the SDA requirement and electrolysis as well. The capacities have come up. I think it's very rosy a picture if you were to look at 1 to 2 years. But the problem is when you're looking at markets like this, the other stocks are running up a lot more. I would strongly suggest, you need some of these names in your portfolio because you can't just buy the high PE names. These are rather disappointing names which, as China opens up or as demand of the world incrementally does well, or just simply put, as EV takes off, these companies will get a lot more demand than one can imagine.
Okay, all right. Vinay, let's talk about a couple of other themes that you have liked. And some of those stocks, they corrected a little bit, but they got bought into. BEL and Vatek Vabag. Both those two in the past we have discussed. And you've got an early actually on both those two names. Currently, what's the call on both these two names?
We're not complaining on both these, as I was telling your colleague earlier. If the manifesto is to invest in CapEx, there are 2 segments where you will see investments increase. One is defense. Remember, India's defense expenditure is just $20 billion on a yearly basis, as against, let's say, $250, $260 billion of US. We're doing 2 things in defense. One is we are increasing the CapEx spend. It's gone up by about 2 to 2.5x in the last 10 years. But the second is we are buying a lot more domestic defense projects. BEL is one of the big gainers for projects coming into the country. And what BEL gains is whether Hindustan Aeronautics or Bharat Dynamics or any other company gets any electronic requirement, BEL automatically gets that story. Its overall order book also is pretty strong, at about 3.5 to 4 times. Having said that, now at a multiple of close to 40, we are more waiting for a correction to incrementally increase our investments. At today's price, we would prefer Hindustan Aeronautics over Bharat Dynamics or Bharat Electronics, but we like all the defense space, period. That's something we want to be invested in. Moving to the water space, again, very similar story to defense. In 2014, the government invested about 150 billion in water treatment. Today, that number's gone closer to $1 trillion. And the number of companies in the water space or water plus management space is literally a handful. VATech shines out here. Last quarter was not too good. Their analyst meet is, I think, tomorrow afternoon, but they still stay with a 3.5 to 4 times order book. They've successfully commissioning desalination of Chennai, which means, virtually maybe 60 or 70% of Chennai will get salt-free water, even if you take it from the tap, which is a big thumbs up for, I think, India as a whole. And once that succeeds, you'll see a lot more orders come up from the other cities as well. In terms of ratios, the company is already between 15 to 20% as far as returns concerned, and very similar number of earnings. They are net cash, and it's at under 15 times 1 year forward multiple. So then valuation's attractive. So we are currently buying these stocks.
Got that. Yeah, we were speaking with VATech Vabag actually just yesterday, and they did make that point that this compression in the order book, which they witnessed in FY24, that'll be a thing of the past, and they're hoping to grow the order book this year. So take your point on board. But Vinay, let me expand that question on capex and manufacturing. So defense is one, and you've explained very well what you like there and how you're looking at valuations. What about the other aspects of manufacturing? Capital goods companies, for instance, they've had a pretty good quarter as well, at least most of them. But again, what is the valuation dynamic like? Or if you're looking at manufacturing from an auto perspective, then just basically tell us, where do you still find some amount of value if you want to play capex and manufacturing?
Sure. There are actually a couple. First and foremost, since you said capital goods, look at Kirloskar Oil. That's something we've been, talking with you all consistently, I think, for the last year. Yes, the stock's done well, but it's still under 20 times multiple. It's moved up the chain on the value it's producing on its equipment, but more importantly, it's also improved its margins. What's interesting is, there's a 4,800 crore book, ARCA sitting in them, which sooner than later will probably be unlocked by the management. So this is one thing we like. Again, return ratios are between 15 to 20% plus. So good return ratios, relatively attractive valuation. That's one of the names we like in capex. Sure. In clean energy, we like a company called MTAR. This is a company which gets about 60% of its overall order book coming from another listed company in US called Bloom Energy, and about 35-40% of its revenues it's getting in from companies in the defense and the nuclear space. Earnings growth fantastic, which is north of 40%. P at about 25 times 1 year forward. Come down from a P of somewhere close to 35-40 times. Results of this stock is weighted, but I think this is one of the small caps we really like.
Sure.
So these are the two names I would focus on as far as capex is concerned, and then you get into power as well. You've got a couple of interesting names there.
Vinay, great conversation, but we'll have to leave it here because we've got a management waiting by to talk about their Q4 numbers. And this is a conversation you should listen into. BEL, a company that you own, they reported their revenue, margins, profits earlier, beating estimates. The company's FY24 order book came in at 35,000 crore rupees, much higher than their guidance. Bhanu Prakash Srivastava, CMD of the company, is now with us. Thank you very much for joining in, sir. Q4 was a strong quarter. Your order inflow has seen very healthy momentum, and you've guided for 25,000 crore of order inflows next year in FY25. Where do you see it largely coming from?
This is coming from all the three services. In fact, based on the processing and all, we guided around 25,000. But the way government processed the order on high priority, many orders we were supposed to come in this financial year. They were fast-tracked and we got the order in 23-24. That's how it overshot our expectations, and we clocked around 35,000 crore of order in financial year 23-24.
Okay, that's on order inflows. You've also maintained a 50% revenue guidance for next year. Now, historically, H2 is better than H1. Now, looking at the current market dynamics, how do you see growth in the first half of the year, considering there is also elections which are currently underway?
Normally, in our type of business, H1 is slightly lower than H2 because we have to mobilize. Systems are not, we are not able to what you say that streamline or are not able to integrate the system in a very short time. So what we do in Q1 is what were already going on in Q3 and Q4 and get cleared. Still, we expect around 15% growth in Q1 as compared to what we did Q1 last year.
Okay, all right, sir. But what are the key growth opportunities in the non-defense space? Your non-defense sector contributed closer on, I think, 15% ballpark of your revenues. And in FY25, you aim to maintain the same. In the long term, by what percent you plan to scale it up to?
I think that our defense to non-defense will remain in 85-15 in this range. Because even though we are putting a lot of effort to diversify and scaling up in non-defense, defense is also increasing at equally fast pace. So non-defense will remain. Some of the area where we are working very hard in non-defense are airport surveillance radar, air traffic management system, metro solutions, railway business, and then cyber security solutions. These are the area, homeland security, smart city business. These are the area where we are concentrating on civilian sector. Similarly, that perimeter security system for various applications. These are the area where we are concentrating in non-defense sector. But in my opinion, defense and non-defense ratio will be in the same range because defense also is increasing with the same pace.
Mr. Srivastava, you've guided for 23 to 25% EBITDA margins. That's the band you're talking about. So what are the key drivers for margin expansion that you expect this year? And what is the profile of the non-defense business and the defense business? If you could just give us the breakup.
Segment-wise margin profile normally we don't do, but overall 23 to 25, seeing the current product mix, we anticipate this margin. It's basically because of better efficiency, operational efficiency, project management, and then indigenization, alternate sourcing. These are the factors which affect which improves the margins.
Okay. Talking about large ticket size projects over FY25 and FY26, what are the big orders in your current pipeline or in the order backlog?
In FY25, what we have anticipated guidance we have given of around rupees 25,000 range. There we have not considered very big ticket item like QRSAM, because the way values of QRSAM are there and even A1 has not been taken, we are giving input to defense for services. We expect QRSAM to materialize in 26 financial year. So in 24-25, it's mainly routine type of business, which will be, few of them will be in the range of 3,000 to 2,000 crore. And most of the products will be in the range of 1,000 crore to 100 crores. But it will be a large number of products and spares and line items. It will be.
All right, sir, but you're targeting close to around $110 million turnover from exports in FY25. Could you tell us which regions will largely contribute and which project profile will this be?
Exports are normally in two categories. One where we do the offset business and subsystems manufacturing for our global partners like Thales and others, and also product going in some offset obligations. Another is that where products like radar and electro-optic system, coastal surveillance system, we export it to friendly countries. So both taken together, it will be in the range of around $110 million in financial year 24-25.
Okay, just a question on geopolitics as well. You've reduced your exposure to Israel quite significantly, I believe. In the conference call, you've mentioned that the impact was minimized in Q4. Can you just give us some more details there? What is the outlook and what linkage may you still have, if any?
If current situation continues, impact will be minimum because there were logistic and supply chain issues we faced immediately after that starting of the war in October. So it took some time before our OEMs, they made the alternative arrangements and established the alternate SOPs to take care of supply chain issue. So it did, there was a spillover from supply during Q2 and Q3, but largely we were able to overcome in Q4. Remaining whatever challenges are there, both BL and our partners, we are working to eliminate that also, so that to a large extent we are able to address in this financial year.
Okay, one final question, sir. You've entered into an 850 crore rupee contract with L&T for the supply of communication and electronic warfare, sensors and systems. What's the key execution timeline for this particular L&T order, and what are the margins you're working with?
Normally, product-wise margins we don't specify, but definitely for their cadet training ships and multi-purpose vessels, we are giving many equipments, and the supply will be based on their delivery schedules for platforms. So, starting from something in this financial year to next 2 to 3 years, it will be completed.
Okay, all right, Mr. Srivastava, we'll leave it on that note. Thank you very much for joining in and good luck for the year ahead. We will take a quick break on that note. We'll come back on the other side, get you a check on what the buzz is in dealing rooms given today's mega rally, and of course some final trading calls as well.
Formal inquiry will now take place to investigate the cause of crash, which is being attributed to bad weather at present. Several world leaders, including Prime Minister Modi, have condoled the death of the Iranian president and foreign minister, and they have said they stand by Iran in this hour of crisis. According to reports, Israel has denied any role in this crash, and experts say at this juncture, any foreign interference looks unlikely, as it would also amount to an act of war against Iran.
Welcome back. Well, it's a bazooka move is what we're seeing on the Nifty. We're almost at around the 23,000 odd mark. The markets are preparing for life about 23,000 as we speak. The Nifty Bank, just take a look at the shape that it's taken. Yesterday, we were staring at around 47,800, 47,500 as well today. We're up 1,300 points in 2 sessions from yesterday's low. Just take a look at today's screen, more than 1,000 point up. And that's the one that's really driving the Nifty higher. Well, Nimesh joins us to tell us what he's picking up in terms of D-Street chatter. Nimesh?
Hi, Nigel. What a move for the markets, right? And the feedback from the dealing room is that while the Nifty markets are at record highs, the Bank Nifty has rallied pretty hard. But if you ask any trader on the street, they would have not made money. The overall market was quite light from a larger HNI perspective. They've reduced a lot of the positions in the market. FIs were net sellers, and now we are seeing a big move in the markets today. Again, largely led by financials, and even in the financials, the FIs have been net sellers. The positions are quite light on the financial side of the market as well. So it's kind of a left-out feeling as well, so to speak, Nigel, from today's move. I guess what led to this big short covering rally in financial is the big RBI dividend payout, which has been a big surprise to the street, and I guess that's led to a bit of a short covering rally in the banking stocks today. I guess what has led to this is largely all the domestic facing sectors have done well. The auto index is up 2%. So is the capital good index as well. So looks like today's rally is largely domestic driven, banks, autos, financials, and for that matter the capital goods as well. The only space which has done a bit underperforming is the metal names, and some bit of individual pharma stocks are under pressure today. But looks like it's a very sharp short covering rally in the financials, which has led the markets to hit a fresh record highs, and big move in the large cap names as well.
Yeah, it's absolutely breathtaking. Just 12 points away from the next milestone, 23,000. Let's see. Really phenomenal. Nimesh, what about stocks? Anything specific that caught your eye?
Well, the first stock on my list today is Adani Enterprises. Normally, it doesn't come into my chatter list, but big move on that stock, up 7% last I checked. The volumes are on the higher side as well. There has been some bit of HNI buying, but I guess the big trigger for the stock to do well is the anticipation that maybe Adani Enterprise will replace Wipro in the Sensex in the review, which is going to come in a day or two. So that's been the key reason for the big outperformance in Adani Enterprise today. The second stock is Vedanta. Well, the stock is under pressure today, but for the last couple of days, there is institutional based buying happening. And even in today's trade, while the stock is down, it's recovered from the lows, but there are buy flows, is what I understand from larger FIs in Vedanta. The third stock is BEL. We heard the management. There were a lot of upgrades as well from FI brokerages. But in general, in today's trade, there has been selling pressure. So it looks like after a big rally in BEL, some bit of profit booking is visible in today's market, especially from larger FIs in that name as well. And the last is Engineers India. We've seen a bit of rotation in the PUCs as well. This stock stands out today. Good volumes from larger HNI is what I understand. And some large HNI investors seems to be quite active buyer as well in Engineers India. And in fact, the feedback is technically to above 270, 273. It's a multi-year breakout as well on Engineers India.
Okay, thank you very much for that. In fact, generally PSUs today are taking a bit of a breather and not participating on the way up. So the Nifty PSC index is absolutely flat. Rahul Mohinder of ViraTechIndia.com is with us on the show. Rahul, 23,000 is almost here in the Nifty, still some distance away from 50,000 on the Nifty Bank. But how would you position yourself now? Any BTST calls?
Yes, the market continues to keeping on surprise because of the kind of speed. It's certainly on steroids. I would be a little cautious from taking a new index position, but having said that, as I mentioned, 23,400 is what I foresee. In a few days or a few weeks, maybe is how I'd like to phrase it. Stock specifically, much better ideas. I was looking at two stocks on my radar. One is Bajaj Auto. If you look at today's overall volumes, probably would be one of the highest volumes we've seen in the past 4 weeks. And plus, we've got a very steady incline on the price and the volume formations, even on an intraday chart. So I would buy the stock for a 9,200 odd target. Let's peg 8,900 as a support. So keep a stop loss below that. Another stock which caught my eye on, again, the back of volume, was Jubilant Food. Massive price action there, of course. But what I'd like to say is 450 is excellent support, established support. Use this volatility to probably get in for a 510 target with a stop below 450.
Okay, Jubilant FoodWorks has corrected. The day's high today on Jubilant Food was above 500 rupees. Numbers were good. They've returned, at least Domino's is showing some growth like to like. But Jubilant FoodWorks is coming for some profit booking. But let's focus on some market opinion now. Ramdev Agarwal, the chairman and co-founder of Motilal Oswal, says the election results on 4th of June will give more clarity on the economic and infrastructure boom. Adds that he's bullish on government continuity.
It's a festival of infrastructure, the start of infrastructure boom in India. And infrastructure boom happens when the economy booms. Because economy booms, the taxation booms. When the tax collection booms, infrastructure booms. So that cycle is on, and it's just about the beginning. And once this little bit of uncertainty in the market gets over on 4th, I think we are going to get much more clarity about what shape of infrastructure boom country is going to have.
So you gave me my segue into the next question. Speaking of 4th of June, just 9 trading sessions left for the election, for the D-Day, for the result day. What is your sense of the government that's going to be coming in? What are you pitching for? What are the numbers that you're looking at? And especially in context with market, how do you think the market sentiment is going to be like?
So, one, the outcome of 4th is not knowable. Okay? The rest all are the at best intelligent guess, but my sense is this is not knowable. And hence, let's not worry too much about it. General environment is good, mood is very good, so retail participation is very good, that boom is on. So I would think that 4th will come and go, and then we'll see the vision of the next 5 years, and vision about the infrastructure, defense, consumption. A whole lot of things will be, it will be a very exciting phase of next 100 years, starting from 4th of June. So markets will also respond to that. In any case, retail boom is on. I think the real, of course, the domestics are very, very positive, but foreigners are not that excited about the, are they selling because they don't want to take the event risk of 4? If that is so, then that will also reverse. And if by chance they reverse, even for a few days, I think we'll see a lot of excitement in the market. But again, the behavior of FI is also not knowable. So why bother about it?
So FII come back, or maybe they may not come back. Not knowable at all. But speaking of, so let's say the BJP continues to stay in power. What do you think will be the effect of a continuity in the government?
Yeah, so continuity means there is no break of the policies. If anything, whatever policies were pursued, it will be pursued with a lot more vigor. Say Vande Mataram train, if they have done say 200 or 300, they may do in thousands. So like that, much more bigger ambitious things will be rolled out. And it also depends on how the economy responds. Because government can respond based on how the economy responds. Because when the economy responds, the tax collection comes. If the tax collection comes, then the government's actions also happen. So, it's a I would say double engine kind of thing. The economy and the government action. And so I'm more bullish on under the continuity, the economy will pick up.
All right. The markets actually, we're almost at around that 23,000 odd mark. We're just around 9 points away. Big up move is what we are seeing. And, the last leg, actually, we're seeing a few stocks that are really taking off. Even some of those metal-related names that were trading in the red, they have popped up in trade. So if you look at JSW Steel, now that's done a U-turn. TCS is piling on the gains. Bharti Airtel as well. And 9 points away from that 23,000 odd mark, should be
400 points. And Nigel, I don't know, hand on heart, I don't know how many traders could have guessed this sort of a move today, given this kind of sort of buoyancy that we've got going. And it's firing on all cylinders. I'd want to see if anything changes in the cash market FII figures, because like we've been saying now, that's the only sort of spot which is not adding up. Is this a cash move from the FII fraternity, which has been sitting out so far? Remember, for the current month as well, for the month of May, overall cash market selling is to the tune of almost 28,000 crore rupees. So are some of those positions shifting before we get to the big June 4 event? That's what we need to watch out for. But look at Reliance, moving in style, 2% higher. Banks, we've been discussing that. A lot of infrastructure stocks have been doing pretty well. FMCG names have not been too bad. Today, even IT for a change, even that's kind of, at least a market performer, Infosys, Wipro. A lot of IT names also adding to the party. In fact, on the downside, we don't have too many stocks. Only individual result reactions where there's a disappointment, for instance, a Sun Pharma or a Power Grid. But otherwise, it's a strong move. And Nigel, like you're saying, some of the metal counters that were witnessing profit booking, even there, the sentiment is turning around. So we're just a couple of points away from the next milestone, 23,000. But I think this is after the jitters and, the Ides of May, if I could say the middle of May, all of that uncertainty is behind. And I think the bulls have made up their mind. They want to go in long and perhaps a front foot forward as we get into the big event.
I think we have to wait a little bit longer for the 23,000 odd mark. For the time being, we'll slip into a short break, come back, we'll continue with Market Talk on the other side.
Artificial intelligence, that's the buzzword echoing across the world, and companies only expect to see explosive growth in the sector over the next 10 years. So where does India stand today and what has been the rate of adoption? EY is addressing exactly that question in its latest report. India's legacy businesses are treading with caution, but startups and global capability centers are taking the lead in AI deployment. An online analysis of the publicly disclosed adoption of AI and Gen AI by India's top 50 most valued Indian unicorns shows that 66% are already using AI or Gen AI technology. This indicates that startups have been more proactive in terms of adopting AI technology versus your legacy players. Now, let's take a look at some of the most implemented Gen AI use cases among India Inc. 1/3 of them use Gen AI to execute.
Welcome back. So the mega up move remains. That's been the story of the day. We have Mayuresh Joshi joining in to make sense of what's been going on the screen. Mayuresh, hi, good afternoon. The screen's telling you one thing, it's that perhaps bulls are confident, CapEx, manufacturing, auto, banks. That's what today is all about. Your thoughts?
Afternoon, Surbhi. Absolutely. I think with the RBI payout yesterday, I think the entire consensus in terms of infrastructure spending is back with the bang. And with the expectations of a stable government expected to continue for the next 5 years and the reform processes thereof, I think the accelerated investments surrounding infrastructure, including capital goods, including a whole proxy in terms of housing, cement companies to a large extent as well to support that thesis as well. I think that entire move is getting well supported in terms of domestic cyclicals, expected to continue doing well. So yeah, I think earnings have been stable so far. Macros are looking good with the GST number that we've just witnessed, the RBI payout. And globally also, I think things seem to be coming back on track. So I think liquidity along with all macro and micro factors firing up the indexes on all cylinders.
All right, Mayuresh, I wanted your view on a couple of names, which have actually done well, but they come in for profit taking today. IMFA, that's Indian Metals. Now that stock is down close to around 3.5%. The first look at the numbers tells you that, they're quite disappointing on the margin front. But a closer look tells you there's a big spike up in the other expenditure. So there could be a one-off that's being factored in out there, just looking at those numbers. And we know that ferrochrome prices are very, very strong. That's virtually at the low point of the day. So that's one stock. And the other one is HEG. The stock is down 15%. Numbers are disappointing, and they have announced this demerger, which the street is still coming to terms with. Why did they announce it? Both these two have, good tailwinds, but for the time being, they're under pressure. They're ancillary, so to call it, of the steel space. Your view on either of them?
Afternoon, Nigel. Now, again, I think numbers in the case of HEG were definitely disappointing. They were very, very soft. But in the case, in a structural case going forward, I think at some point of time, as demand starts coming back, and the green steel concept that is now getting discussed within a large part of the European markets, I think that is going to be a game changer in the next few quarters. So I think a lot of companies need to revive their processes in terms of how steel is probably made. HEG probably in the right direction as far as that structural step is concerned. Obviously, what happens in terms of needle coke prices, how do they evolve over a longer period of time, will also have a say in terms of the overall operating performance. But I think the structural side of the story remains with these graphite electrode players. So I think there is a structural element as a tailwind to both HEG as well as Graphite India. As far as IMFA is concerned, ferrochrome prices are very, very stable, expected to improve going forward as well. Yes, I think the numbers in terms of one-offs did play off in terms of margins. But is there an expectation in terms of some element of recovery that can come through in the next few quarters? I think I've seen the management, you interact with the management a lot of times, Nigel, and the enthusiasm emits from the fact that at some stage, the stability will come back. Obviously, it's a commoditized play, but I think the end applications, realizations expected to remain strong will remain a tailwind for this case as well. So I think, yeah, both the cases have structural tailwinds behind them.
Just quickly, Mayuresh, trying to squeeze in two questions at one go. We didn't have too much time to talk stocks, but in case you have a view on Nykaa, please tell us. Market was not too excited with the numbers after Q4. And also shipbuilders. I mean, it's absolutely phenomenal. The rally in shipbuilder stocks today. Garden Reach is now ending almost on circuit.
So Nykaa again should be soft numbers, so I think we'll let that pass for the paucity of time. But yeah, I think the shipbuilders are acting like rockets. So you look at the share prices that all these shipbuilder stocks have probably delivered over the last few quarters, and they are delivering on numbers. So I think the only two angles that need to be looked out for is how will they execute? Is there an execution risk for any or all of these stocks going forward? What if they miss a couple of quarters in terms of not executing that well and therefore having a patchy annualized number as well? And the second risk obviously emits from the fact in terms of the receivable position as well. But I think the second risk probably seems to be a low probability in terms of how the government balance sheet is stacking up, how payments are probably happening, how the working capital days are playing out. So I think the only risk that happens for these stocks will be is execution. Fingers crossed, I think if they're executing well, I think the momentum can very well continue.
Okay, all right, Mayuresh, short but effective chat. Thanks a lot for joining in and giving us your quick analysis on a whole host of those names. Well, time to wind down on the markets. Then we came off a little bit. We saw 23,000. We thought it was within kissing distance, but we end a little bit off that. Though on an average, we'll end closer to around 22,970 or thereabouts. What did very well today? Adani Group stocks, they were back in style. Adani Enterprises, Adani Ports, both of them firing away. And domestic-facing themes, Mahindra & Mahindra, L&T, Eicher Motors, all of them, bazooka moves is what we saw. These are frontline names that saw a big rally today. And the banking names would be, what a dream run out there. 1,000-point rally is what we're talking about. Took out the 50, took out the 20-day moving averages in style. And that was the big driver today.
Oh, absolutely. I mean, huge moves on these stocks. Even other names on the large cap screen. I mean, Reliance was playing ball today. You had stocks like, TCS, Infosys from the auto pack that weren't too bad either. So it was pretty much all guns blazing. Can't really complain much. ITC, by the way, is ending absolutely flat after its numbers. Let's talk about mid-caps. The mid-cap index has underperformed the large caps. There's no two ways about it, with a gain of just under 0.5%. The advanced decline ratio mildly negative. We've got over 1,250 declining stocks today versus about 1,100 advancing stocks. So it's more stock-specific, the action there. But the PSU trend was still evident. Today it was more about shipbuilders. We were just discussing these stocks. Look at Mazagon Dock, look at Garden Reach, look at Cochin Shipyard. Massive, massive moves on these shipbuilding stocks once again. And, well, railways don't want to be left behind. They're speeding away as well. So RVNL, IRFC, once again, good moves coming in over there. Then there are other names as well. I mean, there's a Vodafone Idea that had a good session. Torrent Power, where numbers originally were thought to be sort of a little lower than expectations, but it turned around. The sentiment remained positive around the company and the prospects. So that stock managed a recovery. Page Industries slightly lower after earnings. So basically, for the mid-cap market, it was more about reacting to individual numbers. The bigger, larger, broader move really was in the big arena, the large caps today. Bell has gone 22,952 is the closing figure, with a gigantic 350-point up move and fresh highs on the Nifty as well as the Sensex. Well, that's a wrap on this edition of Closing Bell. Thank you very much for being with us, but don't go anywhere because we have our special edition of Bulls Charge ahead coming up next.
Using intelligent assistants, while 25% relate to marketing automation. In fact, this quarter has also seen a diversification in investments going into firms using Gen AI or AI applications. However, the report highlighted that hallucination of LLM or large language model responses, data privacy and sovereignty, and the cost implications of deploying Gen AI in production are the top issues. Meanwhile, another report by TCS lists out the same concerns with generative AI, but delves deeper into the kind of impact artificial intelligence can have on the economy. The report, which interviewed over 1,300 CEOs, looked at the potential of AI for business and how it compared with the past disruptive techs like internet and smartphone. While 54% believe the impact would be greater or equal to the internet, 59% say that it would be greater or equal to smartphones. The study also found that 49% of those interviewed expect AI to have no impact on the number of jobs created, while 47% expect more roles to be eliminated than created. Finally, a report by Microsoft and LinkedIn found that an overwhelming 92% of those surveyed were already using artificial intelligence at work versus the global average of just 75%. The survey, which included 31,000 people across 31 countries, also found that 91% of Indian leaders believe they need to adopt AI to stay competitive. However, 54% worry that their organization lacks a clear plan and vision for AI implementation. Despite this, employees are eagerly embracing AI tools, with 72% of Indian AI users bringing their own AI tools to work. 75% of Indian leaders stated that they wouldn't hire someone lacking AI skills, outpacing the global average of 66%. The report, aptly titled "AI at Work is Here, Now Comes the Hard Part," it says that AI is transforming the world of work, reshaping talent landscape, and nudging both individuals and organizations to embrace change.
So the big question that we are asking is the worst over for the chemical sector? Is the worst behind? Now, there has been few brokerage reports in the last few days where they've turned a bit bullish on the chemical sector. But if you look at the management commentary post Q4, most of the managements do believe, and they have a mixed feedback, and they expect the recovery to be in the second half of FY25. And even when there is a recovery, it's going to be volume-led and not price action. So the margins could still be under pressure, even in the second half of FY25. That's a management commentary. But look at the chemical as a space. There has been short-term pain for the chemical sector stocks, but over a longer-term period, they've been massive wealth creators. The next table will show you what I'm saying. Over the last 2 years, most of the chemical stocks have been under pressure. Aarti is down 12%, Atul is down 28%, Navin Fluorine is down 14%, and so is Vinati down 12%. But over a 10-year period, they've been massive wealth creators. Same is with UPL. The stock is down 35% in the last 2 years, but it's gained 15%. But there has been some notable winners as well in the last 2 years. PI Industries has been the best performing chemical stock over the 2-year period, up 54%, despite the fact that it's been a 30% CAGR over the last 10 years. Deepak is up 25%. Again, that's a big wealth creator. So is Tata Chemicals, and SRF marginally up in the last 2 years, but there's been a big recovery over the 10 years.
The market hits a record high following RBI's highest ever dividend for the government. The Sensex and Nifty, along with the mid-cap indices, end at record closing levels. Mid-caps underperform. The market breadth remains in favor of declines.
Buying in financial names helped the Nifty Bank hit more than 2%. RBI dividend bonanza leads to a sharp short covering in banks. Healthcare lags as Sun Pharma guides for single-digit growth in FY25, while Lupin slides on new competition in one of their key drugs.
ITC reports a good set of numbers for the quarter gone by. The core business did well, while agri and paper businesses lag. On the other hand, Page Industries reports a sequentially weak quarter.
Hello and welcome. Bull charge ahead. Your go-to show. We're going to get you all the key data points of this today big rally that we saw, and also gear you up for tomorrow's session. I'm Marshall D'Souza, and joining me as always, Surabhi Upadhyay. Well, Surabhi, what a day.
Those bulls are charging ahead. They're saying we're ready for the 4th of June.
Yeah.
But indeed, I mean, a mega move, almost 400 points on the Nifty. So yesterday it was the RBI doing the bazooka.
Yeah.
Today it was the bulls of the equity market doing the bazooka, right?
Let's take stock actually of today's trading session. There were actually two big triggers. One was the big RBI dividend that we saw yesterday, which clearly helped sentiment here, both on the, on the fiscal mat, as well as it gives the government more amount of headroom in case they want to push through growth or expenditure. So that was one factor. Big dividend is what we saw, and crude cooling off. Remember a few sessions ago, we were at around $90 per barrel. We've cooled down to around $81 per barrel, which from an Indian perspective, it's very, very good. The Nifty Bank, yesterday it looked a little bit weak. It made a bit of a recovery in the second half of trade, on the final hour of trade. It took out the 50 DMA, it took out the 20 DMA. It was on its way to around 49,000 odd, and that was the big driver in today's trading session, taking out some crucial technical levels. And one pillar of the market fired, which is the Nifty Bank, but he wanted the other one as well to do well. Nvidia's numbers came out overnight. Well, the stock was up close to around 6% in post-market close. It gave some kind of positive sentiment for the IT stocks, and they as well did see a big move. So you had both the opening batsmen, the banks and the IT names that did pretty well in trade today. And domestic-facing themes would be, what a beautiful rally out there. Large cap names. If you're talking about an L&T, that did the heavy lifting out there. You talk about some of these auto-related names, whether it was Mahindra & Mahindra, Eicher Motors, all of them moved up. The only problem was your portfolio may not be looking very, very good if in case you tilted more towards the broader markets, because the mid-caps did underperform in today's trading session. Advanced decline ratio, the index on the whole, underperformed in comparison to the large cap names.
Absolutely. I think the RBI provided the much needed trigger for banks to start playing catch up, and that sparked a massive move throughout the market as well. And that's exactly what we got today. Today there was support from a lot of different sectors, as Nigel also pointed out. It was banks on one side, it was auto stocks, IT was doing well, big names like Reliance were contributing. There weren't too many losers on Nifty. It was a very beautiful, widespread, broad move on the large cap screen itself. By the way, in the mid cap arena, yes, there was underperformance, but one trend that you can't ignore simply is PSUs. And today's PSU favorites were actually shipbuilding stocks. Many of them were looking at double-digit gains. I mean, stocks like Garden Reach Shipbuilders, almost 19% higher. Mazga Dock, Cochin Shipyard, massive moves coming in on many of these PSU names. The performance in mid-caps was more stock-specific. It was a lot more about earnings reactions than a wider market move. So, for instance, Nykaa, disappointment on Q4 earnings. Gland, where the market thinks perhaps the worst is sort of, getting over and done for the company. Torrent Power, similar story there. Q4 P&L, market not too happy, but then the commentary and the outlook is what I think the market was focusing on. So recovery from the opening lows on that stock as well. So very interesting trends in the mid-cap market, but the headline absolutely coming in from that mega move on the Nifty and on the Sensex. Well, let's tell you about the lineup, what we have in store for you on the show today. We'll start off by getting you a little more color, and the color is largely green on all the movers and shakers. So Vivek joins in just a bit. The sector of the day was, of course, banks. The stocks that we'll focus on today are Lupin, Cipla and Sun Pharma. We'll tell you why these stocks were buzzing and what the news points here are. Then, of course, we come to D Street Chatter, find out what Nimesh picked up as this mega bull charge was playing out throughout the course of the day. And also today, he's looking at Adani Group stocks, particularly Adani Enterprises. Big move on many of these stocks, with Adani Enterprises leading from the front. And finally, of course, we'll look at all the key events that you need to watch out for tomorrow. But first, the movers and shakers, it's over to Vivek for that. Vivek.
Well, thank you so much. A complete green screen and absolutely not complaining, very, very good day. So the first sector today that we will target is the one that underperformed so far, the entire banking pack. The entire space did very well today. So top movers, Access, Indus, and AU, all of them did quite well. All of them have been significant underperformers, especially in the last 2 weeks. The next set of stocks that did very well in the session today, especially in the last hour, saw significant up move, was the entire auto pack. So have a look at, the kind of moves that Maruti, Hero, TVS Motors, Eicher Motors, all of these names saw, especially in the last hour, very, very good session. You also alluded to the shipbuilders name. Both shipbuilders as well as railway stocks today did very, very well. Have a look at names like Garden Reach, Cochin Shipyard has got a very good set of results as well. And along with that, you also saw RVNL and IRFC today moving strong in the session. The next stock on the radar was PNB Housing. The company held an analyst meet, and analysts came back quite enthused. The company has given some strong commentary in terms of the guidance. A 17% loan book growth CAGR is what they're estimating between FY24 to FY27. The next stock on the radar was Gland Pharma. As far as the results itself was concerned, it was a muted set of results, but the core-based business, especially as well as the US launch momentum, was something that was strong. Stock high by almost 5%, cooled off a little bit from the day's high. But on the other hand, there were a few set of stocks that did see some selling pressure. In fact, the entire commodity pack saw a bit of profit bookings for names like Hinzink, Vedanta, NMDC, Hindustan Copper. All of them cooled off a little bit in the session today. The next stock is Sun Pharma. Sun Pharma, slightly muted set of results, very high R&D spends that the company is anticipating, has made analysts quite wary as far as how FY25 will pan out, expecting a better FY26. Lupin, this particular stock, we highlighted it in the morning as well. One of the competitors for the company has got a nod for a very key drug. And on the back of that, stock saw almost a 5% sell-off today. HEG, again, a muted set of results. Along with that, Street hasn't taken too kindly to the kind of demerger that's happening over there. 16% lower for the session. And Team Lease, yesterday Team Lease was one of the top gainers just after the results came, but the internals look quite muted. Commentary too was quite muted, and stock ended lower by almost 10%.
Good wrap, Vivek. Thanks a lot for that. Well, it was a day of record rally for the markets. The Nifty ended just shy of the 23,000 mark. Buying in financial names led the Sensex, the Nifty to record highs. The mid-caps were the relative underperformers, though the index also scaled new highs. 44 out of the 50 Nifty stocks, well, they closed higher. The key contributors were the big boys: HDFC Bank, Reliance and ICICI Bank. Let's listen in to some market opinion that we got all through the day.
If the results are, what the market likes, then yes, you could have a big relief rally, so to speak. I think after a few days, it will be back to kind of normal, right? And then there will be the anticipation for the budget in terms of what happens. Well, there will be anticipation because, they've talked about bold reforms. So people are, everybody is going to think, from my perspective, we will think about capital markets, what can come. Somebody else will think, what can come as a bold reform in the budget. But it'll be interesting to see, I think on the whole, in the run-up, if the results are as per the market's liking, then I think in the run-up to the budget, we should have a pretty decent market, I would say.
Continuity means there is no break of the policies. If anything, whatever policies were pursued, it will be pursued with a lot more vigor. Say, Vande Mataram train, if they have done, say, 200 or 300, they may do in thousands. So like that, much more bigger ambitious things will be rolled out. And it also depends on how the economy responds.
Okay, well, that was market opinion that we picked up on this big day. Joining in, now we have with us Mayuresh Joshi, Head of Equity Research at William O'Neill, as well as Ruchit Jain, lead for research at 5paisa.com. Mayuresh and Ruchir, thank you very much for joining in. So, Ruchir, just on levels, now that we're in blue sky territory, how do you read the strength of the breakout that we've seen today? Nifty Bank is still about 2.5% away from all-time highs. Would you be comfortable taking fresh longs now?
Yeah, hi, very good afternoon, Subhi. Very good afternoon, Nigel. Well, there's no doubt about the broader trend which remains on the positive side. And usually whenever market hits all-time high, in technical analysis, we take retracements of the previous correction to take a gauge that where the next resistance could be. And the recent correction which we saw from 22,800 to 21,820, almost a 1,000-point correction, 138.2% retracement of that correction is coming around 23,170, and 161.8% retracement is coming around 22,400. So we believe that from a very short-term perspective, our markets could continue with this move towards 23,400 kind of levels. So the risk-reward ratio, even after today's up move, is not that bad to create fresh longs. So one can take a fresh exposure since the rally has been supported by large cap stocks today, and one can keep a stop loss below 22,750 now, which is a support on the lower time frame charts. In fact, if you look at next series options data, being a monthly expiry, today we witnessed a lot of put writing over there in 22,800 strike price. So 22,750 should be the stop loss on any long positions, existing longs or even fresh longs. And one can expect first targets around 23,160, followed by short-term targets around 22,400. Sorry, 23,400.
Okay, all right. Got that. Well, let's focus on the sector of the day then. That's the banks. The Nifty Bank Index gained over 2%. This after the RBI announced a record annual dividend of 2.11 lakh crore rupees for the government. This is a bonanza for the government, which had budgeted just over 1 lakh crores, and the payout is double of that amount. Well, this dividend is nearly 3 times higher than the 87,000 crore payout that we saw in the previous fiscal, that's FY23. We spoke to a whole host of guests. Mr. Samran Chakrabarti, the Chief Economist for India at Citi, as well as Sonal Verma, the MD and Chief Economist at India at Nomura Financial Advisory. Here's what they make of this big move.
We were putting out in our notes saying that there is a possibility that the RBI dividend will be significantly higher than what the government has budgeted for. And so that way, it's not that big a surprise for us. Yes, it means that the government has 3 options in some sense. One is that it can reduce the fiscal deficit, 0.3% of GDP, as you mentioned. What the initial thought process was that the government will do only somewhat marginal tweak to the interim budget numbers, because the interim budget itself was quite detailed. Now, with this more than 1 lakh crore extra kitty, the budget maths will have to be reworked, and it will become very interesting, and the market will keep on speculating till it's actually announced.
It's a substantial fiscal bonanza that has come in. We think the government could therefore choose to reduce the deficit marginally when it presents the final budget in early July, which is what we're expecting, but also leave some cushion for any unexpected shifts that might happen on the revenue and the expenditure side. This is actually going to add to the cash surplus that the government is sitting on. This could very well go, above 5 trillion INR, and therefore some sort of a reduction in the borrowing, could happen. Again, the details of this are likely to get announced in the budget. And as Somiran was saying, it's really positive from a demand-supply environment. So our own forecast is that the 7-year as well as the 10-year bond yields could drop to 6.75%.
Okay, so there you hear views coming in on what this RBI bonanza perhaps could mean for the fiscal deficit, for the bond markets, and overall borrowing expectations. Mayuresh, we saw what that did to bank stocks. It just sparked a massive fire, massive rally really over there. But how would you approach BFSI? What would you buy afresh, given that stocks have now reached elevated levels?
Afternoon, Surabhi. So obviously there are a lot of triggers behind the entire space as a whole. And second, I think earnings for a large part of this space has held up pretty well. So I think expectations in terms of NIM contraction has been very, very marginal. What has largely transpired, specifically for the large private sector banks, was how deposits will probably grow. But even they have grown at a reasonable pace in the quarter gone by. And with some elements that of expectations that there will be at least a rate cut in the US market or two, RBI should also have a similar trajectory in the Indian context, which also gives similar tailwinds in terms of significant growth levers that the space can probably have. So I think among the large names, the PSRS ratings for stocks like an ICICI Bank, Axis Bank look extremely strong. Within the PSU universe, stocks like State Bank of India, Bank of Baroda are also exhibiting similar characteristics and most parameters in terms of growth, specifically when it comes to advances growth, NI growth, the provisioning that they've done, credit costs expected to trend lower, are all positive signs in terms of return ratios picking up, which we closely monitor at MSI. So I think all these 3-4 large names can definitely be kept on your watch list.
Okay, all right. Got that, Mayuresh. Well, let's focus on the pharma themes. Ekta joins us to tell us why a couple of those stocks did get knocked back in today's session. Ekta, take it away.
Well, yes, Lupin and Cipla were in focus today. That is because Amphastar has received US FDA approval for a particular drug that they sell in the US markets, which is basically albuterol inhaler. So Amphastar has received US FDA approval for this particular drug. Now, it is a negative read-through for Lupin as well as Cipla, because albuterol is the second largest revenue contributor to Lupin and Cipla's US revenues. And estimates are, according to analysts, that there could be some amount of price aggression from Amphastar. They could probably resort to around 10 to 25% price erosion to gain market share. So that's the reason why you saw these stocks under pressure. But remember that this is not the first time that a big product has seen competition come in. Yes, it does dent sentiment, but this is pretty much factored into the larger business models, and hence maybe the street will probably shrug it off at some point.
Okay, all right, got that. Thanks very much, Ekta, for those details. Well, staying with the pharma space, Sun Pharma was the top Nifty loser today after the company's revenue came in below estimates. However, margins came in better than expected. Group CFO CS Muralidharan spoke to CNBC-TV18 about the company's guidance for the current fiscal.
So our revenue guidance of high single-digit growth of FY25 is based on all the businesses which are poised for growth. As far as the EBITDA margin guidance, we have not been given guidance on EBITDA for last couple of years at this point of time.
All right, so you had both the pillars of the market that did do well, that was tech as well as the banking names. But it required some support coming from a big boy like ITC, and the numbers didn't disappoint. Mangalam joins us to fill us in with a quick analysis on that. Mangalam.
Well, ITC was higher in today's trading session as the company reported their fourth quarter numbers, and it looks like, even as the headline numbers were below expectations, the internals were pretty strong. Starting from the estimated cigarette volume growth as well, which came in at around 2 to 3%, and this compares with street expectations of 0 to 1%. So let's tell you what's good and what's not so good in these numbers. What's good was the cigarette revenue for the company grew by 7.7% as against street expectations of 4 to 5%. FMCG revenue for the company also grew at 7%, slightly lower end of street's expected range of 7 to 9%, but nothing really to worry about. In fact, the margins for the FMCG business did improve quarter on quarter. That's not all. The hotel business, which has been on a strong footing for the entire industry, continues to do well for ITC as well. The revenues grew 15% with an EBIT growth of 33%. Now let's talk about the weaker parts of the company. Agriculture, there we saw a near 13% decline in revenues. This as against street expectations of 5 to 6% growth. Even the paper business saw a revenue decline of nearly 7% as against expectations of 5 to 10% decline. The street was working with weakness in the paper business and some one-offs in the agri business itself. And that led to the overall numbers, reported numbers, being slightly below street expectations, 16,579 crores on the top line versus a poll of nearly 17,000 crores. EBITDA about 150 crores shy of street expectations of 6,300 crores. Margins were largely in line, and the net profit came in a little above 5,000 crores as against street expectations of 5,115 crores. The key triggers to watch out for going forward will be one, the hotel demerger shareholder nod that takes place on June 6th, and thereafter the budget announcement of the new government is something we'll be watching out for in terms of taxes for the tobacco industry, and rural recovery has been a theme for all the FMCG companies, and ITC going forward should benefit from that.
All right, Mangalam, thank you very much for that. And with that, it is time for a quick break. We'll come back on the other side and get you a popular segment, The Street Chatter, along with all the events to watch out for tomorrow.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Welcome back. Well, let's shift focus to the corporate corner segment. First up, Bharat Electronics. The management has guided for 25,000 crore rupees worth of order inflow for FY25, but says that this does not include some big ticket orders. They add that the order value will be in the range of around 2 to around 3,000 crore rupees, and the contract with L&T will be executed in the next 2 to 3 years. Next on the list is PG Electroplast. That reported a strong set of numbers. The management is aiming for 3,400 crores of revenues, with margin expanding by around 100 basis points for FY25, and the growth will be led by the AC segment and washing machine segment.
Now on to TeamLease. The human resources services company does not see any recovery in IT hiring or specialized staffing going ahead. Management says it's comfortable with 20% growth in generalized staffing. The company anticipates improvement of 5 to 10 basis points in margins on a sequential basis. That's not all. HEG was under tremendous pressure today as margins came in at a 3-year low. Also, the company announced a demerger of the business. The management says that HEG Green Tech EBITDA will move towards 1,000 crore rupees in the next 2 to 3 years, while the core business will struggle for 2 more quarters. Okay, well, those were some of the important corporate highlights that we picked up during the course of the day. It is now time for D Street Chatter. Let's straight away go to Nimesh and figure out all that he picked up on today's mega bull charge. Nimesh.
Hi, Sarbina. Record high for the markets thanks to some massive short covering in the financial limbs today. However, the breadth was weak and the mid-cap index relatively underperformed. So it's not like every trader made money in this big charge today. In terms of individual stocks, so the first name is Adani Enterprise. Big move in that stock was the biggest F&O gainer today on large volumes as well. The street is anticipating Adani Enterprise to replace Wipro in the Sensex later this week. So that was a big trigger for the stock to do well today. The second stock is Vedanta. While the stock was under pressure today, so with the metal names, but for the last couple of days, there is very strong buying interest from larger FIs. So again, in today's trade, there was delivery-based buying from larger FIs in Vedanta. The third stock is BEL. A big move in that stock as well, post earnings and very strong commentary from the management. But after such a sharp move, some bit of profit booking is clearly visible. So there were sell flows from larger FIs in BEL today at higher levels. And the last name is Engineers India. Again, this was one stock which was buzzing into it on large volumes. I understand some HNI interest is back and some large HNI investors have been active buyers as well in Engineers India in the last couple of days.
All right, Nimesh, thanks a lot for that. Well, before we wind down on the show, let's get in Abhishek to tell us all the key market events we need to track for tomorrow. Abhishek.
Well, to begin with, US jobless claims data will come out today. The estimation is about 2.22 lakh versus 2.2 lakh last time that it had come out. S&P Global PMI, that is estimated to come at 51.3%. And to watch out for tomorrow, RBI data will be there on Forex reserves. There will be bonus issues from GM Breweries 1:4. Inox Winds, the announcement again on bonus issue of 3:1. Stock split will take place. Bharat Dynamics face value will decline to ₹5 from ₹10, and some distilleries over there, the face value will decline from ₹5 to ₹2. Interim or final dividends will be coming out for Vedanta Limited as well as Tata Consumer Products. And watch out for the earning season. Tomorrow we have results coming in from Ashok Leyland, Hindustan Construction Company, Hindalco, as well as Hindustan Copper Limited, and it will mark the end of result season for the banking sector with Karnataka Bank result, Manappuram Finance Limited, and United Spirits as well.
Okay, Abhishek, thanks a lot for that. Well, with that, it's a wrap on this edition of Bull Charge Ahead. We'll be back with more news and updates on the other side.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP
was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with
Hello and welcome to Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. Equity market surged to record highs as a bumper surplus transfer from the RBI sparks hope of a reduced fiscal deficit. The Sensex and the Nifty jump over 1.5% each. Investors' wealth on the BSE rises by 4 lakh crores to a record 420 lakh crores. Tech giant Infosys says it's currently working on 200 generative artificial intelligence projects, adding that 6 of 8 Infosys employees are being trained on Gen AI at different levels. CEO Salil Parekh tells CNBC-TV18 he has no plans to cut jobs at the company due to the AI push. That's an exclusive. ITC's Q4 numbers largely along expected lines. Flat cigarette volumes, lower FMCG margins drag on net profit, but the core business continues to do well. The company declares a final dividend of 7.5 rupees a share. Total dividend for the year above 13 rupees. At $25 trillion, US chip maker Nvidia is more valuable than Tesla and Amazon combined. The company's shares surged past $1,000 in extended trade following a spectacular